Hi students, I'm Prakash, Chartered Accountant and acting as Academic Advisor in Masterminds from the past 23 years. So several students have been sending mails and messages to me with respect to the CA Inter latest marathon on advanced accounting. So here is a reply to all of you. So my dear students, we have already uploaded this kind of marathon in December 2024 itself, and each of those two parts were viewed by more than 1 lakh students. And here is the latest video of the same marathon by the same faculty, and this is applicable for January 2026 as well as further attempts. So as you already know, advanced accounting is a very vast subject, and it's not practically possible to cover all the important points in a single video of 12 hours. So that's why we have decided to record this marathon in 21 hours and divided the same into two parts. So I hope that all of you will watch both the parts till the completion so that all the important concepts in the entire syllabus will get covered from exam point of view. So of course, no marathon is a substitute for your preparation. We can only cover the important concepts in this 21 hours of marathon. And by the way, this video is recorded by our one of the senior most faculty, CMA Pranay sir, having 9+ years of exceptional teaching experience. Now coming to more details about the marathon. So we have intentionally recorded this video in 100% English. And don't worry, chapter wise timestamps information is already provided in the description of this video. So generally marathons are extracted from the pre-recorded videos, or sometimes they will be recording them in recording theaters. But we have taken a decision that to give the best quality to the students, it's always better to record this marathon in the face-to-face classes. And for this marathon, more than 250 students have attended in person. So that itself will indicate the quality of this marathon session. So if you like this marathon, then please press the like button so that YouTube can recommend this video to still more number of students. If you got benefited by watching this marathon, then please do recommend this video to your friends so that they'll also get benefited. And don't forget to give your valuable feedback about this marathon in the comment section so that we can make further improvements and we can make this marathon session still more useful to the students. Now, so the faculty has shown one material, exclusive marathon material, and all of you can freely download that material. So whatever the marathon material that we have prepared and the faculty has explained, and you can freely download the same, and you can even print out the same. So first of all, in your Android mobile or an Android tab, you need to install Masterminds app, that is Masterminds online classes. So after that, you need to give your mobile number and mail ID and sign up and select the option of free material in the menu. So you can find the menu with 3 horizontal lines on the top left corner. And after that, click the Documents tab. And next one, open the relevant folder. So for example, so since you are searching for January 2026 attempt marathons, so open the folder of that particular attempt. And in that folder, you will find the relevant file, that is, so January 26 attempt advanced accounting marathon file. So now you can download, you can even take a printout, or even you can share it with your friends. Now, so for best CA and CMA related course videos, please do visit our website mastermindsindia.com. In the top right corner, you will find the buy videos courses section. So please click on the same and you can purchase the relevant courses that you want. And before making the payment, please do call our team members for any technical assistance. So all the best, my dear students. Now you can start enjoying the marathon session. So very soon our team will be uploading the marathon of the remaining subjects of CMA Inter, CA Inter and CMA Final as well. So whenever we upload a latest video, if you want to receive a notification, then please do subscribe to this channel and also press the notification bell icon. All the best, my dear students.
So fine, my dear children, let me start with accounting standard number 2. What is accounting standard number 2? Yes, obviously valuation of inventories. Likewise, my dear children, always just with the name of the standard, you are supposed to know the objective of the standard. Likewise, to tell you, frankly speaking, coming to this valuation of inventory. Fine. So, hope you have remembered the concepts of recognition, measurement, presentation and disclosure. Please respond. What do you mean by recognition? Recording. Measurement is nothing but amount or valuation. Presentation. What do you mean by presentation? Presentation means where that element appears in the financial statements. Element in the sense? Element of financial statements. In framework you will be learning something called elements of financial statements, which is actually a very important for theoretical question. I mean to tell assets, liabilities, incomes, expenses and equity. All these are the elements of the financial statements. And where does this element appears in the financial statements? I mean to tell what includes in financial statements, my dear children? Components of financial statements: balance sheet, P&L account, cash flow statement, source, notes to accounts. I mean to tell statement of changes in equity and notes to accounts. So every element appears in financial statements at one place. Where shall it appear? We call it technically as a presentation. To tell you something like valuation of inventory. So where does inventory appear? Is called as presentation. What is the entry for salary? Salary account debtor to cash or bank account. Salary paid is an expense. Am I correct or wrong? Where does salary appear in the financial statements? That is called as presentation. Is my point clear, everybody? Something like, as you people said, salary appears in P&L account. That concept is called as presentation. And finally, disclosure, which is nothing but additional information given in notes to accounts. It's like something like giving more clarity. Already what had happened is given in the financial statements. Why it had happened, how it had happened will be given in the notes to accounts. Let me tell you a simple thing. Debtors total amount is 1 lakh. But how is it 1 lakh? You go with debtors, you go with notes to accounts relating to debtors, then you will come to know. Likewise, to tell you more clear, trade receivables 1 lakh. How trade receivables is 1 lakh? Check out the note relating to trade receivables. There you are having debtors. There you will be having bills receivable. And also from debtors you may need to deduct a provision called provision for doubtful debts or bad debts. Am I correct or wrong? So this entire part is absolutely nothing but disclosure. Clear, everybody? So now coming to accounting standard number 2. My dear children, what is accounting standard number 2? Valuation of inventory. And coming to valuation of inventory, this is a standard which is dealing only with measurement and disclosure. This is a standard dealing only with dash and dash. Measurement and disclosure. And to all my dear children, this is quite common, that is methods of valuing inventory. Hope you have remembered the methods of valuing inventory. FIFO, weighted average, Inka, standard cost method, adjusted selling price method, etc. But hope you have remembered, is LIFO method permitted or not permitted? LIFO method as per AS2 permitted or not permitted? Not permitted. Why? Fine. We shall discuss the reason later. Anyways, my dear children, the objective of accounting standard number 2 is all about to deal with measurement and disclosure, and also it deals with methods of valuing inventory. It also deals with methods of valuing inventory. And moving on to the next thing, my dear children, which is very, very important, scope. In most of the standards under scope, you will be learning something called non-applicability. Shall I start now? What do you mean by non-applicability, Amma? Standard is not applicable even though it is inventory. Hey, what is AS2, my dear children? Valuation of inventory. Even though it is inventory, accounting standard number 2 does not apply. For what it does not apply? Number 1, work in progress providing for service providers. Work in progress arising from service providers. Work in progress arising from construction contracts. And this is important. Investments in securities held as stock in trade. Investments in securities held as stock in trade and producers inventory relating to renewable resources and non-renewable resources. What is the last and final one? Producers inventory relating to renewable resources and non-renewable resources. Concentrate carefully. Work in progress arising from service provider. Likewise, tourism industry is there. Participate everybody. Tourism industry, hospital industry, hotel industry, all these industries are providing goods as services. Services. Even those service industries are also having some sort of inventory. Am I correct or wrong? Say for example, tourism industry is having inventory kind of something like some cars were given to some customers. By the end of the year, still the cars are there in trips with the customer. Here trips, whatever is there, it is nothing but a service. In the same way, something like hotel industry, lodging and boarding, hospitality industry. By the end of the year, there may be several rooms booked by the customers. And the hotel is providing that room service concept. Whatever the room service at the end of the year, which are still into the hands of customers, is nothing but a service there. I hope you are getting clarity. For all these industries, with respect to the valuation of services, accounting standard number 2 will not deal with. Then who will deal with this service industry, sir? Industrial norms. And the next one, you know very well, something like construction contracts. Contracts which are still under work in progress. Say for example, a contractor accepted a contract which will be completed in a span of 3 years. So after the completion of 1 year, is the contract completed a work in progress? Because the total span of the contract is 3 years. So after the completion of 1 year, still the contract is under work in progress, which is nothing but work in progress arising from construction contracts, for which accounting standard number 7 is applicable. Clear everybody? And hope you know well about this point. Investments in securities held as stock in trade. It is relating to investment. So there is a separate standard relating to investments, AS 13. But unfortunately, AS 13 had excluded this. AS 13 had excluded. Of course, it is stock, sir. Then there is a standard relating to stock, AS 2. But unfortunately, AS 2 had given this under non-applicability. So frankly speaking, even though it is investment, AS 13 is not applicable because it is excluded. Even though it is stock, AS2 is also not applicable because it is specifically given under non-applicability. Is it clear everybody? Then who will apply, sir? Obviously guidance note will be applicable. Who will apply, Amma? Guidance note. And coming to guidance note, what is applicable? Rule of valuing current investment. What is applicable, Amma? Rule of valuing current investment. Hey, what is the rule of valuing current investment? Cost of fair value, whichever is lower. The same is applicable here. Is it clear? Investments in securities held as stock in trade. Dash is applicable, Amma. Guidance note. What is telling by the guidance note, Amma? Rule of current investment. What is the valuation rule of current investment, Amma? Cost of fair value, whichever is lower. And the last and final, which is very important logically, is producers inventory relating to renewable resources and non-renewable resources. Please concentrate carefully. Say for example, there is Mr. A who is a farmer who is producing agricultural crops. By the end of the year, they have actually produced 25 bags of paddy and 20 bags of paddy were already sold to Mr. B, who is a shopkeeper. Now, by the end of the year, this shopkeeper actually sold 16 bags of paddy. Is the example clear, everybody? Sir, is the example clear? Now tell me, Mr. A is totally having how many stock in his hand? 5 bags in his hand. And Mr. B is totally having how many bags in his hand? 4 bags in his hand. Frankly speaking, Mr. A's closing stock is 5 bags. Mr. B's closing stock is 4 bags. AS2 is applicable to, like, is it applicable to Mr. A, Mr. B, or both? Mr. B. It is not applicable to Mr. A because Mr. A is the producer. Accounting standard number 2 is not applicable for producer's inventory, but it is applicable to all other people like trader's inventory. Is it clear, everybody? Please don't confuse. Don't think that AS2 is not applicable for agriculture crops. Don't think that AS2 is not applicable for mines and minerals. Don't think that AS2 is not applicable for forestry products. No, that's not the concept at all. AS2 is applicable for each and every type of this product, provided they are not producers. Is it clear, everybody? Likewise, everything is fine, sir. Then what do you mean by renewable resources and non-renewable resources? So simple, my dear children. Renewable resources, example like agricultural crops, forestry products, and all the cultures that you are having, sericulture, pisciculture. Horticulture is not specifically dealt here because horticulture is a kind of orchard. I mean to tell, like mango orchard, something like that, for which accounting standard number 10 will be there, a concept of bearer plant. So we shall discuss there. Apart from horticulture, every other cultures will be coming here. And coming to non-renewable resources like extraction of mines, minerals, oils, etc. will be coming. Respond, everybody, clear? Please concentrate. Say for example, Mr. A again is the owner of the mine. He had given the same to lease to Mr. B. Mr. B is actually extracted 10 tons of minerals and sold 8 tons of minerals to Mr. C. And Mr. C sold 7 tons of minerals by the end of the year. Is it clear? Is the example clear, my dear children? Just answer me, to whom accounting standard number 2 is outright not applicable? To whom accounting standard number 2 is outright not applicable? Mr. A, B or C? For Mr. A, outright accounting standard number 2 is not applicable because he is the mine owner giving something to lease to Mr. B. I hope you are getting my point. Sir, my dear children, where is the inventory to Mr. A? Where is the inventory to Mr. A? Is there any inventory to Mr. A? That is the answer. Inventory is not there to Mr. A, and hence outright AS2 is not applicable to Mr. A. And Mr. B, how much is the inventory? 2 tons. Mr. C, 8 tons purchased, 7 tons sold. 1 ton is the inventory. Now tell me, in Mr. B and Mr. C, again AS2 is not applicable for Mr. B or C? B, because B is a kind of producer here. He is the person who is trying to extract the mines and minerals. Respond, everybody, clear? And I hope you have clearly understood which scope non-applicability. Work in progress arising from service providers, work in progress arising from construction contracts. The next one, investments in stock in trade, which are, investments in securities held as stock in trade. And the last and final one, producer's inventory relating to dash and dash amount, renewable and non-renewable resources, which implies that for intermediaries, is this standard applicable or not? For intermediate parties who are dealing with renewable and non-renewable resources, is AS2 applicable or not applicable? Absolutely applicable. This is not applicable only for producer. Is it clear, everybody? And I hope this is absolutely clear. No need to discuss more with definition. Something like inventories or assets which are held for sale What do you mean by held for sale? Finished goods. Held for sale and finished goods hai kada, which are still in process of production. What are still in process of production? Work in progress. And last and final one, which are consumed in process of production, which are nothing but raw materials, stores and spares, loose tools, etc. And coming to stores and spares, which is very, very important. If it satisfies the definition of inventory, accounting standard number 2 is applicable. If it is not satisfying the definition of inventory, you have to check whether is it satisfying the definition of PPE or not. Then AS10 is applicable. Is it clear? Stores and spares. Check whether is it satisfying the definition of inventory or check the definition of PPE. If inventory definition satisfies, AS2 applies. If PPE definition satisfies, AS10 applies. Respond everybody clear. And moving on to the next thing, which is very, very important, types of inventory that are there. My dear children, tell me what are the types of inventories that are available. Inventory can be either raw material, work in progress, finished goods, stores and spares, loose tools, etc. No concept of speaking about investments because it is specifically non-applicable. Fine. Quickly answer me the rules. Finished goods should be valued at cost or NRV, whichever is lower. Finished goods of, work in progress has to be valued at cost or NRV, whichever is lower. Coming to raw materials, stores and spares and loose tools, they must be valued at dash price, cost price. Everybody, hope you have got clarity. Okay, now moving on to the next things. Individually, let us start discussing. What do you mean by cost price of finished good? First of all, you need to check out whether you are a trader or a manufacturer. If you are a trader, cost price of finished good, trader will purchase the good or manufacture the good. Trader will purchase the good and hence cost price is nothing but purchase price plus direct expenses. And purchase price is nothing but, no, here you can't tell like that. Purchase price is nothing but price which is stated in the invoice. Purchase price is nothing but price which is stated in the invoice. In invoice, what you will be getting? General purchase price you will be getting. Taxes and duties you will be getting, and trade discounts. All the trade discounts have to be deducted, and all the taxes and duties you need to check out whether is it refundable or non-refundable. Refundable has to be deducted if they were included. Non-refundable has to be added if they were not included. And I hope you are absolutely clear in this context. And trade discount has to be deducted. Coming to direct expenses, all the expenses which are relating to purchase of inventory are nothing but direct expenses. In other words, they are nothing but incidental to purchase, directly relating to purchase. Clear? Provided if he is a manufacturer, be careful my dear children, if he is a manufacturer, then the cost price of finished good is nothing but cost of raw materials consumed plus conversion cost. Conversion cost includes dash and dash. Labor and overheads. Labor and overheads. And for your kind information, my dear children, raw material is generally variable or fixed. Variable. Labor, variable. Coming to overheads, they can be either variable or they can be either fixed. Clear everybody? And now moving on to the next thing. All the variable expenses were directly absorbing on actual capacity or normal capacity. Actual capacity. Fixed overheads will be absorbing on actual or normal, whichever is higher. Hope you know the logic behind this provision. Explaining the logic is technically not possible in the marathon series especially, and I hope you have remembered the concept everybody. Quickly answer me my dear children. If at all a finished good is manufactured by somebody, what is the cost price of finished good? What is the cost price of finished good? Cost of raw materials consumed plus conversion cost. Conversion cost include dash and dash. Labor and overhead. Direct labor is generally variable. Raw material is generally, overheads can be either variable or fixed. All the variable cost has to be absorbed on actual capacity. Fixed has to be absorbed on actual or normal, whichever is higher. You're having a clear-cut example on that, so be very, very careful. And my dear children, please concentrate on this example, absorption of fixed overheads. Say for example, the total fixed overheads is equal to rupees 90,000. Actual capacity produced is equal to 30,000 units. And normal capacity is equal to 25,000 units. How much is the fixed overheads absorbed? And so, how much is the fixed overheads absorbed? How much is the total amount of fixed overheads absorbed? Yes, which is absolutely 90,000. Just concentrate, my dear children. Something like you have to absorb the same on actual or normal, whichever is higher, right? What is the actual capacity? What is the normal capacity? Whichever is higher implies. So 90,000 divided by 30,000, which comes to rupees 3 per unit. And absorbed fixed overheads is equal to 3 per unit multiplied by 30,000 units, which comes to 90,000. Clear, everybody? And concentrate carefully once again with another example. Fixed overheads is equal to rupees 1 lakh. Actual capacity is equal to 30,000 units. Normal capacity is equal to something like 40,000 units. So listen to the question carefully. How much is the unabsorbed overheads, if any? Those students who are watching on YouTube, if you know the answer, please do answer in the comment section. And now you people, please tell me the answer. 20. Okay. Any other answer? Fine, let me cross check the same. What is fixed overhead per unit, Amma? 1 lakh divided by whichever is higher, which comes to 40,000. So which comes to 2.5 per unit. So be careful, my dear children. 2.5 into 30,000. 70, which is called as absorbed overheads. Is it clear? And next 2.5 into 10,000, for which production is not yet done, Kadamma, which comes to 25,000, which is called as unabsorbed overheads, which is absolutely correct. Respond, everybody, clear? Fine, my dear children, be careful with this concept, because this is one of the important concepts for you in each and every problem, if I was not wrong. Almost in every problem you will be having one more important examination tip. In some problems, you will not be provided with both actual and normal capacity. In most of the problems, this data will not be there. Only in 1 or 2 problems, both capacity data will be there. Then you need to consider whichever is higher. But in most of the problems, only one capacity will be given. Whatever the capacity given, consider that capacity by a deemed assumption that it is higher. Is it clear? No need to write the assumption, because it is a deemed assumption. Is my point clear? Likewise, he will be telling the company produced 1 lakh units, but he is not going to give you any normal capacity. In that context, outright you can consider actual capacity itself for absorbing the fixed overheads by considering that itself is the higher capacity. Respond, everybody, clear? Fine, my dear children. Now moving on to the next thing. Likewise, coming to the very important thing, cost also includes other costs. Cost also includes other cost. So now let me show you the data where other cost, what will be included and what will not be included. Yeah. Sir, concentrate carefully, everybody. What will be included here? For your kind information, if you concentrate, quality control cost will be included. Research and development cost will be included. Be careful coming to packing costs. Primary packing will be included and secondary packing generally will not be included. Administration overheads relating to production will be included. Depreciation and amortization relating to production shall be included. Storage costs relating to production shall be included. Very, very important, my dear children, borrowing cost or finance cost. As per accounting standard number 16, only when it satisfies the definition of qualifying asset, only then it will be included. Otherwise, it will not be included. And very important, normal loss also shall be included. Since all these costs are called as included, where shall they be included, sir? They shall be included as a part of cost of production. And whatever are excluded, they will be straight away charged to P&L account. Likewise, to tell you, secondary packing. Of course, I have a special point to discuss with this. And administration expenses not relating to production. Finance cost, if at all, as per AS 16, if qualifying asset definition is not satisfied. Depreciation and amortization not relating to production. Storage cost not relating to production. Selling and distribution expenses. Very important, abnormal loss. All these things are excluded and will be charged to P&L account. Shall I start now? Discussing more with packaging expenses and normal and abnormal losses, because these are important for examination point of view. So the first one, number one, packaging expenses. Sir, coming to packing expenses, it will be having a little contradiction between your costing and your advanced accounting. So AS2. So please concentrate carefully. Two types of packing materials will be there: primary packing and secondary packing. Primary packing cost will always be a part of cost of production. Now, as per your costing, total secondary packing will be excluded from the cost of production. Am I correct or wrong? But secondary packing relating to production will be included in the cost of production. Secondary packing relating to selling and distribution will be charged to P&L account. Is it clear? First doubt you will be getting, sir, secondary packing relating to production. Secondary packing antene selling and distribution kada. Then what do you mean by secondary packing relating to production? Concentrate. AS2, as per accounting standard number 2, whatever the expense that you are incurring till the saleability. Take care, not till the point of sale. Till the point of sale, not till the point of sale, till the point of saleability. Every cost has to be included. Let me ask you a question. Everybody will be commonly telling an example of toothpaste. A toothpaste, you can't hold your hand like this to get the toothpaste. Am I correct or wrong? A response. You have to get the toothpaste in some tube. Am I correct or wrong? Whatever the tube is there, that is called as primary packing. My dear children, will you purchase only the tube, or will you purchase along with the outside cardboard box also? So you will be having a cardboard box. Am I correct or wrong? Inside that you will be having something called toothpaste tube. So this is what you are purchasing, and hence even the outside cardboard cost is also relating to production, and hence it will be relating to cost of production. Is my point clear, everybody? Now, very important, like this, manufacturer needs to sell 1,000 toothpaste to the wholesaler. Will he give one toothpaste box or what? He'll be packing the same in big cartons and distribution boxes. Am I correct or wrong? That big cartons and distribution boxes are called as secondary packing relating to selling and distribution, and hence it will be never included in the cost of production. It will be charged to P&L account. I hope you have clearly understood the concept. So even in secondary packing also two parts are there. Secondary packing relating to product and secondary packing relating to sale. Secondary packing relating to product will be included in the cost of production. Secondary packing relating to selling and distribution will be charged to P&L account. I hope you have clearly understood. Now concentrate with this example. Sir, if you learn this format, it is going to become most easy for you to do any kind of questions. Say for example, you have purchased 1 lakh units. Say for example, you have purchased 10,000 units at the rate rupees 10. So the total cost price had become 1 lakh. And then you just need to add all the direct expenses. You just need to add all the direct expenses like cartage, carriage inward, transportation expenses, whatever all the direct expenses, you just need to add all the direct expenses, say which comes to 10,000. So now 10,000 units cost had become 1,10,000. Is it clear, everybody? Now very important, minus normal loss. Say for example, normal loss is at 5%. So 10,000 into 5%, which comes to 500. So 500 units are the normal loss. My dear children, cost of normal loss is 0. Hey, what is the cost of normal loss? Why? Because normal loss has to be included or excluded. Sir, everybody participate. Normal loss, is it to be included or excluded? Normal loss has to be included, which implies that normal loss has to be included, which implies that cost of normal loss is 0. Not clear? Sir, say for example, if cost of normal loss is 1,000 rupees, you have to deduct or you should not deduct? Because it should be included, kada, and hence cost of normal loss is 0. Is the point clear, everybody? So even though normal loss is having some cost, you should not deduct because normal loss has to be included. So conclusion, cost of normal loss is 0. So concentrate here. So 9,500 units are costing 1,10,000. Is the point absolutely clear? Sir, please understand the logic here. Previously 10,000 units are costing 1,10,000, but now 9,500 units are costing 1,10,000. Is it clear? Okay. So now what is previously cost per unit, amma? 1,10,000 divided by 10,000 units. 11. But now what is cost per unit, amma? 11.58, which is absolutely increasing the cost per unit. So normal loss increases the cost per unit and cost of normal loss is equal to 0 because it has to be included. Shall I proceed further? And very, very important thing, my dear children. Now, say for example, there is abnormal loss and abnormal loss of 1,000 units. Is it clear? How much? Just do a cross multiplication. 1,10,000 into 1,000 divided by 9,500 units. 11,000? 5? So whatever, let me take a round figure for our better understanding. 11,500. Is it clear? Inka clear ga aithe 580. That's it. So now 8,500 units are costing 98,420. Is it clear, everybody? But in the question, he will be asking, now he will be telling some units were sold minus sales. Say for example, you have sold 6,000 units. 98,420 into 6,000 divided by 8,500. 69,480 or 470, whatever. And finally you were left with 2,000 units, 2,500 units with a price of 29,40. So now concentrate carefully, which is so simple, and I'm telling you the conclusion. If you learnt this format, cost of normal loss is equal to 0. Respond point number 1 clear, everybody. What is abnormal loss? In this format, it is clearly available. And what is, be careful, cost of sales. 69,480 is the cost of sales, not sale price. He'll be telling in the question, say for example, 6,000 units are sold at a price of rupees 20,000 each. Then profit is so simple, 6,000 into 20. 1,20,000 is the selling price and 69,480 is nothing but cost of sales. So 1,20,000 minus 69,480, whatever is that, that is your profit. Respond, everybody, clear. And finally this 2,500 is left with some cost price. My dear children, now you need to compare this with NRV, which is given in the question, and ultimately you have to evaluate it cost of NRV, whichever is lower. I hope the format is clear. So simple, like how many units you have purchased, and after that you just need to add some direct expenses, and then you will be getting some cost price. Then minus normal loss. Only units you need to deduct and cost of normal loss is 0. And then you will be getting remaining number of units. And then you need to deduct abnormal loss. And then you will be getting again remaining number of units. From these units you have sold. And finally you will be left with closing stock. And amounts obviously cross multiplication. Only one thing, cost of normal loss is equal to 0. Apart from that, everything is like cross multiplication. Respond everybody clear. In this connection, I would like to tell one more important thing. And if you have observed in one of the CRD questions or in one of the institute material questions, there will be a question something like 1100 units is the opening stock where the cost price is 11,000 rupees. And units purchased in the year will be something like 10,000 units where it is nothing but rupees 1 lakh. So fortunately in this problem, if you have observed 11,000 divided by 1100 units, Anna, 1 lakh divided by 10,000 units, Anna, you will be getting 10 rupees same. Is it clear? And hence absolutely the problem is becoming very easy for you. But be careful, in the examination he can twist by changing the opening stock price or purchases price. In such a case, how we have to do, sir? So simple, you have to follow the method, either FIFO or weighted average. Generally, if nothing is mentioned, what is the best method, Amma? Of course, in such a case, he will be clearly telling you the method. According to that method, you have to follow. In such a case, how to value, sir? Chala jagratta. Opening stock cost price plus all other production you will be spending kada. Production cost. Opening stock of raw material and all other production cost you have to add. Then you will be getting something called cost price. This is relating to opening stock. If you are purchasing at some other price, then purchase cost price of raw material and then production cost price per unit, then you will be getting cost price. Again same, you have to value it at dash or dash, whichever is lower. Cost or NRV, whichever is lower. Is this concept clear? To tell you, if at all opening stock is 10,000 for 1,000 units and purchases is 90,000 rupees for 10,000 units. Then what happened now, Ma? Opening stock price is 10 rupees. Purchase price had become 9 rupees. Is it clear? Did you remember something called process costing? In process costing, opening stock price is separate and purchase price is separate. For FIFO method, you have to draft separate tables, and for weighted average method, you have to draft separate tables. Similar concept is applicable. Cost price per unit relating to opening stock. 10 rupees plus production cost. Say for example, labor plus variable overheads plus fixed overheads altogether had come to 12 rupees. Then it's 22. And the next one is like purchases. And purchase cost is 9 rupees plus 12 rupees. In such a case, it had become 21. Is it clear? Since you will be generally following dash method, weighted average method, then you just need to average these things. And then it will become 1 lakh divided by 11,000 units. Is it clear? 1 lakh divided by 11,000 units if you are following weighted average method. And a per unit price had become 9.09. If you are following FIFO method, this is what your cost is. I hope you have enough got clarity. So you need to check out. Before solving these kind of problems, you need to check out dash method. Likewise, first of all, you need to check out whether opening stock and purchase price same or different. If it is same, super happy. If it is not same, then again you need to check out the method. You need to check out whether is it FIFO method or weighted average method, and you need to solve the problem accordingly. Respond is a concept understood, everybody. Fine, my dear children, and now moving on to the next important thing. That is all about valuation of work in progress. My dear children, work in progress has to be valued at cost or NRV, whichever is lower. What is the cost price, Amma? Cost of raw material plus production cost till completion. Did you remember once again your process costing? Please participate. Did you remember your process costing? If nothing is mentioned, material completion will become 100%. Labor and overheads, he will be giving some percentage for sure. Yes or no? If nothing is mentioned, material percentage will become, because you are consuming the entire material first. In the similar way here also, cost price of work in progress is nothing but cost of raw material plus production cost till completion. Anyways, cost price of work in progress is equal to cost of raw materials plus production cost till completion. Clear everybody? So whatever, my dear children, this is what the cost price of work in progress. And now very important, what is the NRV of work in progress? Concentrate on the line on my screen. So something like, say for example, your raw material is somewhere here, your finished good is somewhere here, your work in progress is somewhere here, and you will be able to sell your finished good at a price of 100. You will be able to sell your finished good at a price of 100 after, of course you need to incur a selling expense of rupees 10. And raw material had completed till this point where you have incurred a cost of 40. And still you need to incur till this point where you need to incur an additional cost of rupees 30. And the cost of raw material is rupees 10. Is the whole point clear, everybody? Quickly answer me. What is the cost price of raw material? What is the cost price of raw material? 10. What is the cost price of work in progress? Cost price of work in progress. Cost of raw materials consumed plus conversion cost, which is nothing but 50. Is it clear? So cost price of work in progress is in our hands. Now you need to find NRV. Concentrate once again carefully. Sir, what is the NRV of work in progress? Point number 1. Will you sell work in progress as it is? Participate. Will you sell work in progress as it is? You will convert work in progress into finished good, and then you will be selling the finished good. What is the NRV of finished good? 100 minus 10, which is nothing but 90. Understood? What is the finished good NRV, Amma? 90. That is selling price minus selling expenses, which had become 90. But this is NRV of finished good. You need the NRV of, bring it here, which is nothing but 90 minus 30, which is nothing but 60. NRV of work in progress. And ultimately, whichever is, participate everybody, whichever is, that's it. Understood, everybody? So concentrate. Work in progress valuation, cost or NRV, whichever is lower. What is the cost price, sir? Cost of raw materials consumed plus production cost till completion. NRV is nothing but, be careful, selling price of finished good minus selling expenses of finished good minus further processing cost. Is it clear? Now, very important conceptually, not examination point of view. Work in progress, if you wish to sell it as it is. Here we told you work in progress has to be converted into finished good and you would like to sell. But here you would like to sell work in progress as it is. In such a case, cost price is same, Amma. NRV is equal to selling price of work in progress minus selling expenses of work in progress. If you would like to sell as it is, then sell the work in progress. Selling price of work in progress minus selling expenses of work in progress. Respond, everybody, clear? Now, the next one, very important for examination point of view also, raw material. Sir, you have to value the raw material at dash price. Only if cost price of finished good is recovered. What is the meaning of this, sir? Selling price of finished good is more than cost price of finished good. And in this case, cost price is totally recovered. So absolutely no problem. Raw material will be valued at cost price. Next, very important. If at all cost price of finished good is more than selling price of finished good, is the cost recovered or not recovered? Since the cost price of finished good is absolutely not recovered in this context, you need to value the raw material at replacement cost. You need to value it at replacement cost. Very, very important. Concentrate here. Cost price of finished good is equal to 120. Selling price of finished good is equal to 160. Is it okay? Cost price of finished good is equal to selling price of finished good is equal to. In this context, answer me, raw material has to be valued at dash price amount because cost is totally recovered. Say for example, if the cost is 200 and selling price is 160, you have to value it at dash price. Replacement cost. Is the concept understood? Very important. Cost price of raw material is equal to 60. Replacement of raw material is equal to 80. Sir, point number 1. Is the cost price of finished good recovered in this context or not recovered? Not recovered. So frankly speaking, raw material has to be valued at dash price. But since the replacement cost is greater than the cost price, you need to value the same only at cost price. Is this concept understood? Be careful. This is very, very important. Now, sometimes in your examination question, replacement cost relating to raw material will not be given. In such a case, it is recommended to consider realizable value given with respect to the raw material. Is my point clear? If dash is not there, consider dash. Replacement cost of raw material is not there, then you have to consider realizable value of the raw material. Respond everybody clear. This is one more important concept relating to valuation of stock. Now, we are almost last with AS2, just with two more concepts. Methods of valuing inventory and joint product and byproduct. Shall I start everybody? The next concept is all about dash and dash joint product and byproduct. Coming to the next one, joint product and byproduct. Concentrate everybody. Joint product, sir, byproduct. Say for example, there is a raw material which is commonly produced up to a particular point, which is generally called as a split off point. At split off point, different products will be separated. And if at all every product is having substantial value, then that product is called as joint product. If at split off point any particular product is not having substantial value, then we will be calling it as byproduct. Is it clear everybody? Next, there's a raw material. You're producing a product. Joint product, byproduct, I'm sorry, joint product, main product, whatever is that. In the course of this production, automatically, without your intervention, a product released, which is also nothing but byproduct. Is it clear everybody? Sir, after production, at a particular point, products will split. If every product is having substantial value, we will call it as joint product. If any product is not having substantial value, we will generally call it as byproduct. That is one type of byproduct. Another type, in the course of production process, without your intervention, if at all any product has been emerged, even then we will be calling it as a byproduct. Understood everybody? Likewise, general example, sugar cane, sugar, molasses. Your aim is to produce sugar, but without your intervention, you will be getting some sort of byproduct, which is nothing but molasses. Respond everybody clear. Now the biggest task here is all about what is the cost price of joint product and what is the cost price of byproduct. Concentrate. Cost price of byproduct is 0. What is the cost price of byproduct? What is the cost price of joint product? Cost price of raw material is common plus allocated joint cost. Is it clear? My dear children, what is the cost price of joint product? Cost price of raw material plus allocated joint cost. Cost price of raw material plus allocated joint cost. Very important. From this point to this point, whatever cost you are incurring, that is called as joint cost. This joint cost has to be separated between different products. Now, the biggest point here is all about how to allocate the joint cost. There are many bases, but one of the best bases is selling price of joint products. What is the best basis, I'm sorry, let me make it more clear. Sale value of joint product. Selling price ante you might misinterpret selling price per unit. No, it is sale value of joint product. Sale value is nothing but number of units multiplied by selling price per unit. Is it clear, everybody? Now, very, very important. If you are having byproduct, you told that the cost of byproduct is 0. But what happens with byproduct? We will be generally selling the byproduct. After selling, you will be getting NRV. Am I correct or wrong? And this NRV has to be deducted from the joint products. Respond. Or this NRV has to be deducted from the main product. So concentrate. Cost of main product is equal to cost of production minus NRV of byproduct. Cost of joint product when byproduct is there. If you have remembered one of the problem, there is a problem in your material, something like Bomex. Another problem also, nylon, polyester. Did you remember? Likewise, concentrate cost of joint product when byproduct is there. Cost of joint product when byproduct is there is equal to cost of raw materials consumed plus allocated joint cost minus allocated NRV relating to byproduct. Respond, is it understood for everybody? And my dear children, this is what the concept relating to joint product and byproduct. Examination tip, be careful. Sometimes in your questions, in the main examination, he might be giving you the profit from sale of byproduct. Okay. Cost price of byproduct. He'll be telling such kind of things. But remember, my dear children, this is wrong valuations. Because you should not find the cost price of byproduct. And automatically, there will be no profit from the byproduct. Only point from the byproduct is NRV of the byproduct. Then the biggest point, what is NRV of byproduct, sir? NRV of byproduct is equal to selling price of byproduct minus selling expenses of byproduct, very, very important, minus further processing cost. Is it clear? Minus further processing cost. This is called as NRV of byproduct. Respond, everybody understood? My dear children, this is the end of joint product and byproduct. And moving on to the last and final concept, which is very, very important, methods of valuation of inventory. My dear children, now tell me which method you have to use. Weighted average, FIFO. Inka? Sorry, which methods you should not use? Tell me first. LIFO you should not use. Simple average you should not use. Why these two methods should not be used? Sorry, just answer me. As per accounting standard number 2, which method you have to use? Before weighted average is wrong answer. Any method? Any method which specifies? Yes, that is correct. As per accounting standard number 2, any method? FAC. Yeah, that's absolutely correct. And those students who are watching on YouTube, if you know the answer, please do comment. And my dear children, as per accounting standard number 2, you can use any method which is satisfying the fairest approximation cost. Be careful, my dear children, fairest approximation cost. So what do you mean by fairest approximation cost? Cost which is approximating the fair value. Cost which is almost equal to the fair value. Now, if you concentrate here, FIFO method. Yes, FIFO is permitted as per S2. Reason being, it is satisfying the fairest approximation cost. What do you mean by FIFO? First in, first out. And the goods which you are purchasing first are also selling first. And the closing stock is including dash goods. Latest goods are older goods. Closing stock is including the latest goods at the latest prices. Latest prices is nothing but fair value. Recent prices hai kada. Latest price is nothing but recent price. Recent price is nothing but fair value. And hence FIFO is satisfying the condition. Now come to very important LIFO. What do you mean by LIFO? Last in, first out. And the goods which are purchased the latest were sold first. So closing stock is including dash goods. Closing stock is including dash goods. Older goods at older prices are recent prices now. Does older price represent the fair value now in the market? And hence LIFO is not satisfying the condition, and hence LIFO should not be used. I hope you have got enough clarity. And very important, simple average method itself is a wrong method. Simple average method is a wrong method. Just concentrate. Say for example, there are 6 subjects in CA Inter. Am I correct or wrong? Say for example, you got 60 marks in 3 subjects, 90 marks in 2 subjects, 40 marks in 1 subject. అయితే అయింది కానీ ఊహ చాలా బాగుంది కదా. Okay, what is the percentage? As per simple average method, 60 plus 90 plus 40 by 3. As per weighted average method, 60 marks into 3 subjects plus 90 marks into 2 subjects plus 40 marks into 1 subject divided by 6 subjects. So once again, don't concentrate on the final answer, concentrate on the method. Is this method correct or this method correct? First one or the second one? Obviously, because in first one subjects are not being considered at all. Only marks are considered. Hey, respond. Say, make this as price and make this as units. So if you are considering only price, we will be generally calling it as simple average method. But even under weighted average method, units are considered. So dash method is a failure method. Dash method is the best method. Sir, weighted average. You might ask me, sir, how weighted average method is satisfying fairest approximation cost? Because average kada, it is representing both older price and recent prices, and hence you can happily use weighted average method. Respond clear. And very important, my dear children, there are some other non-historical cost methods. Till now we have discussed historical cost methods where you are using the historical cost at the time of purchase. That is FIFO and weighted average. But there are some non-historical cost methods also. Standard cost method, adjusted selling price method, or retail inventory method, or last and final one, latest purchase price method. Very, very important. You can use non-historical cost methods only when finding cost under absorption costing technique is not possible. Sir, ardhamainda? You can use non-historical cost method only when finding cost is technically not possible. Sir, I am able to find the cost. Then go for either FIFO or weighted average. That is historical cost method. Don't choose any of these 3 methods. But if at all finding cost price under those, finding cost price is technically not possible, then you can use non-historical cost methods. What are these methods, sir? Sir, among these, this is not at all popular. Latest purchase price. What is latest purchase price? Go to the market. Inquire what is the market value. And simply find that as your cost price. So is it clear? My dear children, once again, not selling price, cost price. Go to the market, inquire what is a recent price, and you will be considering that as latest purchase price, which is not a popular method at all. And these 2 methods are very popular methods, wherein you are having a problem even with adjusted selling price and retail inventory method. This method is mostly used by the retailers, and hence it is called as retail inventory method. And retailers are having many goods at many prices. Likewise, if you have taken a stationery shop, or if you have taken a kirana shop, normal kirana shop, likewise you will be having many uppus pappus. You'll be having many groceries. Apart from that, you'll be having some chocolates. Apart from that, you'll be having some packets. Different companies, different prices. But selling price is same. Lace packet 5 rupees, bingo packet 5 rupees, kurkure packet 5. Hey, am I correct or wrong? Sir, even though the retailer is purchasing at different prices, he has to sell at same price. Take the example, stationery shop. Say for example, something like Bitco, your pens. He is being selling each and every pen at 5 rupees. Even though he is purchasing at 4.3, selling price is 5. 4.5, selling price is 5. 4.9, selling price is 5 because this is MRP, boss. Selling price is 4. Cost price is 4. Selling price is 5 again. Is it clear? So selling price of the retailers is uniform and easy to find when compared to the cost price. So retailers will be using this method, and hence it is retail inventory method. And since retailers are having many goods at multiple prices, finding selling price is very easy when compared to the finding cost prices. And hence closing stock will be valued at selling price first. But you need cost price kada. Deduct profit margin, which is nothing but closing stock at cost price. Respond everybody, clear? My dear children, be very careful. Adjusted selling price or retail inventory method. First of all, you are finding closing stock at dash price, selling price, and then you are deducting dash margin, profit margin. So this is nothing but closing stock at cost price, where the selling price is adjusted with profit margin, and hence this is called as adjusted selling price method. Clear? And I hope you know the concept of standard cost. Standard cost is nothing but depending on the average circumstances, depending on the normal circumstances, you have to estimate a price which is nothing but standard cost. But the estimation should be the recent values. It should not be the older values. Only then it is possible to represent the fairest approximation cost. I'll ask you a question. You are in 2025 and finding cost price logically is not possible for that business concern. It includes multiple processes, and hence can this company use standard cost method or not? Answer. Can this company use standard cost method or not? Yes, absolutely. Provided you are in the year 2025, but your standard costs are estimated in 2010. The same costs are being considered. Now tell me, can you use standard cost method? No. Why no? Because is it representing recent prices or older prices? And hence can you use or you cannot use? My dear children, is the concept absolutely clear? And this is the end of your accounting standard number 2. And one more last important point. Whatever the methods we have discussed till now is are called as non-specific identification methods. But if at all specific identification for the inventory is possible, then you have to follow specific identification method. I mean to tell, inventories which are specifically identifiable, ante inventories which are not ordinarily interchangeable. Best example, jewelry. For gold shops, jewelry shops, each and every good there will be a separate price. Each and every jewelry there will be separate price. Even though two items appear same, is the price same? Even in milligrams gold might differ, and hence automatically price will be differ for two items. So if every good is specifically valued, every good is separately identifiable, then you have to follow specific identification method. If every good is not specifically identifiable, or identifying every good separately is not possible, then you have to follow either historical cost methods, and if you are unable to find the cost price technically, you have to follow non-historical cost methods. Respond clear, everybody? And my dear children, this is the end of accounting standard number 2. And I hope this revision is absolutely beneficial for your examination time. We are going to start accounting standard number 12. Without wasting much time, let us start the next topic, that is like accounting standard number 12. And my dear children, what is accounting standard number 12? Accounting for government. one of the most easy standards, like too simple, nothing difficult at all, but there will be some logical provisions, one or two, where you need to understand more. Apart from that, standard is so simple. And this is an exhaustive standard which is dealing with the concepts of recognition, measurement, presentation, and disclosure with respect to the government grants. And also there are some methods and approaches, if you have remembered: capital approach, revenue approach, and methods like deferred government grant method, asset reduction method. So like the different methods and approaches are there in accounting standard number 12, and even everything is discussed as per AS 12 itself. And now, as usual, once again coming to scope, non-applicability. Of course, AS 2 scope is very important, but AS 12 scope is not comparatively that much important. But since I have to cover, just I am covering. If any special problems in government grants is there, AS 12 will not take care. AS 12, frankly speaking, deals with receipts and refunds of grants itself. Special problems like inflationary conditions, deflationary conditions, all those things will not be dealt at all. And government participation in ownership stake. Ma, what do you mean by government participation in ownership stake? Government is having shareholding in one company. It may be a government company or not. Something like, if you have remembered all the PSUs, public sector undertakings, like Vizag Steel Plant, BHPV, IOCL, all these things are like wherein the government is having 51% shareholding. Sir, not only 51% needed. If government is participating in, if government is investing in any company, then that is not called as a grant. Government is acting as a normal investor in this context, and hence AS 12 is not applicable. Concentrate carefully, everybody. Grant must be receipt, either in cash or in kind. If it is a grant, there should be a receipt. Must and should, there should be a receipt, either in cash or in kind. Let me tell you, say for example, government is giving you some advice. Government is assisting you by giving some advice. Like, don't sell at that place, the supply is more and hence you will not get the price there. So go to some other place and sell. Government had given a kind of advice for you. Is it clear? Is government assisted you or not? Government assisted you or not? Is it called as a grant? So this is something called government assistance other than grant. Government assistance other than grant, for which accounting standard number 12 is not applicable. Let me give you one more example also. Concentrate carefully. Say for example, your company would like to purchase a machine. Or, I'm sorry, your company has to pay electricity charges. Your company has to pay electricity charges. And electricity charges are something like rupees 10 per unit of consumption of electricity. How much are electricity charges? 10 per unit in order to consume the, in order to pay the electricity department. Now, one more very important thing is all about government had announced a grant to the company, like no need to pay 6 rupees, pay only 4 rupees per unit as electricity charges. Is my point clear? How much is normal electricity charge per unit? But how much assistance is given? And how much you are supposed to pay? Can this be called as government grant or not? Yes or no? No, because there is no receipt of cash or no receipt of kind. It is something like subsidized price. Ante. What is this, my dear children? Subsidized price. And hence accounting standard number 12 is not applicable. Concentrate carefully. Now this time company would like to purchase a machine, where the machine market price is 1 lakh. And it had given a subsidy of 60,000, and you can purchase a machine at 40,000 only. Now answer me, can this be called as a grant or not? Can this be called as a grant or not? This is called as a grant, because you are getting machine for that 40,000. Grant which is received in kind. Is my point clear, everybody? These are the traps where examiner will be generally using. Identify and give the accounting treatment in the following situations అంటాడు. First bit, he'll give about electricity charges. Second bit, he'll give about machinery. First bit, you will be trying to write that it is not a grant at all. Even for the second bit, you will be writing the same. This is what the examiner generally uses, especially in compulsory questions. In all the remaining questions, things will be comparatively normal. But compulsory questions, 14 marks will be there, right? That is always a kind of surprising element only. Anyways, let's come back. So finally, in this context, can this be called as a grant or not? Answer, in this context, can this be called as a grant or not? Absolutely yes. Why? Machine is nothing but kind. But here electricity charges is not either cash or not either kind, and hence AS12 is not applicable in this context. But in this context, AS12 is absolutely applicable. Respond everybody. Pakka. Fine. And moving on to the next thing. Government grant definition, which is so simple. Grant is something which is received from the government either in cash or kind. Now exclusions are there. Subject wise it is important. Point number 1, if government grant cannot be measured reliably. I've given you an example, something like government advice or technical assistance. Can this be measured reliably or not? Can this be measured reliably or not? And hence this is specifically excluded from the definition, because you are not receiving anything either in cash or kind, and hence it is not satisfying the definition and specifically excluded. Now concentrate. Say for example, government is purchasing some units from you. Say for example, you or Mr. A doing a business produced 1 lakh units. Produced 1 lakh units. And for your kind information, government kept something called MSP. What is minimum selling price? Minimum support price. What is minimum support price? Guarantee you will be getting that price. Am I correct or wrong? Concentrate. Totally 1 lakh units are there, wherein government had kept an MSP of 10 rupees. So now Mr. A can sell his product at any price more than 10. If at all in any worst situations where Mr. A is not getting the price for the product, then government will help you to purchase all the units at a price of rupees 10. Hey, am I correct or wrong? Now answer me. Can this be called as a grant or not? Can this be called as grant or not? Absolutely no. Here government is purchasing like a customer, and hence in this context it shall not be called as grant. Shall I continue? Sir, concentrate carefully. Now the next concept, recognition criteria. So definition clear kada? Must and should dash should be there in government grant. Receipt of either cash or kind. Other than this, it is not called as a government grant. Now very important, recognition criteria. Sir, as per AS2, what is recognition criteria? It should satisfy the definition of asset. It should satisfy the definition of inventory. As per AS10, what is the recognition criteria? It should satisfy the definition of asset. It should satisfy the definition of PPE. Sir, what is the recognition criteria as per AS26, sir? It should satisfy the definition of asset. It should satisfy the definition of intangible asset. Like this, for almost asset related standards, these are the recognition criteria. But for AS12, recognition criteria is totally different. If you would like to recognize government grant in your books of accounts, then you are supposed to satisfy with 2 conditions. Number 1, fulfillment of conditions. Number 2, certainty in receipt. Clear everybody? Receipt from the government should be certain, and there should be fulfillment of conditions. Once again everybody, what are the 2 conditions, my dear children? Certainty in receipt. My dear children, think with common sense and answer me. Do government gives you the grant without any conditions or with conditions? So always generally government grant will be having some conditions. You have to fulfill that conditions for sure. Only then you will be eligible to receive the grant. Shall I continue? concentrate carefully and answer the journal entries in these situations. You have already got the receipt. Business already had got the receipt, but it would not like to fulfill the conditions. What is a journal entry? Point number 1. Will you recognize government grant or not? No, you should not. But already you have received cash kada. Then how you are supposed to record the entry? No. Yes. Cash or bank account debtor to GG payable account. Is it clear? Sir, normally if you would like to record government grant, what is the entry you will write? Please participate. What is the entry for government grant? Cash or bank account debtor to government grant account. Am I correct or wrong? But in this context, what happened? Receipt is there, but you are not willing to fulfill the conditions at all. And hence the entry will become cash or bank account debtor to GG payable account. Clear everybody? Now concentrate. Yes, receipt is there. You would like to fulfill the conditions also. What is the entry? Cash or bank account debtor to government grant account. Clear everybody? Now concentrate. Government is telling first fulfill the conditions. Then I will give you the grant. Is it clear? Now concentrate. We are thinking to fulfill the conditions. Is it clear? And also receipt will be certain. What is the entry? Receipt will be certain, not yet received, receivable in future. Yes, GG receivable account debtor to GG account. Is it clear everybody? Now another condition. Government is telling Babu fulfill the conditions. But you are expecting, no, I don't fulfill the conditions. If you fulfill the conditions, government will give you the amount in future. Yes, government will give me if I fulfill the conditions. But I don't fulfill the conditions. What is the entry? No entry. Because if you are not fulfilling, why do the government gives you? Is my point clear everybody? Sir, conclusion, if you observe, only when these two conditions are satisfied, you will be recognizing something called government grant. Is it clear? If at all any of the things were not satisfied, it might become either payable or no need to write the entry at all. Clear? If you received the cash, you have to debit cash. If you have to receive in future, GG receivable. Is the recognition criteria clear everybody? Pakka. So you need to recognize the government grant only when two conditions are satisfied. Number 1, fulfillment of conditions, certainty in receipt. Absolutely. Now moving on to the next thing. Very, very simple. Simultaneously, I am going to complete the both concepts, receipts and refunds of government grant. When receipt and refund of government grant, my dear children, first of all, you need to check out how did you receive the grant. Likewise, did you receive the grant either for cash or kind? Cash here is nothing but monetary, kind here is nothing but non-monetary. Check out the type of the grant, whether is it a monetary grant or non-monetary grant. Monetary is nothing but cash, non-monetary is nothing but kind. Now, yes, you are receiving cash. Why are you receiving cash? Check out whether is it relating to establishment of business or you are receiving the same in the due course of business in order to fulfill some conditions. You have to check that. Whether are you receiving the cash from the government for establishment of your business or is it in the due course of running your business in order to fulfill the conditions? Sir, if we are receiving the cash for establishment of business, this is called as capital approach. And if you are receiving the same for due course of business in order to fulfill the conditions, we will generally call it as income approach. Clear everybody? Now the next one. Coming to capital approach. What is the journal entry, sir? Yes, tell me the journal entry, Amma. Cash or bank account debtor to government grant account, GG account debtor to capital reserve account. And in your main examination, you can write a final set of journal entry. Cash or bank account debtor to capital reserve account. Respond everybody clear. Sir, be careful. You need to check out whether the grant is received either for monetary, non-monetary. Monetary is nothing but cash. Non-monetary is nothing but kind. Check out how did you receive that cash. Why did you receive that cash? Whether did you receive it for establishment of your business or due course of business. If it is like establishment of business, capital approach. If it is for due course of business, income approach, or it is also called as a revenue approach. What is the journal entry for capital approach, my dear children? Cash or bank account debtor to GG account, GG account debtor to capital reserve account. Shall I continue? Now coming to the next one, income approach. Check out first of all whether the grant is for less than or equal to 1 year or more than 1 year. If it is for less than or equal to 1 year, so simple. Cash or bank account debtor to GG account, GG account debtor to P&L account. What is the entry? Cash or bank account debtor to GG account, GG account debtor to. If it is for more than 1 year, be careful. Cash or bank account debtor to DGG account, which is nothing but deferred government grant. And every year DGG has to be written off to P&L account in proportionate to expenses spent. In such a case, the journal entry will become DGG account debtor to P&L account. Is it clear, everybody? What is the journal entry if it is for more than 1 year? Cash or bank account debtor to DGG account, DGG account debtor to P&L account. But every year you have to write off DGG in proportionate to the expenses spent. Next important thing. Sir, if it is capital approach, GG is straight away closed and transferred to CR account, which will be shown under the head reserves and surplus. If it is income approach, GG is transferred to P&L account, which can be either set off with the respective expenses or it can be also shown under other income. Did you remember NPO in your foundation? Sports fund can be set off with sports expenses, or sports fund can be shown under income, sports expenses can be shown under expenditure. In the same way here also. Say for example, government had given 10,000 rupees to you in order to provide COVID vaccine to your employees. You have actually spent 12,000 rupees. Is it clear? So options, be careful. Government grant received 10,000. Under other income head, you can show 10,000. Under employee benefit expenses, you can show something like 12,000 since you are providing COVID vaccines to the employees. Respond clear. Or on the other hand, you can set off with this 10,000 and you can show net employee benefits only 2,000. Respond understood. Or say for example, your employee benefit expenses are only 9,000. Now you can set off this 9,000 with 10,000 and you can show other income as only 1,000. I hope you have got enough clarity. The same logic will also apply for DGG. But one more special point in DGG is all about, if DGG received is 1 lakh, you will amortize only part of DGG to P&L account. But still there will be some other part which is left out, which will be shown in balance sheet. And it can be shown two options, either under the head reserves and surplus, or it can be shown as a separate line item which is similar to minority interest. Hey, did you remember? Minority interest is shown after reserves and surplus before non-current liabilities. Like that, even DGG also can be shown after reserves and surplus before non-current liabilities. Ledu ante DGG can be outright shown under reserves and surplus head. Respond everybody clear. And my dear children, this is the receipt of grant with respect to the cash, monetary items. Shall I start with refund everybody? Sir, government is giving you grant in order to fulfill some. So government can refund the grant if your not fulfilling the conditions, and hence the concept here is all about relating to establishment of business it had given you, but you have manipulated the government by showing more expenses. Government had come to identify and hence it had refunded the grant. What is the entry? Capital reserve account debtor to cash or bank account. Exactly opposites. Is it clear? So once again everybody, for capital approach what is the entry? Cash or bank account debtor to GG account. For refund what is the entry, my dear children? Capital reserve account debtor to cash or bank account. Clear everybody? Now if at all you are receiving for due course of business, what is the entry? Cash or bank account debtor to GG or DGG account. GG or DGG account debtor to P&L account. Am I correct or wrong? At the time of refund, what is the entry? Concentrate everybody. Sir, you have received the grant. Yes. You did not write it off the P&L account. Okay. Government asked you to refund the grant again. What is the entry? GG account debtor to cash or bank. Is it clear? Or cash or bank to GG and entire GG is immediately transferred to P&L. At this time government is asking you to refund the grant. What is the entry? Clear everybody? Now concentrate. You have totally received an amount of 1 lakh towards DGG and DGG to P&L in year 1 return of 20,000, in year 2 return of 20,000, in year 3 return of 20,000. Is it clear? Now government is asking you to refund a grant of 40,000. What is the entry? Sir, how much DGG received? How much is written off? Balance how much is there? Government is asking to give that balance of 40. So what is the entry? DGG to cash or bank 40. Clear everybody? If the refund amounts to 60,000, if the refund amounts to 50,000, what is the entry? DGG 40. But you have to pay a total amount of 50. And another 10,000 will be debited to. Sir, if government is asking you to give entire 1 lakh, what is the entry? DGG account debtor 40, P&L account debtor 60, to cash or bank account 1 lakh. I hope you have got enough clarity. And my dear children, all the monetary grant is absolutely completed. Now let me start with non-monetary. Coming to non-monetary, you need to check out whether is it received at free of cost or is it received at a concessional price. Gurtunda, you have made a blunder here. Company received the machinery at a subsidized price. You told A12 is not applicable. Applicable or not applicable? Applicable. Indak tap cheppar kada. Well, telling electricity charges and machinery. Anyways, let me start. Sir, if at all you have received a government grant at free of cost, it has to be recorded at nominal value. Any nominal value, 1 rupee, 10 rupees, 100 rupees, any nominal value is permitted. Anyways, what is the entry for that? Yes, you are getting asset and you are getting grant. Asset account debtor to GG account, GG account debtor to P&L account. With any nominal value you can write. Is it clear? In this context, you might get a different question in the examination. Take care. There is a company which is dealing, whose turnover is 200 crores. There is a company whose turnover is 200 crores. And that company actually received 50 lakhs worth of asset from the government at free of cost. Is it clear? And government is, the company is receiving 50 crores value of the asset at free of cost. And the company would like to show the same asset at 50 lakhs. Is the question clear, everybody? Company's turnover 200 crores. Asset at free of cost. Fair value 50 crores. and company recorded at rupees 50 lakhs. I'm telling that it is nominal value. Is it correct or wrong? Correct or wrong? This is correct. Then sir, 50 lakhs nominal value. Yes. For this company. Sir, this is what the merging of questions what generally will be done by the institute. So be careful in this context. Amma, you may not get as it is the similar kind of questions, but I'm letting you know how to think. That thinking ability is very important in the examination. Reason being, this is obviously nominal. Enduku ante, as per schedule 3, for a company, what is the material amount? 1 lakh or 1% of turnover, whichever is higher is considered as material amount. Is it clear? As per schedule 3, for a company, 1 lakh or 1% of the turnover, whichever is higher is considered as a material amount. Understood? And for your kind information, 1 lakh or 1% of turnover into 2 crores, whichever is higher, and up to 2 crores it's a material amount. So the company can comfortably record the asset at 50 lakh, which is nominal value. Respond everybody clear. And my dear children, this is what something like asset received at free of cost. Now, asset received at concessional price. Be careful. Jagrata. If at all you are receiving any asset at concessional price in the sense 1 lakh asset, be careful. You have got at rupees 60,000. Rupees 1 lakh value of the asset, you have got at rupees 60,000. Is it clear? So now what is the journal entry? You are purchasing the asset, am I correct or wrong? So fixed asset account debtor to cash or bank account, which comes to an amount of 60,000. Understood? And you need to provide the depreciation on 60,000 only. Understood? This is a very, very special case where grant will not be identified at all. Grant will not be identified. If it is relating to establishment of business, cash or bank account debtor to GG account debtor to CR account, and that capital reserve is relating to establishment of business. It's a grant. Next one, if you are receiving grant in the due course of business aite, then you are recording an entry like cash or bank account debtor to GG account or DGG account, and GG or DGG account debtor to P&L account. Grant is identified. Is it clear? Now this one, if at all you are receiving something at free of cost, simply you are writing asset account debtor to GG account debtor to P&L account. Grant is identified. But this is a special case where the grant is not identifiable. Be careful. Grant is not apparent here, but there is a grant received here. Understood? Grant is not. Sir, once again, grant is identifiable in the form of asset, but apparently grant account will not be shown here at all. If any asset is received at a concessional price, then you need to record a dash price amount. Concessional price, and you have to provide the depreciation even at dash price amount. Concessional price. Respond everybody clear. And now be careful. Government is asking to refund these assets. Jagrata, very important. Received an asset at free of cost. Government is asking to refund this asset. Possible or not possible? Participate. Yes. So what is the journal entry you are writing at the time of receipt? Cash or bank account debtor to GG account debtor to P&L account. At the time of refund, what is the entry you will be writing? P&L account debtor to, provided if it is cash. But here is it cash or asset? And hence it should be replaced with. So what is the journal entry ultimately? P&L account debtor to asset account. Respond everybody clear. Sir, now this is a very peculiar case. Asset price is 1 lakh, but government is offering it 60,000. Already business concern had recorded the asset account debtor to cash or bank account by paying an amount of 60,000. Is my point clear? Now government is asking to refund the asset. Government is asking to refund the asset. Practically possible or not possible? Practically possible or not possible? Sir, government can do anything. But in this context, if government is asking to refund the asset, then business concern will ask, I paid you 60,000, sir. Hey, is my point clear? Government had given you an asset at subsidized price. 1 lakh value of the asset given at 60,000. And you have purchased at 60,000 and you are using for some other purposes. You have violated the condition. Government identified. And government is asking you to give back the asset. What the business concern will tell? Sir, I have already paid 60,000 to you. How can I refund the asset for you? Is it clear? And hence in this context, government will withdraw subsidized price. And how much subsidy initially given? Now government will ask you to pay back that 40,000. Is it clear? So what is a journal entry? Asset account debtor to cash or bank account 40,000 in future when the refund of grant had happened. Here refund of grant doesn't mean you have to give back the asset. You have to pay the subsidized price. Respond, is the context absolutely clear for everybody? All the things are over. Now one special case is waiting for you, which is very important for examination point of view. And hence I kept it aside. Now be careful. For examination point of view, this is very, very important. You are receiving cash. You are receiving cash. Monetary grant. I told you we need to check out whether is it relating to establishment of business or whether is it relating to due course of business. Am I correct or wrong? This is dash approach, amma? Capital approach. This is dash approach, amma? Revenue approach or income approach. Am I correct or wrong? Now you are receiving the cash exclusively for an asset. You are receiving cash exclusively for an asset. Shall I start telling the accounting treatment in this context? Which is very, very important. Write your CRD number 1, 4, 5. Everything is depending on this case only. So be very, very careful. Even in the institute examination question papers, elaborately questions were discussed from this concept. Now, you are purchasing an asset of 1 lakh. You are purchasing an asset of 1 lakh. And government had given you 40,000 rupees. Government had given you 40,000 rupees cash. What is the entry? First, at the time of purchase of asset, what is the entry? Fixed asset account debtor to cash or bank account 1 lakh. And then government had given you a grant of rupees 40,000. What is the entry? Cash or bank account debtor to government grant account 40,000. And then government grant account debtor, it had given for the purpose of fixed asset kadamma to fixed asset account, which comes to 40,000. Respond everybody, clear? My dear children, this is nothing but asset reduction method. And what happened? Asset is initially shown at, and now asset is reduced at asset reduction method. And balance of amount, how much is there? So you have to start providing the depreciation only on the 60,000. Pakka. Fine. Now there is one more method called DGG method or deferred income method or asset liability method, wherein the entry will become cash or bank account debtor to DGG account, DGG account debtor to P&L account, where you have to write off DGG every year in proportion to expenses spent. Here the expense is nothing but depreciation. Respond everybody, clear? Now if you are receiving cash, you need to check out whether is it received for establishment of business, due course of business or asset. And then you need to conclude. Clear everybody? If it is received for asset, again you need to check out the method. Whether is it asset reduction method or deferred income method or DGG method. Is it clear? Now very important. If any refund had happened, what is the entry? Cash or bank to GG, GG to fixed asset. Now refund happened, what is the entry? Fixed asset account debtor to cash or bank account. Clear? Amma, if at all in this method, if at all the refund had happened, DGG account debtor to DGG account debtor to cash or bank account. Very important, debit DGG only to the extent of balance. If the balance is not there, it will be debited to P&L. Cheppandi clear? My dear children, this is the end of your receipt and refund of grants. And one special case, concentrate. One special case, everybody concentrate. You are purchasing an asset at a price of 1 lakh. Is it clear? And you have actually got a grant of rupees 1 lakh. You've got a grant of 1 lakh. Sir, chala jagratta. If you are following DGG method, what is the entry for purchase of asset, amma? Fixed asset account debtor to cash or bank account 1 lakh. This is common. Now DGG method, what is the entry, amma? Cash or bank account debtor to DGG account 1 lakh. And every year DGG will be transferred to P&L account. Is there any problem in this context? But if at all business concern had chosen asset reduction method, tell me what happens. Fixed asset account debtor to cash or bank 1 lakh. Next you have got grant. What is the entry you have to write? Cash or bank account debtor to GG account, GG account debtor to fixed asset account 1 lakh. What happened? Ultimately asset value had become 0. Is it clear? In this case, very, very important, even in this case also fixed asset has to be shown at nominal value. Is the additional point clear, everybody? And if at all asset price or asset value had become 0 or negative due to the grant, then it has to be shown at dash value, nominal value. Concept understood for everybody? So just concentrate on the scheme. Concluding accounting standard number 12. Grant must and should, there should be receipt either in cash or in kind. Cash is nothing but monetary grant. Kind is nothing but non-monetary grant. If you have received the cash, then you need to check out whether is it received for establishment of business, due course of business with fulfillment of some conditions, or is it relating to asset. If it is relating to asset, again two methods will be there. Number one is asset reduction method. Number two is DGG method. This is dash approach, capital approach. This is dash approach, income approach or revenue approach. And if you have received anything for kind, you need to check out whether is it received at free of cost or concessional price. Quickly answer me. Receipt of grant, establishment of business, journal entry. Cash or bank account debtor to GG account, GG account debtor to reverse. What is the entry? Capital reserve account debtor to perfect. If it is due course of business, what is the entry? If 1 year, what is the entry? Cash or bank account debtor to GG account, GG account debtor to refund. What is the entry? P&L account debtor to, if GG balance is there, what is the entry? GG account debtor to, GG account debtor to cash or bank account. Clear, everybody? If more than 1 year, what is the entry? Cash or bank account debtor to DGG account, DGG account debtor to P&L account. Every year you have to amortize DGG in proportion to the expenses spent. Refund. What is the entry? DGG account debtor with balance, P&L account debtor balancing figure to cash or bank account. Perfect. Now coming to the next one. If it is relating to asset, if it is relating to asset reduction method, grant received, what is the entry? Cash or bank account debtor to GG account, GG account debtor to fixed asset account. And if refund, what is the entry? Fixed asset account debtor to cash or bank. DGG method, what is the entry, sum? Cash or bank account debtor to DGG account, DGG account debtor to, every year you have to write off in proportion to the expenses spent, but here expenses are depreciation. Clear everybody? Refund aithe what is the entry? DGG account debtor with balance, P&L account debtor balancing figure to cash or bank account. And if it is received in kind free of cost, what is the entry? Cash or bank account debtor to GG, antena? Asset. What is the entry? Asset account debtor to GG account debtor to P&L at nominal value. And if it is received at a concessional price, what is the entry? Asset account debtor to cash or bank account. Clear everybody? That's it, my dear children. And in the case of refund, here you can't give the asset back. You have to pay only the subsidized price. Hope you have remembered. And my dear children, that is the end of accounting standard number 12. And I hope even this is also very beneficial for your exam. Let us continue with the longest standard and the largest standard in CA Inter, and one of the largest standards in accounting standards, which is accounting standard number 10. My dear children, what is accounting standard number 10? Amma? PPE, which is nothing but property, plant and equipment. Generally, property is nothing but land and building. Plant is nothing but a factory or a big process or what is it called, industry. And finally, equipment is nothing but plant and machinery used in that factory. That is why this is called as property, plant and equipment. And now, this is also an exhaustive standard. Previously, there used to be two standards for PPE and depreciation separately, but now even depreciation is also dealt in this standard itself. And now moving on to the next part, which is very important, that is all about scope. As usual, in every standard in scope, we will be seeing non-applicability. Here also we will be seeing non-applicability, wherein the first part is so simple. If there is any specific accounting standard, then this standard is not applicable. If there is any specific accounting standard, then AS 10 is not applicable for PPE. And example is nothing but leases. For accounting standard number 19, there is a separate standard for leases where AS 19 is taking care. So even assets which were given under lease, also AS 19 is applicable, but not AS 10. But take care, my dear children, for depreciation, AS 10 continues to apply. For depreciation, AS 10 continues to apply. But for recognition, measurement, presentation, disclosure, with respect to PPE, AS 10 not applicable. Dash is applicable. AS 19 is applicable. So it is highly recommended for everybody to participate. Otherwise, you will sleep. Yes. Moving on to the next thing, Amma. For renewable and non-renewable resources also, accounting standard number 10 is not applicable. I mean to tell something like for renewable resources, already you know, agriculture products, forest products, sericulture, pisciculture, etc. And you told something about horticulture while telling AS2. Did you remember? Fine. So concentrate carefully. For renewable resources, accounting standard number 10 is not applicable. One of the renewable resources is nothing but biological assets. What do you mean by biological assets, Amma? Living animals or living plants. Biological assets are nothing but living animals or living plants. Now, coming to living plants, divided into two parts, bearer plants and other than bearer plants. For bearer plants, accounting standard number 10 is applicable. For other than bearer plants, accounting standard number 10 is not applicable. Take care, for bearer plants, accounting standard number 10 is applicable. For other than bearer plants, AS 10 is not applicable. Even for the living animals also, accounting standard number 10 is not applicable. Is the first point clear, everybody? Now, be careful. For these parts, there is a separate accounting standards. New accounting standard is under development. So for these parts, new accounting standard is applicable once if it is issued. But till the issue of new accounting standards, those living animals and those living plants which are other than bearer plants, if they satisfy PPE definition, then accounting standard number 10 is applicable. Is the extension clear, everybody? So tell me, everybody, quickly. Biological asset meaning? Living animal, living plant. Living plants are divided into bearer plant, other than bearer plant. For other than bearer plant, AS10 is not applicable. For bearer plants, AS10 is applicable. For living animals, AS10 is not applicable. Now for living animals and other than bearer plants, a new accounting standard is under development. So after the standard is issued, that standard has to be followed. But what till the issue of new accounting standard, Amma? You need to check out the satisfaction of definition. If PPA definition is satisfied, AS10 is applicable. If PPA definition is not satisfied, AS10 is not applicable. Is it clear, everybody? In this context, let me give you a clarity with respect to living animals. Because there are various classes wherein different faculty were taught, and wherein this question might have taught very differently by different faculty, and let me conclude a single answer for that, and hope you have remembered the question. There is a cattle, to tell what is it called, ox, not cattle, clearly to tell you. There's a question in your material. There's an ox which was purchased by a business concern. Bulls and ischad kada. There are bulls or ox, whatever, purchased by some business concern in order to carry the construction material for constructions on hilly areas. And say, for example, they were purchased for 90,000. And business concern are treating these as PPE, and they would like to depreciate the same for 3 years. The life of the cattle, the life of the bulls is expected to be 3 years. And is it possible or not possible? Point number 1. For living animals, outright accounting standard number 10 is not applicable. New accounting standard is applicable. But now what is the situation, Amma? Till new accounting standard is released, you need to check the definition of, if PPA definition is satisfied, then AS10 is now. For living animals in this context like bulls, is PPA definition being satisfied or not? But to know that, first of all, you must know what is PPE. Tell me what is PPE, Amma? PPE are nothing but tangible asset whose life period will be more than or equal to 12 months. And the PPE should be used either for production of goods, rendering of services, administration purpose, and rental purpose. Am I correct or wrong? In administration purpose, and many things will come, like selling and distribution, finance and accounting, staffing and personnel, NNEL personnel, and staff, employees ani ardham. Is it clear? Everything will be included in administration purpose. Now, answer me, the bulls which were purchased by the business concern, is it tangible asset or not? Quickly answer me, tangible or not? Life more than 12 months or not? The company is a construction company, and hence the bulls were used to carry on the construction material to the site place. So it is obviously used for some business and administration purpose. Am I correct or wrong? Frankly speaking, in this context, living animal had satisfied the definition of PPE, and hence accounting standard number 10 is absolutely applicable. Is the point clear? But now the real part is all about, is the depreciation needed or not needed? Now listen, if it is a company, then as per Companies Act 2013, there is a separate schedule for depreciation, which is Schedule 2. As per Schedule 2 of Companies Act 2013, Section 123 of Companies Act 2013, living animals are those animals which are not to be depreciated. As per Companies Act 2013, Schedule 2. But if it is other than company, then Companies Act is not applicable, and hence if they would like to follow, they can follow and they can comfortably depreciate the cattle, or they can comfortably depreciate the bulls. Is the point clear, everybody? What about the depreciation on livestock, depreciation on bulls, depreciation on ox? If it is company, as per schedule 2, must and should, you should not depreciate. But if it is other than company, it depends on their policy. If they want, they can comfortably depreciate. Cheppandi clear? Then my dear children, this is all about the clarification giving with respect to that bulls question. Shall I proceed further? Fine. Now, one more important thing. Likewise, we have discussed about renewable resources. I mean to tell biological assets, living animals, living plants, bearer plants, other than bearer plants, etc. Now, coming to something called non-renewable resources. My dear children, for extraction of mines, minerals, oils, gases, etc. AS10 is applicable or not applicable? Cheppali, not applicable. AS10 is not applicable. Is it clear? Now concentrate carefully. There is a crop wherein the farmer is cropping. I mean, wherein the farmer is cultivating the crop. Is AS10 applicable for that crop or not? Answer yes or no? No. But farmer is using a tractor to cultivate the crop. For tractor, is AS10 applicable or not? Absolutely. Say for example, Mr. A is in mining business, extracting mines and minerals, for which accounting standard number 10 is. But Mr. A is using some drilling machine for the purpose of this mines. Answer, for this drilling machine, is AS10 applicable or not? Yes, AS10 is applicable in this context. Respond everybody, clear? And my dear children, scope is absolutely completed, and already I have discussed the recognition criteria, if you have remembered. What is recognition criteria? It should satisfy the definition of asset. It should satisfy the definition of PPE. And hope you have remembered the definition of PPE. PPE or dash item summa? Whose life is more than 12 months. Production of goods, rendering of services, administration purpose, rentals. Administration also includes selling and distribution, finance and accounting, personnel, that is HR, human resources, safety, environment purpose, etc. Fire extinguishers are for safety purposes. Yes, they will be included in PPE. For environmental purpose, you might install some machines, smoke filters. Yes, they will be included in PPE. For human resource purposes, HR and finance and accounting purposes, you are purchasing a computer. Yes, AS10 is applicable. For selling and distribution, you have purchased some vehicles. AS10 is applicable. Respond everybody, clear? Very, very important clarification. All the assets are at one side. Land and buildings is at another side. Coming to land and building, you need to check out whether the land and building is used for investment purpose other than investment purpose. Investment purpose ante, yes, accounting standard number 13 is applicable. Other than investment purpose ante, I mean to tell like administration purpose, selling and distribution purpose. Hey, clear everybody? Other than investment, if you would like to use it for your own purpose, if you would like to use it for your business purpose, then accounting standard number 10 is applicable. Up to this, clear everybody? Additional clarification, for land and buildings which are for investment purpose, obviously AS13 is applicable, but also AS10 is applicable, and it is limited only up to cost model. Revaluation model is not applicable. Dash is not applicable. Revaluation model, dash is applicable. Cost model is absolutely applicable. Clear everybody? Fine. And moving on to the next thing, the definition of bearer plant. We told something like for bearer plant AS10 is participate, for bearer plant AS10 is. But what do you mean by bearer plant? Three conditions should satisfy, Amma. Number one, the lifespan should be more than or equal to 12 months, and the bearer plant should supply some agricultural produce. Plant itself should not be the produce. From plant you should get the produce. Plant itself should not be the produce. Take tree. Where tree itself is the produce. Respond. And hence, is it a bearer plant or not? No, it's not a bearer plant. Is it clear? Crops, paddy, Bengal gram, or all the remaining things, whatever are there, all the crops are generally for less than 12 months, and hence accounting standard number 10 is not applicable. But take care, if it is sugar cane, AS 10 is applicable, because for sugar cane you will cut the you will cut the stem and cane will grow again, and hence AS 10 is applicable for sugar cane. And all the general mango tree, coconut tree, orange trees, etc., AS 10 is absolutely applicable. Be careful. If at all there is a tree which is used for both fruits and lumber, or it is also called as timber. If there is a tree which is used for both the purposes, likewise examples given, cherry tree. It is used for cultivating the fruits, selling the fruits, enjoying the amount, and also it is cultivated for the bark of the cherry tree. In such a case, it is not satisfying the definition of bearer plant, and hence AS 10 is outright not applicable. Respond everybody, clear? That's it with bearer plant, my dear children. And moving on to the next one, be very, very, very careful. The concept we are going to start is all about recognition and measurement. There are two types of recognitions and measurements. Initial recognition and measurement okati, subsequent recognition and measurement okati. Dash is done at the time of purchase. Initial. Dash is done after the purchase. Dash is done at the end of the year. Subsequent. Dash is done as at the balance sheet date. Subsequent. Initial recognition depends on modes of acquisition. Initial depends on. Subsequent depends on models. What are the two models you are having as per AS 10? Cost model okati, revaluation model okati. As per accounting standard number 10, initial recognition and measurement. What are the modes of acquisition? Number 1, cash or credit. Number 2, self construction. Number 3, exchange of assets. Number 4, issue of securities. Shall I start now? So coming to the first one, Nana, cash or credit. It has to be recorded at dash price, amma. Cost price is equal to dash plus dash, amma. Purchase price plus direct expenses. Direct expenses are those expenses which are incidental or directly attributable to the purchase. And purchase price is nothing but price which is stated in the invoice. Already discussed that in invoice 3 components will be there. Number 1, general purchase price okati, trade discount okati, taxes and duties okati. Trade discount has to be deducted. Coming to taxes and duties, you need to check out whether is it refundable or non-refundable. Refundable has to be deducted if it is included. Non-refundable has to be added if it is not included. Trade discount is always to be deducted. And some other things similar to trade discounts are quantity discounts and volume rebate. Quantity discount. If you purchase more than 3 units, we will give you discount. Volume rebate. If you purchase more than this many volume of good, we will give you some rebate. Quantity discount and volume rebate are one and the same. Something like in EOQ costing you will be having. If at all the trader is purchasing more than 1000 units, 0.5 rupee per unit will be given as discount. Is purchasing at EOQ better or exercising the option better anedo untundi. So that is nothing but quantity discount or volume rebate. Respond everybody, clear? Okay. Now be careful. I'm showing the list. I'm showing the list relating to the direct expenses. Take care, all the carrying costs has to be included, like freight inward, carriage inward, toll charges, transit charges, etc. Unloading charges have to be included, site preparation charges, assembling cost, installation fees, employee fees, professional fees, and some other thing like testing cost. Testing cost has to be net of sale proceeds. Likewise, at the time of testing, you might get some sample output. Testing cost is 1 lakh. If you sell the sample output, you are getting 25,000. What is the net testing cost? So now you have to include 75,000. And the next one, be careful. Other standard relating things. Number one is borrowing cost. If at all the fixed asset or PPE had satisfied the definition of qualifying asset, then borrowing cost has to be capitalized. If at all it is not satisfying the definition of qualifying asset, it has to be charged. And if any government grant is received and if you are following asset reduction method, then grant has to be deducted from the asset value, cost price of the fixed asset. If you are following DGG method, this concept will not be there at all because you are going to treat it as a separate liability. Cheppandi clear? And the next one, things which are to be excluded, administration expenses which are not directly relating to installation. Selling and distribution expenses, initial operating losses. I hope you know the concept of initial operating losses. Initially, say for example, you have purchased heavy machinery valuing 2 crores. But initially the production run itself is like 10 lakhs. And if you sell hardly, you will be getting 20 lakhs. Is it clear? So when compared to this 2 crores and 20 lakhs, obviously there is some loss. Am I correct or wrong? Respond. But you should not do like that at all. And let me tell you, operating losses meaning, say for example, you have established a company in the first year. Established a company in the first year where your total expenses including depreciation is 20 lakhs. First year obviously expenses will be more kada. Establishment expenses, preliminary expenses, registration fees, huge amount of depreciation, like that there is around 20 lakhs. But revenue generated is only 5 lakhs. Respond. Obviously there is a loss of, this is called as initial operating losses, that is like operating by using the assets in the first year or using the asset for the first year. Operating the business by using the assets for the first year, ledante using the asset for the first year. In these courses of action, if you have got loss, that loss should not be considered. Respond everybody, clear? And now moving on to the next thing, cost of relocation or redeploying. Cost of relocation, changing from one location to another location. Likewise, asset is installed at this place. From this place, asset is installed at another place. Is it clear? So it is not to be included. Say for example, asset is installed at one room. You so felt that for that room that asset is not needed and hence deinstall and moved on the same asset to another place in another room. There the need is there. This is nothing but cost of relocation or redeploying. Now answer me, does it to be included or to be excluded? Excluded. You need to include only those expenses which increases future economic benefits. Is it clear? You need to include only those expenses which increases or maintains increases the future economic benefit. Cost of using, that is repairs and maintenance. Cost of research and development, which will be dealt as per AS 26. Advertisement and promotional expenses, of course these are also not to be included at all. Inauguration cost is not to be included. Training costs are not to be included. Respond everybody, clear? Because training is a routine exercise, it should not be included. But further clarification relating to training, inauguration cost, advertisement and promotional activities, research and development, we are going to learn in accounting standard number 26. Inauguration cost, preliminary expenses, pre-operating expenses, advertisement, promotion expenses, training cost, all these things we are going to learn in AS 26. Respond everybody, clear? So one of the important expense that you need to consider is all about present value of decommissioning and restoration expense. Everybody, I hope you know the meaning of this expense. What do you mean by decommissioning? Dismantling. Restoration, bringing back to the original position. Bringing back to the... Now, at the end of the year, whatever the dismantling expenses and bringing back to the original position expenses are there, you have to estimate and bring it to the present value. Say for example, you would like to install a machine in a room by altering that room, by altering the walls of that room. Owner told, okay, now you alter if needed, but whenever you are vacating the building, you have to restore the same room to the original position. So now you have installed an asset in that room and you are estimating that the life of the asset is 10 years. After 10 years, you have to dismantle the asset where you are going to incur a cost of 1 lakh and you have to restore the walls to its original position where you are estimating that you will be incurring 1.5 lakh. And hence on a whole you are incurring 2.5 lakhs as decommissioning and restoration expenses at the end of the 10th year. Now you are somewhere at year 0. Bring the 2,50,000 to the present value and you need to create a provision. Is it clear, everybody? Now very, very important. What is the treatment for this provision for decommissioning and restoration expense? Check out whether the asset is used to produce inventory or asset is used for other than inventory. Likewise, if you take central AC unit plant, it will not give any inventory. Am I correct or wrong? So it will be coming under this lot. But say for example, you have installed a machinery which is producing wood, then it will be coming under this lot. Respond clear. Now, very, very important, my dear children, if at all it is an asset which is producing inventory and you have to incur provision for decommissioning and restoration expenses, that will be added to the cost of production as per AS2. Is it clear? But if at all that is an asset other than inventory, asset other than producing inventory, not other than inventory, it's a PPE other than producing inventory, then PFDR has to be capitalized as per AS10. Meer adagachu, sir, you are treating that this has to be dealt as per AS2 under cost of production kada, then why you did not discuss in AS2? In AS2 there is no specific provision for this. Simply AS2 is telling only one statement. Any other cost which is directly relating to production can be included. Sir, is it clear? But the clarification is given in AS10 and hence now I am discussing. Is it clear, everybody? So now be careful. Say for example, whatever 2.5 lakh you are going to incur after 10 years, bring it to the present value and say for example it comes to 189,250. You have to capitalize the same to the cost of the fixed asset and the journal entry will become asset account debtor to cash or bank account, which is nothing but cost price, to provision for decommissioning and restoration expenses account. This will be recorded at present value and capitalized to the value of the asset. Respond, everybody, clear? And chala jagratta, now you are recording this provision for decommissioning and restoration expense at present value or future value? Present value. So at the end of year 10, it should be converted into future value. At the end of year 10, it should be converted into future value. So every year you have to unwind the discount. This is the technical term, mama. Unwinding of discount antaru, which is nothing but every year you will be getting the interest. Am I correct or wrong? Respond. That interest should be closed and transferred to P&L account. That interest should be closed and transferred to P&L account. This is technically called as unwinding of discount. And something in our example, we got 189,750 kada. Say for example, if the present value rate is 10%, 189,750 into 10%. You will get 18975. Every year you have to find like that. Sir, is it clear? And the journal entry will become borrowing cost or interest account debtor to provision for decommission and restoration expenses account. and then this has to be closed and transferred to P&L account. P&L account debtor to borrowing cost account. Respond everybody, clear? And my dear children, be careful. In year 1, you have to compute it on present value. 189750 in 10%. Say for example, you will be getting 18975. In the second year, your computation should be on 189750 plus 18795, whatever is that, into 10%. I mean to tell, it should compound every year. Because it is something like present value application ante 1 by 1 plus I whole power n kada, where you are bringing the same to the present value by compounding. Annuity present rate by compounding. So every year, even on interest has to be computed. In the next year, 189750 plus 18975 plus interest of second year into 10%. Sir, is it clear? And a conclusion, you need to compute interest on? You need to compute interest on interest also. Respond everybody, understood. And my dear children, that is the end of present value of decommissioning and restoration expense, and also that is the end of cash or credit. Now moving on to the next thing, self-construction. Very simple. Self-construction has to be recorded at dash price, cost price, which is nothing but purchase price. You are constructing, so you'll be using your material and you are converting the cost. So material plus construction costs. Material plus construction cost. Cost of material used plus construction cost. Where construction cost includes labor, overheads, other depreciation, etc. Respond everybody, clear? Of course, depreciation is included in overheads, kada. So simply self-construction, say you are purchasing, you are constructing your own building. Material used for that building, labor used for that building, and other expenses or overheads used for that building. Respond everybody, clear? Very, very important. Internal profits, if any, have to be eliminated. If you are using your own cement bag for construction of your own building, you are using your own cement bags for the construction of your own building. In such a case, you need to consider only the cost price, but not the selling price. Such internal profits, if any, they have to be eliminated. And very important, abnormal losses have to be eliminated, but normal losses have to be included. Include normal loss, eliminate abnormal loss, and eliminate internal profit. Say for example, you are using 100 cement bags for the construction of your building. Each cement bag cost price is equal to 500, selling price is equal to 600. Now accountant should use how much amount, amma? Accountant should compute how much amount, amma? 500, but not 600. Inka clear ga cheppali ante 100 cement bags multiplied by 600 minus 100, which is nothing but 500 kada. I mean to tell, like, internal profits have to be eliminated. Respond everybody, understood? The next one, issue of securities and exchange of assets. Be careful. Coming to exchange of assets, which is totally similar to a barter system. And be very careful, my dear children. You need to check out whether there exists a commercial substance or there is no commercial substance. What do you mean by commercial substance, sir? Risk, timing, nature, cash flows. Or enterprise specific value of portion of operations should significantly differ from old asset to new asset, exchanged asset to acquired asset. What is this one, sir? Simply, say for example, you are exchanging your old car with a new car. Check out whether risk, timing, and nature, cash flows, same or different. You need to check out. Sir, if it is same, then there is no commercial substance. If it is different, there is a commercial substance. Hey, respond everybody, clear? Sir, if at all You cannot tell with this one. There is one more point given. Enterprise specific value of portion of operations. Specific value is nothing but cash flows after tax. Portion of operations by using that asset. Inka simple ga cheppalante, you will be getting CF80 in your FM. Capital budgeting. CF80 using an asset. Did you remember? CF80 using an asset. Capital asset. That is nothing but enterprise specific value of portion of operations. But in advanced accounting as per AS10, it is called as post-tax cash flows. What is it called as? So post-tax cash flows from old asset and new asset, they should be significantly differ. If they are significantly differ, then there exists a commercial substance. If there is no significant difference, there is no commercial substance. In general, exchanges happened between same assets. No commercial substance. Exchange happened between different assets. There is a commercial substance. This is general understanding. Say car to car, no commercial substance. Hey, is it clear? Computer to laptop, there is no commercial substance. But be careful, huh? Plant and machinery to plant and machinery. Which plant and machinery and which plant and machinery is needed for you? Say for example, machinery producing inventory of 10,000 units is exchanged for machinery producing 11,000 units. No commercial substance. But machinery is exchanged for land. Commercial substance is there. Car is exchanged for machinery. Commercial substance is there. Furniture is exchanged for furniture. No. In this case, you are supposed to tell which kind of furniture. Say, for example, chairs are exchanged for chairs. No commercial. But chairs are exchanged for fixtures. Commercial substance is there. I hope it's clear for you. Exchange happened between same assets. No commercial substance. Exchange happened between different assets. Commercial substance is there. Sir, to write journal entry, it is so simple. Concentrate on the entry that I am writing. New asset account debtor to old asset account. First you freeze this entry. And then check out whether cash is being received or cash is being paid. If cash is paid, to cash or bank. If cash is received, cash or bank account debtor. Either in these two cases, either of the things will happen. Is it clear? Now let us start filling the amount. Cash or bank received will be absolute. How much you receive, put that. How much you pay, put here. And this is also very simple. Old asset has always to be credited with book value of the asset given up. Now the real problem is only with this part. This has to be recorded at Jagrat. If commercial substance is there, then you have to record it at fair value of asset given up. So if fair value of asset given up is not there, fair value of asset acquired. Even if this is also not there, book value of asset given up. If commercial substance are not there, book value of asset given up. There ends the matter. Is it clear, everybody? Assets acquired has to be recorded at. Check out whether commercial substance is there or commercial substance is not there. If commercial substance is there, then fair value of asset given up. If it is not there, fair value of asset acquired. Even if it is not there, book value of asset given up. Respond everybody, clear. And then you will be getting a balancing figure which is nothing but profit or loss. Is it okay for everybody? So once again, I'm telling you the entry. So simple. New asset to old asset. Check out whether you are paying cash or whether you are receiving cash. This is absolute no change. This is absolute no change. This is absolute no change book value. Now you have to record this value. For that, there is an answer for entire assets acquired. What is that, sir? Commercial substance is there. Book value of asset given up. Commercial, if it is not there, book value of assets acquired. Even this value is also not there. Book value, I'm sorry. Yeah, I'm sorry. Be careful. ఇక్కడ కరెక్టే చెప్పాము. Yes, if commercial substance is there, you need to record the same at fair value of asset given up. If this is not there, fair value of asset acquired. Even if it is not there, book value of asset given up. If commercial substance are not there, book value of asset given up. Is it clear? After filling all this data, you will be getting a balancing figure, which is nothing but either profit or loss. Is the concept understood for everybody? Now moving on to the next thing, issue of securities, very simple. You will be getting a machinery. Yes, sir. You will be issuing securities, either equity or preference or debenture or bond, whatever is that. Now, this always should be recorded with fair value of securities issued. This is always to be recorded at face value of securities issued. Difference between these two things is nothing but securities premium. Is it understood, everybody? In some rarest of the rarest situations, if fair value of the security is not there, then use the face value of securities issued. In some situations, if fair value of the securities are not there, use face value of the securities issued. Clear, everybody? And my dear children, all the modes of acquisitions were completed. Now let me concentrate on some special areas. Point number 1. If at all PPE or acquired at a consolidated price. If at all group of PPE or acquired at a consolidated price or a single negotiated price, then you are supposed to apportion the consolidated price basing on the fair value as on the date of purchase or date of acquisition. Say for example, asset 1, asset 2, asset 3. Fair values 1 lakh, 2 lakhs, 50,000 are purchased at a common price of 3 lakhs. Then you have to, you should not write like asset 1, 2 and 3 account debtor to cash or bank. 3 lakh is wrong. Asset 1 account debtor, 2 account debtor, 3 account debtor, 2 cash or bank, 3 lakhs is correct. But this 3 lakhs has to be apportioned to asset 1, 2 and 3 basing on the fair values as on the date of acquisition. So this 3 lakhs has to be amortized in the ratio of 1 lakh is to 2 lakhs is to 50,000. Respond, everybody, clear? How much ever the amount, write that. Shall I proceed further? The next important thing, deferred credit period. Sir, what is deferred credit period, sir? Deferred meaning is nothing but postponement. So postponement of credit period. What do you mean by this one? Say for example, the seller will be generally offering a credit period of 2 months. But since there are good relation between the trader and the company, he is offering a total credit period of 2 years for us. Is the amount payment delayed or not? If the payment is delayed, everybody will be expecting. Payment is delayed, everybody will be expecting interest. So, if at all the trader is being paid with the cost price of the machine plus interest, there is no problem. But if at all, since the relations are very good between the trader and company, is asking to pay only the cost price even after 2 years. Sir, ardhamainda? And he is not asking to pay interest. In such a case, the total cost price of PPE, whatever is there, you have made it into 2 parts. Number 1, present value of payment. Number 2, balancing figure. Present value of payment should be treated as cost price. Balancing figure should be treated as interest as per accounting standard number 16. Let me tell you an example. Say for example, you have purchased 2 lakhs value of fixed asset. And to everybody he is offering only 3 months credit period, but due to very good relations he offered 2 years credit period for us. If at all he is expecting interest, then you are supposed to pay 2 lakhs plus interest. But he is telling out of good relation, even no need to pay interest, sir. Then this entire 2 lakhs shall be made into 2 parts. Number 1, present value of 2 lakhs. Number 2, balancing figure. This present value of 2 lakh will be treated as cost price of PPE. This balancing figure is treated as interest. Is it clear? Sir, did you remember PFDR unwinding of discount? Gurtunda, borrowing cost account debtor to PFDR, P&L account debtor to borrowing cost. In the similar way here also, interest account debtor to creditor account. Because it is not yet paid kada. And then P&L account debtor to interest account, provided if the asset is not satisfying the definition of qualifying asset. If the asset definition satisfies the qualifying asset definition, then it has to be capitalized to PPE. So deferred credit period clear. And simple nana, if he is not expecting interest, in the total payment itself there should be interest. You separate the interest portion, which is nothing but balancing figure other than present value of payment. Respond everybody, clear? Moving on to another special point, component method of depreciation. So simple. If asset is having multiple components, then you are supposed to treat each and every component as separate asset, and you are supposed to depreciate separately. Is it clear? Sir, Jagratta, if at all component, all the major parts are called as components. All the major parts are called as components. Other than these major parts, there will be some portion of asset kada. It is called as remainder of asset. It is called as remainder of asset. Now very, very important, inverter. Generally two components are there. Number one is UPS, number two is battery. Don't write the entry like inverter account debtor to cash or bank. Separate it into components. Inverter UPS account debtor, inverter battery account debtor to cash or bank account. Now for battery, you have to follow WDV method of depreciation. For UPS, generally you will be following SLM method of depreciation. Now moving on to the next thing, amma. Be careful. If at all, Jagratta, UPS, life, battery, life. UPS method, battery method, one and the same. Is component method of depreciation needed in this context or not needed? Not needed, because life is same, method same. In this context, component method of depreciation is absolutely not needed. Is it clear, everybody? Fine. Sir, there is a very important question from examination point of view. Be careful. Jagratta. If at all you have purchased you have purchased an asset today, and this asset is having two components like component 1, component 2 and remainder of the asset. Frankly speaking, you are supposed to account in three parts: asset component 1 account debtor, asset component 2 account debtor, asset remainder account debtor to cash or bank. But unfortunately, you cannot account on component wise because you don't know the cost price separately. Best example, AC is having indoor unit and outdoor unit. But can you separate indoor unit and outdoor unit? No, AC antene it's a package. Nobody are going to sell indoor and outdoor unit separately to you. So frankly speaking, component method of depreciation possible in AC context or not possible? Not possible. But in inverter context, possible, because you can purchase battery and UPS separately. Shall I proceed further? Now, you are not following component method of depreciation because you can't find the cost price separately. So now you have accounted asset account debtor to cash or bank account. And you are thinking that the life of asset is 10 years. Exactly after 7 years, component 2 is replaced. This time component 2 is replaced from the market since market value is separately available. So component 2 value has to be capitalized. Yes or no? You are purchasing component 2 from the market after 7 years. So component 2 value has to be capitalized. But very, very important, book value of old component 2 has to be de-recognized. But you don't know what is the book value of old component 2 kada. So what are you supposed to do ante? Component 2 market value take and you work back to the present value. You are replacing in which year, amma? 7th year. So go back for year 0 present value and find the present value of component 2 value at year 0 and then provide depreciation for 7 years and then you will be getting one book value. This value has to be deducted from cost price of asset. A new component 2 value has to be capitalized, added to the value of the asset. Hey, respond everybody clear. You're having a problem, something like an asset is purchased and a turbine is there. And the turbine is replaced at the end of year 4 or year 6. Gurtunda. So be careful. This is very, very important. And now, be very careful. Moving on to the next concept. What is it called? Subsequent expenditure. Subsequent expenditure. Does it to be capitalized or does it to be charged? One very simple rule, if subsequent expenditure increases the future economic benefit, maintains the future economic benefit, you need to check out. If it is maintaining the future economic benefit, charge. If it is increasing the future economic benefit, capitalized. Is the rule clear, everybody? Please concentrate in this context, one very different example. You have purchased a machinery, you have purchased a car. Where it is giving you a mileage of 10 kilometers per liter. And exactly after 6 years, the capacity of the car is only 4 kilometers per liter. Is it clear? And you have replaced the same with a new carburetor or with a new motor, wherein the capacity has been increased to 8 kilometers per liter, or it is increased again up to 10 kilometers per liter. Now, is it to be charged or to be capitalized? Charged or capitalized? Charged or capitalized? Okay, let me tell you one more example to make it more clear. Generally, there is a machinery whose capacity is 1 lakh units. And after 5 years, the capacity is also decreased to 60,000 units. Now you are incurring some expenditure of rupees 5 lakhs and hence the capacity is again increased up to 1 lakh, not more than 1 lakh. Is it clear? Sir, Now answer me. Is the 5 lakh to be charged or capitalized? Charge or capitalized? Adenti. You told 4 is increased up to 10 and here you told it has to be capitalized. Sir, is my point clear? Car example, machinery example, same hai kada. 4 kilometers capacity is increased up to 10. You told capitalized there. Ikkada em chepparu 60,000 units is increased up to 1 lakh. And you are telling charge here. Is it to be charged or capitalized? Rendu charge? Rendu capitalized? Sorry, the answer is 2 things have to be capitalized, amma. Because you should not check the original capacity. Present the capacity is 60,000. To maintain 60,000 units, if you are incurring any expenditure, that has to be charged. Okay, is my logic clear? To maintain the capacity level at 60,000 units, if you are expending anything, that has to be charged. But if at all anything you have incurred to increase the capacity from 60,000 units, that has to be capitalized. Respond everybody clear. That's it. And one of the important subsequent expenditures is major inspection cost. And for your kind information, major inspection cost has to be capitalized, always capitalized. Major inspection cost is always to be capitalized. Respond everybody clear. Because major inspection cost is reaping you some benefits, like how to use the asset, when to use the asset, when to replace, what to replace, everything will be clearly given, and hence major inspection cost has to be capitalized. Respond everybody clear. Now the next one, replacement. Replacement of a worn out part. Worn out part is nothing but damaged part. It has to be. Sir, answer cheppandi. Replacement of worn out part. Charge. Damaged parts, amma. Likewise, a continuous running of machine, some screws will come out. You may need to fix it. If at all sewing machine, tailors has to replace the tailor belt. That is quite common for them. So all those are worn out parts and hence they were to be charged. But if at all it is a worn out part replacement which increases the future economic benefit, in such a case it has to be capitalized. And my dear children, next one, replacement of asset or component. Replacement of asset or component, capitalized. But take care, old asset book value or old asset component book value has to be de-recognized. Sir, gurtunda? Old asset book value or old component book value has to be de-recognized. If at all you are unable to find what is a component book value, then find the market value at present, work back to the present. Sir, arthamatunda? If at all component book value are unable to ascertain, now find what is a market value as of that point and work back to the present value at year 0 and provide the depreciation till now. That will become the book value and it has to be de-recognized. Understood everybody? Very important. The next one, re-major inspection cost. Even re-major inspection cost is also to be capitalized. But in this context, if any old major inspection cost is there, that has to be de-recognized. Respond everybody, clear? Okay. Moving on to the next thing, cost model, revaluation model. If it is cost model, it is very, very simple, my dear children. I mean to tell you need to find the historical cost minus accumulated depreciation minus accumulated impairment of loss, and finally you will be getting a value called book value. If it is revalue, then this has to be replaced with revalued figure minus accumulated revised or new depreciation minus accumulated or revised new impairment of loss, and finally you will be getting book value. Is it clear? Now I'm going to start with the concept of revaluation. Point number 1, a single asset cannot be revalued. All the assets need not to be revalued, and if you wish to revalue, you have to revalue the entire class of assets. You have to revalue the entire class of asset. And very important, first time revaluation upward. What is the entry? Asset account debtor to revaluation surplus account. Subsequent revaluation downward. First of all, you have to debit the revaluation surplus to that extent, and then if any is there, debit to the balancing figure to asset account. Clear everybody? Next one, first time revaluation downward. P&L account debtor to PPE or asset account. Subsequent revaluation upward. PPE account debtor to P&L account to that decrease, and if any is there, it will be credited to revaluation surplus. Respond any doubts to anyone? Now, very, very important, techniques of revaluation. Sir, I hope the concept is clear. First time upward, subsequent downward. First time downward, subsequent downward. Subsequent upward. Is it clear? First time aithe you have to use RS or P&L. Subsequent aithe reverse you have to use. First time upward, what is the entry? Asset account debtor to revaluation surplus. Next downward aithe first use revaluation surplus. First time downward aithe what is the entry? P&L account debtor to PPE account or asset account. Then upward aithe first you have to use P&L account. Is it clear everybody? Next, techniques of revaluation. There are two techniques or two methods of revaluation. Concentrate carefully. If at all asset 1 lakh minus accumulated depreciation 60,000 and the balance comes to 40,000. Now this 40,000 is revalued upward to 80,000 or revalued upward to 70,000. Is it clear? Now, what is the accounting treatment in this regard? Technique number 1, eliminate accumulated depreciation. And what is the entry, sir? Accumulated depreciation account debtor 60,000 to asset account 60,000. And automatically what happened, amma? Asset value had decreased it to 40,000 now after writing off of 60. Sir, ante kada. And accumulated depreciation balance had become 0. Asset is having dash balance. Accumulated depreciation. Credit 60, debit 60, cancel. Asset debit 1 lakh, credit 60. So balance 40. Now start doing revaluation. And 40 assets should increase up to 70 kada. And how much is the upward? So what is the journal entry? Asset account debtor to revaluation surplus. It is quite common. Follow the rules. Technique 1 clear, huh? Hold your calculators and answer me clearly. Technique 2. Asset 1 lakh minus accumulated depreciation 40, 60, 60, asset book value 40. Now this 40 should become 70. Am I correct or wrong? Company would not like to eliminate accumulated depreciation. It wants to continue with accumulated depreciation. In such a case, you need to do the cross multiplication. 1 lakh into 70 divided by 40. 1 lakh. Next, 60,000 into 70 divided by 40. 1 lakh. Now check out. Even now, the answer will become 1 lakh 70 only. But you need to pass the entries for this one now. Concentrate. Increase the value of the asset from 1 lakh to 175. So, asset account debtor 75,000 and increase the value of depreciation also to accumulated depreciation 45,000 and automatically the balancing figure 30,000 will be credited to revaluation surplus. Is it clear, everybody? This is nothing but technique 2. Until in one of the techniques, accumulated depreciation will be totally eliminated. In another technique, accumulated depreciation will not be eliminated. Next one. How many times you have to do the revaluation? If there is a significant difference between the book value and the market value, you can do revaluation for every year. But if there is no significant difference between book value and market value or fair value, you can do only once in 3 to 5 years. Is it clear, everybody? Next one. What is the revalued amount, sir? Check out whether your asset is having active market or not. If my asset is having active market, market value or fair value is nothing but revalued amount. If active market is not there, let the management decide by following various methods like discounted cash flows method, capitalization approach, earnings approach, optimized depreciation replacement cost methods. Hey, this is so simple. You will be doing in your FM. Inka clear ga cheppali ante cash flows used to generate from that machine divided by normal rate of return. Ante. Ee methods anni ante. Cash flows used to generate the return divided by rate of return. This is called capitalization or earnings approach. DCF ante meeku telusu kada. Future economic benefits will have to be brought to the present value. That is called as discounted cash flows approach. And this is not there for you. Only name is there. Depreciated replacement cost method. Only name will be there. Respond, everybody, clear. Now the next one. When do revaluation surplus be closed, sir? Two options are there, amma. Policy number 1. Continue to show revaluation surplus forever. When the machine is disposed, then you can also close the revaluation surplus by transferring the same to general reserve. Is it clear? Policy number 2. Every year, close revaluation surplus and transfer the same to P&L account. Every year, how much, sir? In proportion to depreciation. Is it clear? Danine in standard it will be given like this. Depreciation on revalued figure minus depreciation on original cost price. Antadu. That has to be written off to P&L account. But this is technically nothing but total revaluation surplus in proportion to depreciation. Sir, Ardhamainda. Say for example, asset value 1 lakh. Revalued to 1,20,000. How much upward is there, Amma? Continue this 20,000 forever. Whenever the asset is sold, pass an entry. Revaluation surplus to general reserve 20,000. Ledu ante policy number 2. Say for example, you are following 20,000 for 10 years. 20,000 for. So how much is the revaluation surplus? 20,000. And how many years you are having, Amma? Say SLM method is followed. So in proportion to depreciation, you have to provide revaluation surplus also. So 20,000 divided by 10 years, which comes to 2,000 per annum. In proportion to depreciation. Ledu ante depreciation on revalued figure 12,000 minus depreciation on original cost, that is 10,000, which is nothing but 2,000 again. So respond, is it clear everybody? Fine. Revaluation concept is completed, and moving on to the next concept, Amma, retirement of PPE. Ma, retirement is nothing but, be careful, held for sale but not yet sold. Ante your asset is actually retired from active use. No future economic benefits are there by using the asset. Only one option there is to sell. Held for sale but not yet sold. In such a case, you have to record the asset at book value or net selling price, whichever is lower. Book value or net selling price, whichever is lower. NSP is nothing but selling price minus selling expenses. Net book value is nothing but cost price minus accumulated depreciation. Is the retirement concept clear, everybody? Now, if you have sold any PPE, then automatically find profit or loss. Profit or loss is equal to dash minus dash. Selling price minus cost price, but please modify here, it will become book value. Whatever the profit or loss it will be immediately transferred to P&L account. In this context, one examination tip, no concept of capital reserve as per AS10. As per AS10, no concept of capital profit. And you might have learnt in foundation something like, if at all the selling price is more than the cost price. Did you remember? Selling price is more than the cost price, then that will be treated as capital profit and it has to be transferred to capital reserve. But unfortunately, such concept is not there as per AS10. Simply as per AS10, profit or loss has to be transferred to P&L account. Clear, everybody? And moving on to the next concept, depreciation. Coming to depreciation, frankly speaking, I'm not going to discuss each and everything because it is very simple. One advanced point is that depreciation on integral part of PPE and depreciation on non-integral part of PPE. I don't discuss this concept at all because it is not needed for exam. Now, things that are important for depreciation. What is the method of depreciation you need to choose? Not SLM, not WDV. Here also the rule is very simple. Any method. Any method in which is basing on the pattern of generation of future economic benefits. I hope in AS2 you have remembered. Any method which is representing the fairest approximation cost. Here also in the similar way, any method which is representing the pattern of generation of future economic benefits. If the future benefits are equal, SLM, future benefits decreases, WDV, future benefits depend on units, production units. If they are depending on hours, machine hours method, no depletion method is permitted, no sum of years of digits method is permitted. Generally only these patterns will be permitted. And be careful. If you have remembered the inverter example that I told you, battery benefits will be generally decreasing and hence following WDV method. And UPS benefits are generally same and hence following SLM method. Is it clear, everybody? Now, very, very important. What is method of depreciation or what is change in method of depreciation? This change in method of depreciation is nothing but change in accounting estimate. Is it clear, everybody? Method of depreciation is an accounting policy. Sir, is my point clear? Which method you have to use? It depends on the pattern, and hence it is an accounting policy, but it is depending on the estimated pattern kada. So it is depending on the accounting estimate. This is a very different and very peculiar point. One single line. Method of depreciation is an accounting policy which is depending on an accounting estimate. Therefore, change in method of depreciation is called as change in accounting estimate. Concept clear, everybody? Quickly answer me. What is method of depreciation? Accounting policy. It depends on estimation, and hence change in method of depreciation is change in accounting estimation. Clear, everybody? Now moving on to the last and final part, that is impairment of loss. Impairment of loss is provided after depreciation. Remember, impairment of loss is provided after depreciation, that is cost price or revalued amount minus accumulated depreciation, then you will be getting net book value. Compare this net book value with recoverable amount, and if net book value is greater than recoverable amount, bring down net book value to the recoverable amount, and this difference is nothing but impairment of loss, which will be charged to P&L account. If net book value is less than recoverable amount, then there is no impairment of loss. And what do you mean by recoverable amount, sir? Value in use or net selling price, whichever is higher. What do you mean by value in use, sir? Present value of future economic benefits. What do you mean by net selling price, sir? Selling price minus selling expenses. Respond, everybody. Clear? This is all about impairment of loss, which shall be charged to P&L account. Clear, everybody? And last and final, for a company to provide depreciation, you have to follow schedule 2. But remember, as per Income Tax Act, less than 180 days, more than 180 days, such concept is not there here. Here you have to provide depreciation proportionately depending on the period of usage. 4 months used, 4 by 12. 6 months used, 6 by 12. Like that you need to provide. Respond, everybody. Clear? And the last, which is like if any estimations are changed. Likewise, revaluation is an estimation. Life period is an estimation. Method of depreciation is an estimation. If any estimations are changed, then you have to compute the depreciation prospectively, but not retrospectively. Respond, everybody. Clear? And my dear children, accounting treatment, with this I will close totally. Accounting treatment for depreciation. What is the entry amount? Depreciation account debtor to PPE account. Then close depreciation. If at all it is relating to administration or selling and distribution purposes, then it will be closed and transferred to P&L account. If it is relating to production or inventory purposes, then it will be closed and transferred to manufacturing account or something called cost sheet. If at all you have used this asset for self-construction, and you have used a tractor for construction of building, then depreciation on tractor has to be added to the building, and the journal entry will become self-constructed building account debtor to depreciation on tractor account. And if at all you have used a computer for developing a software, then it has to be capitalized to the intangible asset. In such a case, intangible asset software account debtor to depreciation on computer account. Is it clear, everybody? And my dear children, thank you for your extended cooperation, and accounting standard number 10 is also totally completed. Yes. So welcome to day 2, session 2, part 1, which is before break. We have something huge target to complete here actually. We have to complete at any cost because we have to complete much more topics in some lesser number of hours. And hence our target in this session, that is from 9 to 11, to complete Intro to Accounting Standards Framework AS1, AS4, AS5 and AS25. This is our target to complete. Hey, highly recommended to listen, concentrate, participate. Okay. So let us continue with the first and foremost thing, which is all about introduction to accounting standards. Also, it seems we have provided some amendment material for you, so which is totally amended. So for the purpose of applicability of accounting standards, all the business entities are actually classified into corporate entities and non-corporate entities. Corporate entities are classified into SMCs and non-SMCs. Non-corporate entities are actually classified into level 1, level 2, level 3, level 4, and you have to actually remember 4 categories here. And also note, if at all any business entity is becoming smaller level after becoming a higher level subsequently, then it should be in that category or in a lesser category in order to avail exemption for at least 2 years. Hey, did you remember? Did you remember that? I mean, previously a non-corporate entity is level 2. Now it had become level 4. Can it claim level 4 exemptions immediately? No, it has to be in the category of level 4 for 2 consecutive years. Only then from the next year it will be claiming the exemptions available to level 2. Level 4. But frankly speaking, such kind of provisions were done away with. Because previously level 1, now in order to claim level 2 exemptions, it should be in the category either of level 2, level 3 or level 4. Hey, am I correct or wrong? Yes or no? Sorry, if you have remembered, pretty fine. If you have forgotten, most happy. Reason being, the entire elements have got amended. And now the non-corporate entities are divided into 2 types. Number 1 is large scale entities. Number 2 is MSME entities. If you have remembered, teachers will be generally telling something like level 1 entity is large scale, level 2 is medium, level 3 is small, level 4 is, now level 1 is large scale entities and level 2, 3, 4 were clubbed and we are together calling it as MSME. What is MSME? Micro, small and medium scale enterprises. Is it clear, everybody? Fine. But before discussing about these things, some general aspects likewise to tell you. Sir. Wait. Wait. Okay. What are accounting standards? As usual, accounting standards are written policy documents. Hey, what are accounting standards? Which are either issued by government or expert bodies. Government or expert bodies. Expert bodies like ICAI, ICMAI, because ICAI issued accounting standards. ICMAI issued cost accounting standards. Like ICSI will be issuing secretarial standards. I hope you have remembered something called ICDS. Income computation and disclosure standards, which are actually issued by Income Tax Act 1961. So standards can be issued either by government or expert bodies. And standards will be actually concentrating on these 4 aspects. RMPD. What are RMPD? Recognition, measurement, presentation. Recognition is nothing but recording. Measurement is nothing but presentation. Where shall the element appears in financial statements? And last and final, disclosure. Give additional information in notes to accounts. Is it clear, everybody? Sir, and benefits of accounting standards is an important for theory question. Take care. Benefits of accounting standards, important for theory question. Take care. You can understand it easily. On the next one, Standard setting process. How a standard is being introduced. That is also important for theory. Be careful. Start everybody. First of all, institute will be issuing accounting standards through institute antene ICAI kada. Accounting standards are issued by ICAI through ASB. Who is ASB? Accounting Standards Board. So steps of issuing accounting standards. Number 1, identification of broad area where standard need exist. Nowadays the sensible point is all about, trending point is all about agriculture. On agriculture there is a need of getting a new standard, and hence institute had identified that agriculture is the broad area, and then it will be formulating some study groups. Study groups will be preparing something called preliminary draft. This preliminary draft will be revised by Accounting Standards Board, and then this preliminary draft shall be sent to various bodies and members of ICAI for comments. Various bodies, members of Institute of Chartered Accountants of India, various bodies like ICMAI, ICSI, Scope is nothing but Standing Committee on Public Enterprises, Association Chambers of Commerce, SEBI, Company Law Board, MCA. Like that, it will be sending an accounting standard preliminary draft to various bodies and members of ICAI. Then it will be collecting some comments. And this preliminary draft could be modified once again, and this name is called as exposure draft. And this exposure draft once again sent to members of ICAI and also to general public. And then it will be collecting again some comments. Again with that comments it can modify the exposure draft, and finally it is called as final draft. And at last, whatever the final draft is there, it will be released as an accounting standard. What is released as an accounting standard, Amma? Final draft shall be released as an accounting standard with the effective date of commencement. With the effective date of commencement. Is it clear, everybody? Now, accounting standard is ready. Will it be applicable to everybody? Frankly speaking, ICAI is a regulatory body. It is not a legal body, and hence it cannot ask anyone to apply the accounting standard. Is it clear? Hey, who is releasing accounting standards in India? Through ASB. But can it ask everybody to apply the accounting standard? Because ICAI is dash body, regulatory body. It is not dash body, legal body. So it cannot order anybody to follow the accounting standard. Is it clear? Okay, then what can it do, sir? Be careful, my dear children. Accounting standard can be released by ICAI, but it cannot ask anybody to follow. Whatever the accounting standard or Ind AS which is issued, the same shall be considered and revised if needed by NFRA, National Financial and Reporting Authority. And after that, the same accounting standard shall be approved by central government through MCA, and the same shall be released through section 133, and it is applicable to company. Is it clear, everybody? Sir, is the extension process understood? Who is releasing, sir? Who is framing accounting standard? Through ASB, and it will be revised by whom? NFRA, and ultimately it will be issued by whom? Central government through MCA, through section 133 of Companies Act 2013. Now every company has to obviously follow section 133, and it has to follow all the applicable accounting standards or Ind AS. Respond, is this part understood? Now biggest point. Then what about the non-corporate entities, sir? For non-corporate entities, there is no mandatory that they have to follow accounting standards. For non-corporate entities, is it mandatory or not mandatory? But if at all non-corporate entities would like to be transparent, would like to be competitive, would like to be understandable, then it is recommended for a non-corporate entities also to follow accounting standards. Is it clear? But say for example, if non-corporate entity is going to a loan for a bank, it is going for a loop. Okay, a non-corporate entity is going to apply for a loan in a bank. Then obviously banker will be checking the financial statements. At that time, the financial statements should be in line with accounting standards. In such cases, following accounting standard is recommendatory. And if at all any non-corporate entity is falling under section 44AB. What is 44AB? Tax audit. As per Income Tax Act, during tax audit, the tax auditor needs to check the books of accounts. Am I correct or wrong? At that time, he needs to ensure whether books of accounts are being followed by accounting standards or not. Is my logic clear, everybody? Conclusion. Non-corporate entity. In most of the case, it is recommendatory in nature. In one case, it is obviously mandatory. Number one, if you are coming under tax audit as per section 44AB. And also highly recommended if you are applying for a loan towards the bankers, then automatically bankers also will be checking your financial statements. And even in that case also, it is indirectly mandatory to you to follow accounting standards. In all the remaining cases, ICAI cannot mandate the application of accounting standards. Respond everybody, clear? And the standard setting process is also totally done. Now this is very important, totally amended, so please concentrate carefully. All the entities are classified into corporate entities and non-corporate entities. No change with corporate entities. It is again classified into SMC and non-SMC. Non-corporate are classified into large scale entities, MSME entities, instead of L1, L2, L3, L4. Now done away with the rules of L1, L2, L3, L4. Now the rules are something like large scale entities and MSME entities. Clear, everybody? Sir, non-SMC and large scale entities, all the standards needed to be followed, but SMC and MSME, few accounting standards are exempted. Shall I proceed further? Now, my dear children, first of all tell me, what do you mean by a non-SMC? Number one, any of the following can be satisfied. Number one, it is either listed or it is in the process of listing either in India or outside India. Participate, everybody. If a company is either listed or in the process of listing either in India or outside India, then it will be called as non-SMC. If it is not listed, if it is not in the process of listing, then you need to check out condition number 2, whether is it bank, financial institution or insurance company. Irrespective of listing, either if it is bank, financial institution or insurance company, automatically it will be called as a non-SMC. So now if it is not listed, not in the process of listing, not a bank, not a financial institution, not an insurance company, check out for condition number 3. Previous year turnover at the end of the year. If it is greater than 250 crores, sir, greater than or equal to kadu, greater than 250 crores. Is my point clear? If at all previous year turnover at the end of the year is greater than 250 crores, then again it will be coming under non-SMC. Sir, not listed, not in the process of listing, not a bank, not an institute, not an insurance company, not even previous year turnover at the end is more than 250 crores. Check condition number 4. Previous year borrowings plus public deposits altogether are more than 50 crores. Is it clear? If it is more than 50 crores, then automatically it will be treated as non-SMC at any point of time during the year. Turnover aithe end of the year. Borrowings plus public deposit aithe at any point of time during the year. Then it will be called as NSMC. So all these 4 conditions are not satisfied. Okay, it can become SMC provided one more condition is there. Yes, you may not satisfied any of 1 to 4 conditions, but either your holding company or your subsidiary company had satisfied one of the 4 conditions and they are under non-SMC category. Now no need to check the conditions. You'll automatically become non-SMC. Understood? Either your holding company or your subsidiary company had become non-SMC, then automatically you will become non-SMC. No need to check further conditions at all. Respond everybody clear. And if any of these conditions are satisfied, you will be called as non-SMCs. If all of these conditions are not satisfied, SMC. The same logic is applicable even for large scale and MSMEs also. If any of the 5 conditions are satisfied, they will be under large scale. If all of the conditions are not satisfied, they will be under MSME. Is the point understood for everybody? Okay, so now quickly answer me. It's a non-corporate entity which is either listing or in the process of listing, either in India or outside India. Or if it is doing banking business, financial institution business, insurance company business, then it is under large scale. If not, last year turnover at the end of the year is greater than 250 crores, then it is under large scale. Or last year borrowings plus public deposit at any point of time during the year greater than 50 crores, again it will be under large scale. Sir, I did not satisfy any of these 4 conditions, but either my holding enterprise or my subsidiary enterprise had satisfied one of these 4 conditions and it had become large scale. So automatically my entity also will become large scale. Respond everybody clear. And then now no need to read the conditions once again for L1, L2, L3, L4. Whatever the conditions that are applicable for SMC and non-SMC, the same conditions are also applicable for MSME and large scale entities. Respond everybody clear. That's it. Now, moving on to one more thing. Yeah. So I hope you well know that how a non-corporate entities can list. Listing is generally applicable only for companies. Yes or no? But how a non-corporate entities can list? My dear children, in stock exchange, even mutual funds can also be listed. Mutual funds are not companies. Mutual funds are actually trusts. If it is trust, then automatically Companies Act is not applicable. They will be coming under non-corporate entities. Sir, is it clear? How a non-corporate entities can list in stock exchange? Every company, every public company can list, and also mutual fund can also be listed. Mutual fund is a non-corporate entity because it is trust, it is not a company. Hey, respond everybody clear. So like that, even holding or subsidiary is also possible for mutual fund. Everybody, is it clear? Shall I proceed further? Next. Even this condition is also same. Sir, for the first year it is SMC. For the first year it is SMC. Can it avail exemptions or not? In the year of incorporation, for the first time it is SMC. Answer, yes, it can avail. Because for the first time in the company's lifetime it is SMC, amma. It can avail exemptions. But very important, previously it is non-SMC and now it is becoming SMC. Can it avail exemptions immediately? To avail the exemptions available for SMC, it should be in the category of SMC for 2 consecutive years, and only then it can claim the exemptions available to SMC. Respond everybody clear. The same principle, same logic is applicable even for large scale entities and MSME entities also. If it is for the first time MSME entities, then obviously exemptions are available. But previously large scale entities, and now if it is becoming MSME entities, then obviously exemptions are not available immediately. It has to be in the category of MSME for 2 consecutive years. Then automatically it can avail the exemptions available for MSMEs. Respond everybody clear. And my dear children, all the general instructions are same for both the entities now. If it is MSME or SMC, it has to state that it is MSME or SMC and complying with all the applicable accounting standards. They respond clear. So like that, there are some conditions which are common, very not important for examination. So I'm not discussing those things. And yeah, here we have provided the list of applicable of accounting standards. Sir, if it is large scale, all the accounting standards are applicable. If it is MSME, some standards are fully applicable, some standards are partly applicable, some standards are not at all applicable. Very, very important point now I'm going to discuss. Along with AS3, along with AS17, along with AS20, along with AS24, some other standards like AS18, AS28, AS18 and AS28 are also not applicable for those MSME entities whose turnover is up to 50 crores or which is having borrowings up to 10 crores. Is my point clear? Now, MSMEs. For all MSMEs, AS3, AS17, what are the other two standards? AS24, AS20. Antena? These four standards are not applicable for every MSME. But if at all such MSME turnover is less than 50 or equal to 50 crores. If at all such MSMEs borrowings or public deposits is less than or equal to 10 crores or its holding or subsidiary is not a large scale entities. In such case, for these MSMEs who have satisfied even these conditions, along with these four standards, AS18 and AS28 are also not applicable. Cheppandi clear? Sir, I am explaining this provision. Reason, this provision is not important for exam, but this is an amendment and hence I am explaining this provision. Is it clear? So dash standards are outright not applicable for every MSME. AS3, 17, 20, 24. But along with these four standards, 18 and 28 are also not applicable, provided if the turnover is less than or equal to 50 crores and if the borrowings and public deposits are less than or equal to 10 crores. Respond everybody, clear? Fine, my dear children, this is the amendment. And even last and final, my holding or subsidiary should not become large scale entity or should not become MSME entity which had satisfied 250 crores and 50 crores conditions. Is it clear? If either my holding or my subsidiary is having more than 50 crores. Is my point clear? My holding company or subsidiary company's turnover is more than 50 crores. Then automatically I need to consider as an MSME which a turnover more than 50 crores. Sir, is it clear? 1 second. I'm standard. Either my holding company or subsidiary company. If they are large scale, even I will become large scale. Respond. If they are MSME category 1, then also I will become MSME category 1. Is it clear? MSME category 1 ante MSME whose turnover is between 50 to 250 crores. Or MSME whose borrowings plus public deposits are between 10 to 50 crores. MSME category 1. Then also I will become MSME category 1. And hence automatically 17, 3, 20, 24 are not applicable. Now, my entity, my holding entity or my subsidiary entity are under MSME category 2 only. What is the meaning of that, Amma? Borrowings and public deposits are less than or equal to 10 crores and turnover is less than or equal to 50 crores. Then along with the 17, 24, 20 and 3, 18 and 28 are also not applicable. Cheppandi clear? If my holding is large scale, even I will become. If my subsidiary is large scale, I will become. If my subsidiary is MSME category 1, I will become MSME category 1. Is it clear? So all the holding entities, subsidiary entity and even my entity should be under MSME category 2. Respond clear for everybody. So just concluding the part, listen carefully. All the non-corporate entities are divided into two parts, large scale entities and MSME entities. What all the conditions that are applicable for SMC and non-SMC, the same are applicable here also. For all large scale entities, all accounting standards are applicable. But for coming to MSMEs, again they were into two parts. Number 1, MSME category 1. Number 2, MSME category 2. MSME category 1, which is purely similar to your SMC. Whereas coming to MSME category 2, their turnover should be between 50 to 250 crores. Their borrowings or public deposits should be between 10 to 50 crores. Frankly speaking, this is similar to your L2 entities. L2 ra? Fine, whatever. Now, for MSME category 1, 17, 20, 24, 3 are not applicable. For MSME category 2, along with these 4 standards, 2 more standards are not applicable, AS 18 and 28. Respond everybody, clear? Now, last and final point, AS 14, amalgamation relating to companies. AS 21, consolidation generally relating to companies. AS 23, consolidation generally relating to companies. AS 27, consolidation generally relating to companies. And hence even these standards are not directly applicable for any non-corporate entities unless and until these standards are applicable to them. Sir, is my point clear? Generally, since these 4 standards are applicable for companies, these 4 standards are not applicable for non-corporate entities. But there may be some exceptions. Response, sir. Because even consolidation can be done for non-corporate entities provided if the conditions are satisfied as per AS 21. In such a case, then the standard may be applicable, but generally applicable or not applicable? Not applicable, because these are generally applicable only for companies. Respond, is my statement clear, everybody? That's it. See here, generally no transactions relating to 14, 21, 23, 27 and even 25 also, and hence these are not at all applicable for any MSME or non-corporate entities. However, if there are any transactions, then you need to apply. Clear, everybody? Sir, please respond, is it clear? And my dear children, that is the end of introduction to accounting standards. And last and final, you are just having a concept of Ind AS. Ind AS are nothing but accounting standards are converged with IFRS, and we have developed a new set of standards called Ind AS. Entire world is following something called IFRS. Is it clear? But we are following something called Ind AS. If there are any comparisons with respect to Ind AS versus IFRS, then we will be having something called carve-ins, carve-out. Is it clear? Sir, more detailed explanations are given in Ind AS when compared to IFRS. That is called as carve-in. We have deviated the rule when compared to IFRS. It is called as carve-out. Comparison between dash and dash. Ind AS versus IFRS. If detailed explanation is given, it is called as carve in. If some deviation is made, it is called as carve out. Be careful. Change in nomenclature. That is change in name. They are calling it as statement of comprehensive income, but we will call it as statement of profit and loss. They will call it as common stock, but we will call it as equity share capital. They will call it as preferred stock, but we will call it as preference share capital. They will call it as statement of position, but we will call it as statement of balance sheet. So like that, if at all there is change in nomenclature, names are changed, then it is neither carve in nor carve out. Neither carve in nor carve out. One more important provision. Reduction in options in Ind AS when compared to IFRS. Say IFRS is giving you to follow 5 policies, but you are giving only 4 policies. Are you violating anything? No. Sir, is my point clear? Say for example, as per accounting standard number 10, you can follow SLM, WDV, production units method and machine hours method, which are in the pattern of generation of future economic benefits. But you can't follow sum of years of digits method, where as per IFRS you can also follow that one. Say for example, as per IFRS you can follow 1, 2, 3, 4, 5 methods. But as per accounting standard you can follow only 4 methods. Now tell me, is this called as carve in or carve out? Neither carve in nor carve out. Because are you giving detailed explanation? Are you violating anything? Violating ante you have to tell some other method which is not there in IFRS. Sir, is my point clear? So please take care. Giving detailed rules when compared to IFRS is called as carve in. Deviating the rules are called as carve out. And reduction in number of options, neither carve in nor carve out. And change in nomenclature, neither carve in nor carve out. Respond everybody, clear? And my dear children, that is the end of introduction to accounting standards. Only one thing that you need to take care, non-corporate entities are divided into large scale and MSMEs. All the large scale are similar to non-SMCs and all the MSMEs are similar to SMCs. But again in this one more special point is that MSME category 2. If at all the turnover is less than or equal to 50 crores and if at all the borrowings plus public deposits is less than or equal to 10 crores, then along with the non-applicabilities available for MSME category 1, 2 more standards are not applicable, 18 and 28. Is the point clear? Now last and final one more point relating to AS 25 interim financial reporting, AS 14 amalgamation, 21, 23, 27 consolidation. These are generally applicable only for companies and outright generally not applicable for non-corporate entities. But if there are any transactions even in non-corporate entities, then they need to follow. Respond clear? One clarification. Exemptions available for SMCs is different. Exemptions available for MSMEs is different. Rules are same, but applicability of accounting standards are not same. I did not concentrate on this one because it is old only. 17 is fully not applicable. But for MSMEs, 17, 24, 20 and 3, these 4 standards are not applicable. Is it clear? I did not discuss the exemptions available for SMCs, just I discussed the rules ante. Whereas coming to non-corporate entities, I discussed everything. Is it clear? Okay. Sir, we have to complete framework faster because it is easy and frankly speaking, nothing great to discuss except 2 to 3 concepts. Number 1 is components of financial statements. Number 1 is components of financial statements. Ma, what are the components of financial statements? Amma? Balance sheet, P&L account, cash flow statement, SOC and notes to accounts. Is it clear everybody? That shows the position. That shows the performance. That shows activity wise classification. That shows changes in equity and changes in share capital and changes in reserves and surplus. This statement is called as SOC and that shows the additional information. Clear everybody? Nothing great to discuss, but only one thing, liquid position is expected by creditors. Not liquid, I mean to tell, not insolvency position. Liquid position or liquidity position were easily convertible into cash. Obviously, outsiders, creditors, lenders need cash more, so they always expect liquid position. There is some other position called solvency position. Shareholders always need solvency position because they would like to get something called wealth maximization. And apart from these two positions, super position, that is liquidation position or insolvency position. Is my point clear? Likewise, this position, whenever the liabilities are more than assets, or whenever the company is incurring with continuous losses. Hope you have remembered the concept of internal reconstruction. Then internal reconstruction will be generally ordered for. Is it clear? Now moving on to the next thing, elements of financial statements. What are the elements of financial statements, Amma? Assets, liabilities, expenses, incomes and equity. Dash is having residual interest. Residual interest. Correct. Residual interest and remaining interest ani ardham. What do you mean by remaining interest? Assets, liabilities, equity. Sell all the assets. First you have to settle the liabilities. Balance, if any, leftover part, residuary part shall be enjoyed by equity. So Dash is having residuary interest in the entity. Equity is having residuary interest in the entity. And equity is not a liability. Because liability is having dash obligation, present obligation. Equity is not having any present obligation. If at all equity is having present obligation, then you have to repay to equity shareholders faster. Then there will be no company. So take more care. Equity is not a liability. Liability is having dash obligation, present obligation. But equity is not having any present obligation. Equity is having something called residuary interest. Dash or the resources held by the enterprise. Assets or the resources held by the enterprise. Is it clear, everybody? Now coming to the definitions. Assets or rights or resource held by the enterprise arising from the past events, generating the inflows of future economic benefits, and ultimately they are measured reliably. And coming to liabilities, liability is a present obligation which is to be settled by the business enterprise, and where it is generating the outflow of future economic benefits, and ultimately it is measured reliably. What is important feature of asset ante? Control and inflows of future economic benefit. What is the important feature of liability ante? Present obligation and outflows of future economic benefits. And coming to expenses and incomes. Expenses, outflows of economic benefits. Income, inflows of economic benefits. Not future. If you are telling something about future, it will become either asset or liability. If you are telling something about past 1 year, that is called as expense or income. Because only if you have incurred, you will be booking in P&L account. Only when you have earned, you will be booking it in your P&L account. So speaking 1 year past is expense and income. Speaking the future economic benefit is assets and liabilities. Is it clear, everybody? With expense, asset will decrease or liability will increase. With income, asset will increase or liability will decrease. With expense, ultimately equity or capital will decrease. With income, ultimately equity or capital will increase. Respond, everybody. Clear? My dear children, for these rules there is an exception, that is purchase returns, sales returns. Because purchase returns, sales returns, you have to see from the point of view of income and expense. You should not see from the point of view of stock, because stock is an asset. Ardhamainda? If you purchase goods, then it is purchases. Am I correct or wrong? Purchases is nothing but an expense. Am I correct or wrong? If it is for cash, cash will decrease. And asset is getting decreased. If it is for credit, creditor will increase and the liability is increasing. And with expense, asset decreases or liability increases. But problem ekkadostadante, some of the students will be arguing, sir, with purchases stock is increasing kada. And with purchases asset is increasing kada. You are telling asset is decreasing. So is my point clear? But if you have really purchased for cash, cash is also decreasing. Whenever you are purchasing, you are getting stock. Stock is an asset. Asset is increasing. Is my point clear? And hence I told you very clearly that whatever the rules that you have learned for expenses and incomes, you should not consider purchase returns, sales returns from stock point of view. మీకు గుర్తున్నట్లయితే ఇన్ యువర్ ఐపీఈ ఇంటర్మీడియట్ పబ్లిక్ ఎగ్జామినేషన్ పర్చేస్ రిటర్న్ సేల్స్ రిటర్న్స్ యూ విల్ బి లెర్నింగ్ సంథింగ్ కాల్డ్ నామినల్ అకౌంట్స్. బట్ కమింగ్ టు సిఏ ఫౌండేషన్ యూ విల్ బి లెర్నింగ్ ఇట్ లైక్ ఎ రియల్ అకౌంట్. మీకు లేదు కదా, ఎంపీసీ వాళ్ళకు ఉండదు కదరా, నాకు కూడా తెలుసు అది. ఫైన్ సార్, 1 second. సో కంక్లూజన్, విత్ expense asset will decrease or liability will increase. With income asset will increase or liability will decrease. Don't apply this rule from stock point of view. Is it clear everybody? That's it my dear children. These are the elements of financial statements. One more interesting and important thing. Is preference share capital an equity or a liability? Point number 1, now it is not possible to issue irredeemable preference shares. Now it is not possible to issue irredeemable preference shares. So at any cost you have to repay the preference share capital with a maximum period of 20 years. If it is issued for infrastructural facilities, then within a maximum period of 30 years. At any cost you have to repay preference share capital. So frankly speaking, companies having a present obligation. So frankly speaking, it should become a liability. Am I correct or wrong? But take more care my dear children. As per schedule 3, preference share capital has to be shown under equity. Is the point understood? And if at all you have encountered with a question, is preference share capital an equity or a liability? Even though it is satisfying the definition of liability, as per schedule 3, it has to be presented only under equity. Respond everybody, clear? You are supposed to write that statement very clearly. And shall I proceed further? And moving on to the next important concept in framework, that is all about measurement basis. There are 4 types of measurement basis. Historical cost basis, next current cost basis, realizable value basis, present value basis. And with respect to asset is important, liability is not important at all. But let me tell you, even with liability also, concentrate carefully. If you are purchasing an asset, then automatically, if nothing is mentioned, default historical cost basis. Did you remember yesterday S10? 2 models will be there. Cost model okati, revaluation model. If nothing is mentioned, dash model, default cost model. So historical cost of asset is nothing but purchase price plus direct expenses. Current cost, realizable value. Current cost is nothing but market price of similar asset if you would like to purchase or if you would like to replace. Realizable value basis ante market price of same asset if you would like to sell that asset. Sir, I am already holding an asset. I would like to sell this asset. How much ever amount I will get from this asset is called as realizable value. If at all I would like to replace this mobile phone with a new mobile phone, then I have to pay some price kada. That is called as a current cost. And last and final, present value basis. That's very simple. Present value of future economic benefits from using the asset. Say for example, you can use the asset for the next 5 years. For the next 5 years, you can generate some future economic benefits. So bring every future economic benefit to year 0. That is nothing but present value basis. And now coming to the next one, liability. Be careful and listen carefully. Liability, historical cost is nothing but all the gross value of the loan. Say for example, you have applied for a loan of 20 lakhs. Loan sanctioned is 17 lakhs. Is it clear everybody? Loan sanctioned and released is 17 lakhs. Out of which 2 lakhs towards insurance deducted and only 15 lakhs kept in your hand. How much you have to repay? 17 or 15? 17, because they have sanctioned 17 and 2 lakhs deducted towards insurance, 2 lakhs something deducted towards insurance, commission, brokerage, etc. And totally net received is 15 lakh. But historical value of the liability is 17 lakhs. Until you have to repay entire 17 lakhs. Is my point clear, everybody? Now, current cost basis. All of a sudden, if you would like to replace this loan with a new loan, if you would like to replace this loan with a new loan, how much amount you have to apply for is called as current cost basis. Is it clear? And the next one, realizable value basis and chepkudandi, settlement value basis. All of a sudden, if you would like to settle your loan, how much amount you have to pay, that is called a settlement value. If I was not wrong, prepayment penalty gurtunda? No? Prepayment penalty. Sorry. Say for example, how much loan you have taken? 17 lakhs. So do you need to repay that 17 lakh amount or not? Say for example, you have asked the company that you will be paying the same within 10 years. I mean to tell the loan tenure is 10 years. So 17 lakhs has to be repaid over the period of 10 years. But after the completion of 4 years, you would like to repay the loan. And hence, since you are paying prior to the 10 years, banker will be charging some penalty called prepayment penalty. So, settlement value basis and all of a sudden, if you would like to settle the loan, how much amount you have to pay? That is called a settlement value. And finally, present value. Present value of outflows of future economic benefits. Present value of outflows of future economic benefit. Say for example, you have taken a loan. At the end of year 1, you have to pay some EMI. At the end of year 2, you have to pay some EMI. At the end of year 3, you have to pay some EMI. Every EMI has to be brought to the present value, and we will be calling it as present value of outflows of future economic benefits, which is nothing but present value basis. Clear, everybody? Fine. Liability is not more important, but asset is very, very important. Take care. And moving on to the last and final concept, that is called as a capital maintenance. My dear children, there are 3 types of capital maintenance. Amma. What do you mean by capital maintenance? First of all, opening capital is equals to closing capital. Meaning of capital maintenance ante, sir, last year you have run the business. Current year to run the business, at least that of previous year, you should have the amount at least that of previous year. Kada. Last year you have 1 crore amount to run the business. Current year also you would like to run the business. In order to run your business at least like previous year, you should hold the amount at least like previous year. This is called as capital maintain. Ante only if you maintain the capital in the current year at least that of previous year, you can at least run the business similar to the previous year. If your capital is decreasing, then your performance will decrease. So you have to be careful and you have to maintain the capital. The 3 capital maintenance are historical capital maintenance, or it is also called as, frankly speaking, financial capital maintenance at historical cost, financial capital maintenance at current cost, physical capital maintenance at current cost. Under financial capital maintenance at historical cost, opening capital in rupees is equals to closing capital in rupees. Ante, whatever the net profit you have got, that entire amount can be drawn. No? Hey, yes or no? Say for example, you have started your business with 1 lakh rupees by purchasing 10,000 units. So totally you have spent 1 lakh. And during the year you have sold all the 10,000 units at a price of 12. So you are having something like 20,000 is your profit. So opening capital 1 lakh plus 20,000 profit, closing capital is 1.2 lakh. In the next year, your capital should be a minimum of 1 lakh because previous year it is 1 lakh kabatti. And hence you can withdraw how much amount, amma? So your net profit is equal to drawings. Respond everybody, clear. Now concentrate carefully everybody. Sir, you are having 1 lakh. You have purchased 10 rupees units, on a whole you have got 10,000 units. So totally 10 lakh. And frankly speaking, during the year you have sold all the units for 15 rupees ankondi. Until your profit becomes 50,000. So what's your closing capital? 1,50,000. But in the next year, each unit had become 12 rupees. Each unit had become. So my dear children, you have to purchase 10,000 units in the next year by investing 12 rupees per unit, until you should have 1,20,000 this time. You should have an amount of how much, Amma? Last year you are having how much, Amma? But current year you should hold how much, Amma? And you can draw only to a maximum extent of 30,000. And last year your units are 10,000 units. Current year your units are 10,000 units. Respond everybody, clear. So if at all you are concentrating only on amounts 1 lakh, then 50,000 net profit can be withdrawn kada. That is called as financial capital maintenance at historical cost. But if you are concentrating on units, then two types: financial capital maintenance at current cost, physical capital maintenance at current cost. Two things are one and the same, but only difference is that under PCM at CC, you will be using specific price indices. Whereas under financial capital maintenance at current cost, you will be using average price indices. He will be giving you in the question, opening index is 100, closing index is 150. So if you are purchasing 10 rupees unit at the starting of the year, at the end of the year it had become 15. If it is specific price index, then it is PCM at current cost. Say for example, average price index is this one, opening 100, closing 130. So opening 10 rupees, then closing will become 13 rupees. So consider 13 rupees for financial capital maintenance if it is average price index. Is the point clear? Sir, opening capital in rupees is equal to closing capital in rupees, dash maintenance. Opening capital in rupees is equals to closing capital in rupees. This is dash maintenance. Financial capital maintenance at historical cost, or it is also called as historical cost maintenance. And the next one, opening capital in units is equals to closing capital in units. It can be either financial capital maintenance at current cost, physical capital maintenance at current cost. The only difference, FCM at CC will be using average price index, PCM at CC will be using specific price index. Respond everybody, clear? Sir, you will be considering the financial capacity with historical data under financial capital maintenance at historical cost, and you will be considering productive capacity in physical capital maintenance at current cost. Hybrid system between these two things is nothing but financial capital maintenance at current cost. Respond everybody, clear? Hybrid, because FCM at historical cost, PCM at current cost. Two things crossed. FCM at current cost. Units with average index. Respond everybody, clear? My dear children, that is the end of framework, where we have totally completed framework, and now we are about to start accounting standard number 1. Anyways, let us start accounting standard number 1. What is S1 number? Disclosures of accounting policies. What do you mean by accounting policy? What do you mean by accounting policy? Sir, frankly speaking, policy includes two things, principle plus method. Specific accounting principles and methods to follow such specific accounting methods, and we will be calling it as accounting policy. And take care, valuation of inventory, already we have seen yesterday. Valuation of inventory, principle is nothing but cost or fair value, whichever is lower. There are multiple methods for that. FIFO method, weighted average method, standard cost, adjusted selling price, standard cost, latest purchase price, specific identification method, etc. Next one, valuation of inventory. Yes, there are rules for that. If it is long-term investment, it has to be valued at cost price. If it is current investment, it has to be valued at cost or fair value, whichever is lower. And also there are two methods for that, FIFO and weighted average. Is it clear, everybody? So like that, accounting policy includes two things, Amma. Number one is principle. Number two is method. Be careful. Now, if at all any policy is changed, we will be calling it as change in accounting policy. If at all any estimation is changed, we will be calling it as change in accounting estimate. But there is a biggest point, method of depreciation. It is an accounting policy. I already told you while telling S10. But change in method of depreciation is called as change in accounting estimate. Reason is so simple. Method of depreciation, it is having a rule, pattern of generation of future economic benefits. And there are multiple methods for that. So method of depreciation satisfies the definition of accounting policy, and hence it's an accounting policy. But choosing of policy is depending upon the estimation, that is a pattern of generation of future economic benefits. So take care, the policy method of depreciation is actually depending on the estimation of pattern of future economic benefits, and hence change in method of depreciation is called as change in accounting estimate. For this one it will be different. For all the remaining things it is same. If a policy is changed, change in accounting policy. If an estimation is changed, change in accounting estimate. But method of depreciation is an accounting policy, but change in method of depreciation is change in accounting estimate. Respond everybody, clear? And my dear children, moving on to the next thing, how can you choose a policy? It is obviously depending on primary consideration and other major consideration. Primary consideration, you can choose any policy which is representing true and fair view. That is, it should not be either overvalued or it should not be either undervalued. Choose the policy like that. But also you can consider the three principles MPS: materiality, prudence and substance over form. I hope you know about substance over form, reality over legality. We have done many things like less or lessee. Under finance lease, who is the owner for the asset? Lessor. But asset will be recorded in the books of who is using the asset. Is it clear, everybody? This is nothing but substance over form. You need to consider reality over legality. And moving on to the next thing, prudence. Already you know about prudence. Something like anticipate all possible future losses but not gains. You need to recognize the gains only when they realize, only when they accrue, only when they earn. But losses you can recognize upfront and you can create in the form of provision. And moving on to the next thing, materiality. So simple, Amma. Consider significant amounts or what is it called? Material amounts relatively important. Frankly speaking, be careful. Coming to materiality. Materiality of information. If the information is material, disclose. If the information is immaterial, you can ignore. And materiality of items. Some items are always material irrespective of amount involved. Best example is all about fines, penalties, frauds occurred in cash, etc. These are always material irrespective of amount involved. But materiality of amount, if at all the amount is material, then you have to present separately, otherwise you can ignore that. Let me give you some of the examples. Best example, paisa can be ignored. Omission of paisa. Is it clear? Something like, did you remember rounding off? If it is something like 1,93,448.2 crores, you can round off this 0.2 crore. Yes, you can write off, you can round off that 0.2 crore. Yesterday I told you schedule 3. As per schedule 3, what is the material amount? Gurtunda? 1% of turnover or 1 lakh, whichever is higher. Now 193,448.2 crores is your turnover. Into 1% ante something like 1934 crores is your turnover. Ante up to 1934 crores it is immaterial. Is my point clear? Yes, up to 1934 crores it can be immaterial, and hence you can round off this 0.2 crore. Respond everybody, pakka. So omission of paisa can be done, and some items which are satisfying the definition of asset. Say for example, calculator, dustbin. These are the items which are having future economic benefits, which will be used for more than one financial year. But since the amount involved here will be small, you can comfortably treat these as expense. Is it clear? Donation received should be a liability. But if at all donation is small like 10 rupees, no need to consider it as liability. You can comfortably treat it as income. Respond everybody, clear? So that is all about materiality, which is so simple. Now moving on to the next thing, be careful. Disclosure relating to accounting policies. Disclosure relating to accounting policies. Be careful. Point number 1. You have to disclose all the significant accounting policies you have followed. Such disclosure should be form part of financial statements. And point number 3, all the disclosures should not be scattered. They should be only at one place, generally notes to accounts. Last and final, disclosure is not a remedy for inappropriate accounting treatment. Is it clear, everybody? You have to disclose all the significant accounting policies that you have followed. Next one. Such disclosure should be a form part of financial statement. Scatter up should only be at one place. One place, generally notes to accounts. Last and final, disclosure is a remedy or not a remedy. Doing wrong accounting and telling it is our policy, that is not possible. Wages paid for installation of machinery, capitalize a charge. Wages paid for installation of machinery, capitalize a charge. Capitalize, but you are charging and telling that this is our policy. No, it is not possible. Disclosure is not a remedy for inappropriate accounting. Respond everybody, clear? And the last and final one, fundamental accounting assumptions. There are 3 fundamental accounting assumptions: going concern, accrual, and consistency. Going concern, it is said to be that business is having indefinite life period. But what is indefinite life period is not defined in AS1. So as per IAS 1 and as per IGAPS and as per Ind AS, you can consider if business is having a minimum of 12 months, you can consider it as a going concern. Sir, ardhamainda? What is indefinite life period is not defined in AS1. So by taking IAS 1, International Accounting Standard number 1 and Ind AS 1 and as per IGAPS, you can tell if at all the life is more than 12 months, then you can consider that the business concern is having going concern. And the next one, as usual, something like accrual. Recognize incomes as in when earned, recognize expense as in when incurred. Coming to consistency, follow the same accounting policy, don't change the accounting policy. Is it clear? Now, if going concern is there, prepare the books of accounts on historical cost basis. If going concern is not there, you need to follow the realizable value basis. If going concern is there, historical cost basis. If going concern is not there, realizable value basis. If you have remembered, you will be having one problem in AS1. Prepare P&L account and balance sheet by assuming that going concern is there and going concern is not there. Stock, fixed asset, deferred payment penalties. Sir, gurtochinda? I mean to tell stock 30,000 or 42,000, whichever is lower. As per going concern is there. If going concern is not there, realizable value 42,000. Is it clear? And say for example, PPE is 39,000 and the remaining life years is like 5. So 39,000 by 5 whenever going concern is there. But the realizable value of PPE is only 35,000. Then you need to book only 4,000. Listen, let me tell you a bit clearly. PPE in your balance sheet is being shown at 39,000 and given in the adjustment that remaining life period is equal to 5 years. So if going concern is there, you need to book the depreciation something like 39,000 divided by 5 years. 7,800, which is your depreciation. And also given that the realizable value of PPE is 35,000. And now, if going concern is not there, TPA has to be valued at realizable value. And 39,000 should become 35,000. And you need to write off 4,000 and you need to charge the same to P&L account. Respond everybody, clear? Like this, you need to consider each and every asset and liability. If going concern is there, historical cost basis. If going concern is not there, realizable value basis. Say for example, loan also. Loan 5 lakhs is there, which will be repaid after 5 years. If going concern is there, yes, you will be repaying it after 5 years, kada. So you just need to book 5 lakhs only. But if going concern is not there, you have to repay immediately. Now banker is asking to repay immediately, you have to pay 10% prepayment penalty. And how much you have to repay? 5 lakh 50,000. And a 5 lakh loan should become 5 lakh 50,000. Additional 50,000 should be treated as an expense. Sir, ardhamainda? Loan is at 5 lakhs. It has to be repaid after 5 years. Then automatically if going concern is there, continue loan to be shown at 5 lakhs antunna. But if at all going concern is not there, you have to repay the loan immediately. Then banker is asking you to pay a penalty of 50,000. What is the loan amount shown in balance sheet? But to repay, you have to repay 5 lakh. How much extra you have to repay? That is a kind of loss, kada. You have to charge it in P&L account. Is it clear? Say for example, creditor is shown at 9,000. Where you have to repay it after 1 year. Continue to be shown at 99,000 if going concern is there. If going concern is not there, you have to repay the creditor immediately, and creditor is giving you a discount of 1,000 rupees. Is it clear? And 9,000 should become 8,000, and automatically this 1,000 will become gain, and which has to be taken to P&L account. I hope you have enough understood. And if going concern is there, you have to follow dash basis, historical cost basis. If going concern is not there, realizable value basis. And the difference has to be taken to dash account, P&L account. Is it clear, everybody? And if going concern is not followed, you have to disclose. If accrual is not followed, you have to disclose. If consistency is not followed, you have to disclose. If accounting policy is not followed, no need to disclose. If accounting policy is followed, then you have to disclose. But fundamental accounting assumptions law, if followed, no need to disclose. Because it is expected that each and every business concern will be following fundamental accounting assumptions. So if followed, no need to disclose. If you did not follow, then you have to disclose. What you have to disclose, sir? Number 1, fact that going concern is not followed. Fact that accrual is not followed. If not followed, then what did you follow? If going concern is not there, then you have to prepare your books of accounts basing on realizable value basis. Disclose that also. And also, if accrual is not followed, then you will be following cash basis ane kadamma. Disclose even that one also. Respond everybody, clear? Fact that going concern is not followed. Why is it not followed? If going concern is not there, in what basis books of accounts are prepared, you have to disclose. Fact that accrual is not followed. Why is it not followed? If accrual is not followed, we have followed cash basis, and you have to disclose. But very, very important, as per section 129 of Companies Act 2013, it is not possible for a company to follow cash basis. It is mandatory to follow accrual basis. In such a case, company cannot take a stand that I did not follow accrual basis and hence I am disclosing as per AS1 will not make it correct, because accounting standards should not violate statutes or provisions of law. Respond everybody, clear? So a company can follow cash basis and disclosing as per AS1, correct or wrong? Wrong, because for a company it is mandatory to follow accrual. And now last and final, consistency. Sir, you have to follow same accounting policy. Exception, you can change the accounting policy as per AS5 provided if at all the change is permitted by statutes or provisions of law, if at all the change is permitted by an accounting standard, if there is better presentation in the financial statements. Respond everybody, clear? Now very, very important, if consistency is not there, you are supposed to disclose which policy is changed, why is it changed, effect on financial statements, quantification of effect. If you are unable to quantify, disclose the fact. Clear? Likewise, valuation of inventory is changed. Why is it changed? Like for better consumption of, better reflecting the consumption pattern. Jagrata, that word is important. If at all you are changing the method of valuing inventory, generally why did you change ante? Better reflection of consumption pattern. Sir, in exam నాకు ఇది గుర్తుండొచ్చు సార్. రాసా ఈ better presentation of financial statements. Sir, అర్థమైందా? Like which policy is changed? Why is it changed? Is there any effect on financial statements? Yes, then disclose, quantify the effect. If you are unable to quantify, disclose the fact. Due to change in policy, no change in the current year, but there is change in the future years. Disclose the same in the current year only. That even though we have changed the accounting policies, there is no effect of financial statements in the current year, but financial statements do affect in the future years. Respond everybody, clear? So that is the end of accounting standard number 1, where you need to take more care something on disclosures. If accounting policies are followed, you have to disclose, but if fundamental accounting assumptions are not followed, you have to disclose. Respond everybody, clear? Okay, moving on to the next standard, accounting standard number 4. Accounting standard number 4, which is like contingencies and events occurring after balance sheet date. Sir, point number 1, likewise in this standard there are two parts. One is contingency and the other is events. And for your kind information, all the contingencies are generally dealt by accounting standard number 29. Contingent gains outright dealt by accounting standard number 29. But coming to contingent losses, then something like if at all the same is not dealt by any other standard, then it is being dealt by AS4. Is it clear? The same is not dealt by any other standard, then it will be dealt as per AS4. But if at all any contingent loss or contingent gain is dealt by AS29, then the standard won't deal. So to tell you, contingencies and events. First, let me clarify about contingency. As I said, contingent gain outright dealt by AS29. If it is contingent loss, if it is not dealt by any other standard, then it will be dealt as per AS4. Is the point clear? Now coming to events. Events occurring after balance sheet date, or even contingencies occurring after balance sheet date. But you must learn the definition of contingency and events. So first of all, what do you mean by contingency? Contingency is a situation or condition existing on the balance sheet date whose confirmation will be received in future upon happening or non-happening of one or more uncertain future events. This is called as contingency. What is contingency? A situation or condition existing on the balance sheet date whose existence shall be confirmed in future upon happening or non-happening of one or more uncertain future events. Is the point clear, everybody? Now coming to the next one, event. What do you mean by events occurring after balance sheet date? Events which are occurred after the balance sheet date but before the date of approval of financial statements are considered as per accounting standard number 4. And now coming to events occurring after balance sheet date but before the date of approval of financial statements are actually divided into two types. Number 1 is adjusting event. Number 2 is non-adjusting event. Non-adjusting events are events which are not adjusting events or other than adjusting event. But adjusting events are those events which are satisfying the following 3 conditions. And those things are, number 1, there should be some conditions existing on the balance sheet date. The next one, additional evidence occurred to confirm such condition. And last and final, the same should be material. If all these 3 conditions are satisfied, then you will be calling it as adjusting event, and the event has to be adjusted in the previous year balance sheet, and assets and liabilities figures will get altered. Whereas coming to non-adjusting events, it is not to be adjusted in the financial statements at all. They have to be disclosed in the approving authorities report. Approving authority is nothing but for a company, board of directors, for a partnership firm, managing partner. So non-adjusting events are not at all disclosed in the financial statements. Now, be careful, exception. Even non-adjusting events may be adjusted, provided if any of the two conditions are satisfied. Number one, if going concern affects. If going concern affects, automatically it will be dealt as per AS1 and you need to adjust the same in the books of accounts by following realizable value basis. And the second one, if at all law is specifically asking you to adjust, then you need to adjust in the financial statements. Best example, proposed dividend. Frankly speaking, point number one, sir, dividend will be proposed by the board of directors after the financial statements are prepared, and the same shall be declared by the shareholders in annual general meeting after the financial statements are actually audited. Am I correct or wrong? So frankly speaking, declared dividend will become a liability in the next financial year. And by the time when the shareholders are declaring the dividend, since the financial statements were already closed, you cannot adjust it in the previous year financial statements. But proposed dividend, board of directors will be proposing the dividend after checking whether the profits are there or not. So frankly speaking, board of directors will be preparing the dividend once the financial statements are prepared. Is it clear? So board of directors are declaring the dividend after the date of balance sheet, but before the date of approval. Frankly speaking, am I correct or wrong? Or as at the time of approval? As from the, exactly before approving the financial statements, they will be checking whether profit is there or not, and they will be automatically proposing the dividend. Am I correct or wrong? But for your kind information, this is obviously non-adjusting event because there is no additional evidence at all. But for your kind information, proposed dividend has to be adjusted in the financial statements by disclosing the same in note to reserves and surplus. This is very important. If at all a question is being asked from this chapter with respect to this dividend point, students are simply writing dividend, proposed dividend is a non-adjusting event, but it has to be adjusted antunaru. But that is not the correct answer. You must clearly mention that even though proposed dividend is a non-adjusting event, it has to be disclosed in the financial statements. Normally non-adjusting events will not be disclosed in the financial statements. They will be disclosed in the approving authorities report. But in this context, it is mandatory to disclose in the financial statement since it is being asked by law. Since law is asking you to disclose in the financial statements, you obviously need to disclose the same in the financial statements. Respond everybody, clear? Pakha. Fine. There are some things. Number one, sir, negotiations will never amount to conditions. Negotiations confirmed will amount to condition. Negotiations finalized will amount to condition. Negotiations generally will not amount to conditions. Respond everybody, clear? Something like merger, acquisition, reconstruction, all these things are also will not amount to conditions. Respond everybody, clear? Fine, my dear children, frankly speaking, this is the end of accounting standard number 4. And immediately starting with accounting standard number 5. What is accounting standard number 5? Net profit or loss for the period, prior period items and changes in accounting policies. Net profit or loss for the period, prior period item and changes in accounting policies. Be careful, my dear children. First of all the period items are classified into two types. Number 1, ordinary items. Number 2, extraordinary items. And ordinary items are generally no need to disclose, but there are some ordinary items due to their size, due to their nature, due to their incidence and occurrence of transactions, you have to disclose as exceptional items. But the word exceptional item is not given by AS5. The word exceptional item is given as per schedule 3. Is it clear? AS5 is not having exceptional item name, but it is telling some transactions due to its size, nature and incidence of transactions, then the ordinary items have to be disclosed. Is my point clear? Sir, as per AS5, there are only two names: ordinary activities, extraordinary activities, or ordinary items, extraordinary items. But some of the ordinary items have to be disclosed due to their size, nature and incidence of the transactions. Ante. These are called as exceptional items as per schedule 3. Is my point clear, everybody? Fine. And moving on to the next thing, all the salary paid, purchase of goods, sale of goods generally will become ordinary and general. No need to disclose separately. But take care, my dear children. Profit on sale of asset, loss on sale of asset, litigation settlements, valuation of stock at NRV and reversal of NRV, reversal of provisions. Okay, all these things will become exceptional items. Even receipt of government grant is also an exceptional item. Respond, is it clear? And unexpected things happen, like flood occurred, storm occurred, cyclone occurred, and fire occurred and destroyed the stock, machines destroyed, and refund of government grant. All these things actually will be coming under extraordinary items. How to classify whether is it ordinary or extraordinary or exceptional, sir? Point number 1. Is it a part of business and occurring regularly? Then ordinary and general. Part of business but occurring only once in a while. Ordinary and exceptional. You can check out. Litigation settlement is a part of business, but every day you will not be having that. Sale of asset is a part of business, but every day you will not have that. Is it clear? And stock will be generally valued at cost or NRV, whichever is lower. But what is lower in general? Cost price. But sometimes even NRV also lower. So you have to check out. Creation of provision is normal, but reversal of provision is not normal. Yes, that is a part of business, but it happens only once in a while. I hope you have enough understood. So is it a part of business regularly occurring? Ordinary and general. Part of business and occurring once in a while. Ordinary and exceptional. And last and final, it is not at all part of business, but ultimately business gets affected because of that event. Then we will be calling it as extraordinary. Clear, everybody? And my dear children, you are supposed to disclose exceptional items and extraordinary items separately. You need to disclose exceptional items and extraordinary items separately. Be careful. Shall I proceed further? And the next one, prior period items. What are prior period items? Items of expenses or incomes identified in the current year due to errors or omissions committed in the prior periods. Items of expenses or incomes identified in the current year due to dash or dash, errors or omissions committed in the previous period. They will be called as prior period items. Even prior period items are also to be disclosed separately. Clear, everybody? And the next one, changes in accounting estimates, changes in accounting policies. Accounting estimate. Who will estimate? Ante management through their professional judgment by considering the past experience, by considering the present circumstances, by considering the future estimations, they will estimate. Is it clear? So estimations do revise. Estimations do revise. Estimations do change. Estimations will change for sure. Be careful. Change in accounting estimation cannot be called as prior period item. Change in accounting estimate cannot be called as a prior period item. Okay, sir. Then what is change in accounting estimate? Look for the original classification. If original classification is ordinary and general, estimation is also ordinary and general. If original classification is ordinary and exceptional, further classification is also ordinary and exceptional. If original classification is extraordinary, further is also extraordinary. Respond, is it clear? Let me give you an example. Creation of provision for bad debts. Yes, it is revised in the current year, but it is called as ordinary and general. Hey, is my point clear? Now, be careful. Valuation of stock at NRV. Valuation of stock at NRV in the last year. Current year you are estimating and again you are changing that. Reversal of NRV. Valuation of stock at NRV is an exceptional item. So reversal of NRV is also an exceptional item. Is the point understood? So you need to check out whether the original item is ordinary and general, ordinary and exceptional, and extraordinary, and automatically the revised estimate today also will become basing on the original classification. Respond everybody, clear? And if any accounting estimation is changed, you are supposed to give dash effect, prospective effect, and right from today to the future. And the last and final one, changes in accounting policies. Sir, be careful, don't confuse AS1 versus AS5. Follow the same policy consistently is told as per AS1. Yes, you can change the policy whenever it is permitted as per AS5. That is, whenever it is permitted by accounting standard, whenever it is permitted by law, whenever there is a better presentation in the financial statements. Follow the same policy as per AS1. You can change as per AS5, but disclosures are common as per both standards. And which policy is changed? Why is it changed? Effect on financial statements. Quantify the effect. If you are unable to quantify, disclose the fact. Respond clear. And one more point, something like no change in the, due to change in accounting policy, no effect in the current year, but there may be effect in the future years. You have to disclose the fact in the current year. Respond everybody, clear? Okay, and moving on to the next thing, very important. The following are not called as change in accounting policies. Number one, introduction of new accounting policy is never an accounting policy. Never change in accounting policy, sorry. Introduction of new accounting policy is not called as change in accounting policy. And one more thing, you are changing the accounting policy due to the substance of underlying transactions were changed. Even that cannot be called as change in accounting policy. What do you mean by that, sir? Sir, previously transactions happened through VAT. At that time you are having one kind of policies. Now VAT is changed to GST. Obviously your policies will change. Am I correct or wrong? You are changing the policies deliberately? No. Since the underlying transactions were changed, you have to change your policy. Even in this context also, it is not called as change in accounting policy. Respond everybody, clear? Previously no policy, but now new policy is there. It's not called as a change in accounting policy. Whereas you are changing the accounting policy since the underlying transactions were changed. Even that is also not to be called as change in accounting policy. Is it clear? Now the next one. Sir, if there is change in accounting policy, which effect has to be given as per AS5? My dear children, unfortunately as per AS5, no effect is clear. So by following the Ind AS provisions, if any change in accounting policy is there, you have to give retrospective effect. In AS5, what is the effect? Is silent. Change in accounting estimate is the prospective. Change in accounting policy, no specific effect is mentioned, and hence obviously as per Ind AS you need to give dash effect, retrospective effect. Last and final. Sir, management is unable to decide some change is change in accounting estimate or change in accounting policy. Then it is recommended as per accounting standard number 5 to consider it as change in accounting estimate. Is the point clear, everybody? Fine. Be careful. As per accounting standard number 5, every income and every expense has to be routed only through P&L account. And something like, if you have remembered in your foundation, DRI, income from DRI, income from debenture redemption investment should be transferred to DRR and untundi. But that policy is wrong as per AS5. Every income and every expense occurred in that period has to be transferred only to P&L account. If you are not transferring to P&L account, then automatically income is understated and profit is understated. Is it clear? Now be careful. Income received, sorry, not income, amount received from a creditor. No, amount paid to a creditor, Raju, is recorded in Raja account wrongly. Can this be called as prior period item or not? amount paid to a creditor Raju is recorded in Raja account wrongly and identified in the next financial year. Can this be called as prior period item or not? No, this is not called as a prior period item because this is neither income nor an expense. అలా చూస్తున్నారేంటి? AS5, what is the name of AS5? Net profit or loss. So amount received from, amount paid to Raju. What is the journal entry, amma? Raju account debtor to, but wrongly you have written like Raja account debtor to cash or bank account. You have identified in the next financial year. So rectify the journal entry. What is the journal entry? Raju account debtor to Raja account. So is your P&L account affected or not affected? And hence ultimately you should not consider it as prior period item. Is it clear, everybody? One more examination tip, something like purchase of asset. What is its nature? Is it ordinary and general, ordinary and exceptional, or extraordinary? Ordinary and point number 1. Is it relating to the business or not? Is it happening every time or once in a while? And hence it should become, but it is not classified as per AS5 because purchase of asset is not affecting profit or loss. Purchase of asset, what is a journal entry? Asset account debtor to cash or bank account. It is not affecting profit or loss account and hence it will not be classified as per AS5. But sale of asset is classified as per AS5. Reason being, you will be having profit or loss which will be transferred to P&L account and it is treated as an ordinary and exceptional item. Is it clear? One more important thing. What is receipt of government grant? Point number 1. Is it connected to business or not? Yes, it is connected to business. And will it happen every time or once in a while? And hence it is called as ordinary and exceptional. Once the government had given the grant, generally understanding, will it take back? No. Of course, if you did not fulfill the conditions, it will take back. But generally, once if the government had given the grant, it will not take it back. But if at all government is take it back, it is totally unexpected. And hence it is called as extraordinary. Respond everybody, clear? My dear children, this is the end of accounting standard number 5. Please cooperate. This is very important concept I am supposed to tell actually. Sir, concentrate carefully. First of all, change in method of provision. Change in method of valuing provision is always change in accounting estimate. Remember, it's not change in accounting policy. చాలా మంది ఏమనుకుంటారంటే మెథడ్ ఉంది కదా, ఇట్స్ ఎ పాలసీ. నో, change in method of valuing provision is change in accounting estimate because your valuing provision implies automatically you are changing the amount and hence change in method of valuation of provision is always change in accounting estimate. Is it clear, everybody? Hey, be careful, listen carefully and answer. Till last year you have provided provision for bad debts, but in the current year you have decided not to provide provision for bad debts at all. From current year you have decided not to provide provision for bad debts. What is this called as? Change in accounting policy. Be careful. Till last year you are providing provision, but from the current year decided not to provide a provision and you are changing your policy. Is it clear, everybody? Last year your provision for bad debt is 10%. Current year you did not provide the provision since the estimated provision is 0%. This is called as change in accounting estimate. I hope you have got enough clarity. Point number 1, change in method of provision is change in accounting estimate. Sir, Jagrata. Change in method of provision is change in accounting estimate. Change in percentage is nothing but change in accounting estimate. Till last year you are having a provision, but from the current year decided not to provision. This is called as change in accounting policy. Be careful. Till last year, no provision, but you have decided to create a provision from the current year. What is that called as? What is this called as? This is not to be called as change in accounting policy as per AS5. This is called as introduction of new accounting policy. Is the point clear? I hope you are well understood with one different concept. Be careful. That is a concept underlying in that problem. Sir, indaka I have told you different things మీకు గుర్తున్నట్లయితే creditor ఒకటి, loan ఒకటి, asset ఒకటి. 39,000 by 5 years. 39,000 minus 35,000. That is what this problem. Okay. This is very important. Be careful. Even it is being tested in the examination elaborately. And this is another model relating to AS1. This is also being tested elaborately from AS1. He will be giving different situations and he will be asking you to write an accounting policy for that. They will be changing the accounting policy and you need to draft notes to accounts. See here, first one. B Limited has not complied with AS2 and the same is disclosed that we are not following AS2. Disclosure is not a remedy for inappropriate accounting. Like that, multiple things he is clubbing and he is asking you to write some notes to accounts. Is the point clear? So this is also a famous question from AS1. AS4. Provision concept is normal. Now check out. The company closing its accounting year on 30/6/2020. Accounting year closing on 30/6/2020. And the books of accounts were approved somewhere on 20th August 2020. And the boring work which is done on 1/9/2020, they have identified a rocky surface. Is it adjusting or non-adjusting? Adjusting or non-adjusting? Huh? AS4 is not applicable for this. Because AS4 is applicable only for those events and contingencies occurred after the balance sheet date but before the date of approval of financial statements. But this is an event which is occurred after after the date of approval. So AS4 is not applicable. Hope you might have chosen why I am telling these questions. Every point is different. And hence I am telling these questions. Sir, if at all the boring work was done on 1/8/2020. Is it clear? By the time when they have accepted the contract, they don't know that there was a rocky surface. But on 1/8, whenever they are doing the boring work, they found a rocky surface. Is it clear? Now, is it adjusting or non-adjusting? Sir, question clear, huh? By the time when they have accepted the contract, there is no, they don't know that there is rocky surface. But after the date of balance sheet, but before the date of approval of the financial statements, they have identified some rocky surface. Okay, now answer me. And hence they would need to spend an additional amount of 10 lakhs. Now answer me, is it adjusting or non-adjusting event? That is an adjusting event. Why? Sir, management does not know is not a bar as per AS4. AS4 evantundi, there should be a condition existing on the balance sheet date ani maatrame antundi. It is not telling whether that condition is aware to the management or not. They don't care for that. Is the point clear? Sir, what is needed? Existence of condition, awareness of condition. So already they have accepted the contract ante, already rocky surface is there by that time. You did not know that, does not make it non-adjusting event. Respond everybody, clear. So be careful. Already I told you about dividend. If at all dividend is there, obviously it's a kind of non-adjusting event. Frankly speaking, non-adjusting event should be disclosed in approving authorities report. It should not be disclosed in financial statements. Am I correct or wrong? But be careful, proposed dividend has to be disclosed in notes to accounts in the financial statements as per schedule 3. Mandatory to write this point. Is it clear? Next, yeah. And this model is also comprehensive model as per AS4. And he will be asking 4 to 5 points in the same question and he is testing in the examination whether is it adjusting or non-adjusting event. Is it clear everybody? So now moving on to the next one, that is AS5. Sir, let me tell you a small link between AS4 and AS5 with respect to prior period items. Be careful. Year starting, year ending, date of approval of the financial statements. There was an item, expense or income here, but omitted due to error or some sort of omission happened, and that was identified here. If at all, sir, be careful, huh? 11-12 item is identified in 12-13. 11-12 item is identified in 12-13. Is it a prior period item or not? Please participate. Is it a prior period item or not? But that prior period item is identified before the date of approval of financial statements. And hence, as per AS4, this will become an adjusting event because already error or omission happened by the year end. And already there is a transaction at the end of the year, kada, and you have identified here. And the condition is there, further evidence is also there. Is it clear? Something like painter painted the factory and bills were not submitted. Bills are submitted after the end of the year but before the approval of the financial statements. Accountant did not recognize the transaction during the year since the bills were not submitted. Is it clear? Point number 1. Is painted the factory or not? Painter painted or not? Ante already painting expense incurred or not incurred? That is condition existing on the balance sheet date. But unfortunately, you did not record in the previous year since bills were not submitted. And the bills were submitted in future. After the date of balance sheet, before the date of approval of financial statements, which is additional evidence. So if at all a prior period item which is identified after the balance sheet date but before the date of approval of financial statements, that will become an adjusting event. Respond everybody, clear, huh? And hence it has to be adjusted in the previous year financial statements. Here AS4 is applicable. But if at all any prior period item is identified after the date of approval of the financial statements, then AS5 is applicable and you have to rectify the same in the next financial year by disclosing separately. Respond, is it clear? Take more care. And now, sir, dash is a universal standard. And for every standard, dash standard is applicable. AS1 is applicable, also AS4 is applicable. AS4 prakaram, let me tell you one more interesting point, which is the last and final. That is, whether is it adjusting or non-adjusting will be decided as per AS4. If it is adjusting, then you have to adjust as per respective accounting standard. Ardhamainda? Now we have seen contract. During the year, contract is there. But you have identified that rocky surface is there after the date of balance sheet but before the date of approval. So frankly speaking, that is an adjusting event. Now you need to adjust the same in the financial statements as per A7. Is the point clear? Huh? Like that, some negotiations happened, concluded, but amount exchanged later. Adjusting or non-adjusting? Negotiations concluded by the end of the year. Since concluded, it is adjusted. But since negotiations concluded by the end of the year, but the amount, legal things were done after the end of the financial year, but before the date of approval. This is adjusting, am I correct or wrong? And that has to be adjusted as per AS1 with the principle of substance over form. Ardhamainda? During the year, negotiations completed. But the registrations were done after the end of the balance sheet, before the date of approval. Adjusting or non-adjusting? As per AS4. Adjusting. How to adjust? Follow AS1 by principle substance over form. I hope you have understood here. So to decide whether is it adjusting or non-adjusting, you have to follow AS4. If it is to be adjusted, then you have to follow respective accounting standard. Is it clear? Okay. And coming to AS5, frankly speaking, I have discussed even with every example also. AS5 I have discussed every example, but take care, even from AS5 you will be getting a comprehensive question. ఎలా వస్తుందంటే he will be giving some changes altogether and he will be asking whether is it change in accounting policy or change in accounting estimate, or whether is it period item or prior period item, whether is it exceptional item or extraordinary item. Like that he will be discussing, he will be asking a question. So concentrate on this. After this I'm going to give you the break. Introduction to accounting standards. There is an amendment with respect to non-corporate entity to deal whether is it large scale entity or MSME entity. Shall I start now? Zeta Traders is a partnership firm having a turnover of 240 crores and borrowings of 40 crores. It is not a bank, not into insurance business, not a listed entity, not a holding or subsidiary of any other entity. It would like to avail the exemptions available for MSME. Answer, is it large scale entity or MSME entity? MSME entity, and hence it can avail the exemptions available for MSME. ABC and Co, it's a non-company entity, was an MSME in the financial year 2023 and availed certain exemptions. In the next financial year, its turnover exceeded 300 crores. What should ABC and Co do in the financial year 24-25? Large scale MSME. Till the last year it is MSME, but from the next year it will become large scale, and hence it has to follow all the accounting standards. Is it clear? X Limited, a listed non-company entity. Listed non-company entity, turnover 40 crores, borrowing 5 crores. Of course, it's not a bank and not a financial institution. What is the classification? Large scale MSME. Why large scale? Listed, irrespective of the remaining things, because any of the elements were satisfied, it will become large scale. MNO Enterprises, it's an unlisted LLP qualified as an MSME in the financial year 23-24 and chooses not to claim exemption from AS15 but avails relaxations from AS3. What disclosure it has to require in its financial statements? Point number 1, ఇక్కడ మ్యాటర్ ఏంటంటే ఫర్ దిస్ MSME AS15 is partly applicable, AS3 is fully not applicable. The entity had chosen to follow AS15. Hey, is it clear? Not to claim exemption from AS15 and it would like to follow AS15 and it is not following AS3. What it has to disclose? That it is following AS15 and it did not claim the exemption. AS15 I did not claim the exemption. We will be following AS15. AS3, yes, we are still not following AS3. It's so simple, amma. Whichever standards you are not following, disclose. Whichever standards you are following, disclose. There ends the matter. So AS15 is actually not applicable, but it is following kada. Let the same be disclosed. AS3 is not applicable and hence it is not following. Disclose even the same also. Is it clear? Which is there in the general instructions. You revise the general instructions, you will get it. Next one. Ravi Traders is an unlisted partnership firm, turnover 230 crores, borrowing 45 crores. It's not a bank, not a financial institution, not an insurance company, and also not a subsidiary. The firm wishes to avail MSME exemption. Is it possible or not? Yes, because it is not satisfying any of the conditions relating to large scale. Be careful. Last and final one, if I was not wrong. There's an LLP who is having a turnover of 180 crores and borrowing of 55 crores in the financial year. It is not a listed entity, not a financial institution, or even it is not a subsidiary of any entity. Is it large scale or MSME? Why large scale, amma? Borrowings is 55. Hey, last and final, I am giving one more example with point number E. It's an unlisted partnership firm. Turnover 230 crores. Borrowing 45 crores. Not a bank, not a financial institution, not an insurance company. But it is having a subsidiary entity which is large scale entity. So Ravi Traders also will become large scale. Respond everybody, clear. My dear children, this is the end of day 2, session 2, part 1, wherein we have completed actually AS4, AS5, AS1 framework and introduction, and also covered with all the important and typical aspects relating to problematics. Is it clear? We shall try to complete investment accounts. AS17, AS24 is our primary target, and let us also try to complete AS29 if possible. Okay, shall I start now? Fine, my dear children, let me start with investment accounts. Investment accounts or accounting for investment, whatever, which is dealt as per accounting standard number 13. So frankly speaking, coming to accounting standard number 13, the important aspects is all about recognition and measurement. And there are actually two types of recognitions and measurements: initial recognition and measurement, subsequent recognition and measurement. Dash is done for the first time, dash is done at the end of the year. Initial recognition depends on modes of acquisition, subsequent depends on AS10 is actually depending on models, but AS13 is depending on classification. And coming to modes of acquisition, how can you acquire the investments? You can acquire for cash or credit, you can acquire for exchange of assets, you can acquire for issue of securities. And coming to classification, as per AS13, the investments are classified into two parts or two types. Current investments okati, long-term investments okati. Now let us start decoding everything. If something is acquired for cash or credit, it has to be recorded at dash price, cost price, which is nothing but purchase price plus purchase price is nothing but quoted price here. As per AS10 price, which is stated in the invoice. As per AS2 price, which is stated in the invoice. But as per AS13, it is something like quoted price. Quoted price is nothing but price which is quoted in the market. And the quote can be either ex interest price or cum interest price. Is it clear, everybody? Direct expenses are those expenses which are directly relating to purchase or incidental to purchase. And moving on to the next thing, exchange of assets. My dear children, if anything is exchanged for another asset, you will be getting investment and you will be giving your old asset. As usual, this has to be always recorded at book value. Check out whether cash paid or cash received. The same thing, cash paid or cash received, this will not change. This is exactly same, whatever is given in the question. And finally, this has to be recorded at fair value of asset given up. If it is not there, fair value of investment acquired. Even if it is not there, book value of asset given up. Is it clear, everybody? And this is totally similar to the provision that was learnt in AS10 with respect to existence of commercial substance. Here no sort of telling like if no commercial substance, that concept itself will not arise at all. Respond, is it clear? So this is what exchange of assets. And the next one, issue of securities. Again same, you are getting investment and you are issuing securities which can be either equity shares or preference shares or even debentures or bonds. This always shall be recorded with face value. This time it has to be recorded with fair value of securities issued. The difference will be nothing but securities premium. Is it clear, everybody? And for your kind information, my dear children, if fair value of securities is not available, then there will be no securities premium. It will be recorded with face value of securities issued. Respond, is this part understood? The next one, subsequent recognition and measurement. Coming to subsequent recognition and measurement. Subsequent recognition and measurement law, it is actually depending on classification, and the investments are classified into two types. Number one, current investment, long-term investment. Long-term investments or investments which are other than current investments. What are current investments? Two conditions should satisfy. Number one, the intention to hold is for less than or equal to 12 months and there should be readily realizable. intention to hold should be less than or equal to 12 months, and also it must be readily realizable. Only when these two conditions are satisfied, we will be calling it as current investment. Now, my dear children, what is a link between initial and subsequent recognition? At the time of purchase, it can be any type of investment. You will be recording on the basis of modes of acquisition. It can be current investment, it can be long-term investment. You will be recording basing on the modes of acquisition. And after recording the investment, immediately after recording, okay, after recording the investment, be careful, immediately you have to classify whether is it current investment or long-term investment. It is actually depending on something called intention. You have purchased an investment, let the business concern check out their intention. If their intention is to hold for more than 12 months, then let it be like long-term investment. If their intention is less than 12 months and if it is readily realizable, then it will be called as current investment. Is it clear? Purchase the investment, record the journal entry, immediately classify whether is it long-term or current and keep it aside. Now go to the end of the year. Identify all the current investments and long-term investment and apply the valuation rule. Current investment has to be recorded at cost or fair value, whichever is lower, whereas long-term investment has to be recorded at cost price. Exception, if there is a decline in fair value, if there is decline in value which is other than temporary, which is nothing but permanent decline, then automatically you need to record it at dash price, fair value. Is it clear? A long-term has to be recorded at dash price, cost price. Exception, if there is a decline which is other than temporary, and the meaning is like a permanent decline, then you need to record it at dash value, fair value. Respond everybody, clear? Pakka. So now quickly answer, my dear children. Long-term investment has to be valued at dash price. Temporary fluctuations, ignore. For long-term investments, temporary fluctuations should be recorded or should not be recorded. Temporary increase should not be recorded. Temporary decrease should not be recorded. Conclusion, temporary fluctuations has to be ignored. Permanent increase, ignore. Permanent decrease, consider, and you have to record it absolutely at fair value. Up to this clear, everybody? Sir, current investment has to be valued at cost or fair value, whichever is lower. Long term has to be valued at exception, if there is a other than temporary decline value, then you need to record it at, which implies that permanent increase is considered ignored. Temporary fluctuations are considered ignored. Up to this clear, everybody? Very, very important. Whether is it current investment or long-term investment, if there is a permanent increase, whether is it current or long-term, if there is a permanent increase after permanent decrease, then you can consider the same and reverse the loss up to cost price. More than cost you should not do it, but up to cost price you can do it. Respond everybody, clear? This is the end of valuation of investments. I mean to tell recognition and measurement of investments. Now, there is some things to discuss which is like forms of investments. You can invest either in securities, or you can either invest either in bullion, or you can also either invest in property. You can also invest in others like cryptocurrency market, fixed deposits, etc. But this is not specifically dealt by this standard. This standard actually concentrated only on these things. Now securities is nothing but equity shares, preference shares, debentures, bonds, government securities, etc. Bullion is nothing but gold and silver. Now property, this is important. Also we have discussed yesterday in accounting standard number 10. So investment in property is applicable only for land and building other than substantial use. Other than substantial use, it should not be used for administration purpose. It should not be occupied for its business purpose, and you have to use it for your investment purpose. Is it clear, everybody? Now the next question, what do you mean by investment purpose, sir? To learn this, you must know the definition of investment. What do you mean by an investment, Amma? Investment is an asset which is held by an enterprise which is generating either return or capital appreciation or other benefits like control or significant influence or etc. Is it clear? So now you have to hold land and building either to generate some rent from it or to get some capital appreciation, but you should not use it forever. Understood? So now coming to this one, such kind of, sir, please be careful. All the tangible assets are divided into two parts. Other than land and buildings, land and buildings. Other than land and buildings, AS10 is applicable. For land and buildings, two parts. If it is used for business purpose or administration purpose, AS10 is applicable. If it is used for investment purpose, that is either for the purpose of rent or capital appreciation, then AS13 is fully applicable, and AS10 is partly applicable only up to cost model. Revaluation model is not applicable. Respond everybody, clear? One more very important point, Amma. Investments held as stock in trade. Did you remember we have discussed in AS? 2. Investments held as stock in trade is excluded from the definition of investment, and also it is given under non-applicability of AS2. So conclusion ఏమంటే, for investments held in stock in trade, AS13 is not applicable, AS2 is not applicable. Then what are applicable, Amma? Guidance note are applicable. As per guidance note, you have to value the investments held as stock in trade at valuation of current investment rule, that is cost or fair value, whichever is lower. Respond everybody, clear? So now telling you some more thing, the order of applicability. First of all, check out whether accounting standard is there. If yes, that is applicable. If there is no accounting standard, you have to check the guidance note, then that is applicable. If there is no guidance note, then you need to check out industrial norms, and for specific industry there will be rules and regulations, that is applicable. Even if industrial norms are not there, then you need to follow IGAAPs, Indian generally accepted accounting principles. Clear everybody? So this is the order of applicability, and anyways my dear children, this is what the definition of investments and valuation, recognition and measurement of investments. Shall I proceed further? Now very important thing, that is all about what is it called, reclassification. Be careful. Sir, when will you reclassify? Whenever your intention is changed, you will be reclassifying. Initially, by the time when you have purchased, you are thinking that you will be holding it for lesser than or 12 months and treating it as current investments. Or initially you thought of like you will be holding for more than 12 months and treated it as long-term investment. But if at all your intentions are changed, then current investment will be reclassified to long-term investment, or long-term investment can also be reclassified into current investment. This is technically called as transfer of investments as per AS13. Is it clear everybody? Reclassification of investments is nothing but transfer of investments as per accounting standard number 13. Now, sir, be careful. Generally, you have to value the investments only in these three situations. Number 1, initial recognition and measurement. Number 2, subsequent recognition and measurement. Number 2, as on the date of reclassification. Is it clear? You can value the investments only in three situations. Number 1, initial recognition and measurement. Number 2, subsequent recognition and measurement. Number 3, date of reclassification. Only on these three times you need to value the investments. Other than this, you can't value the investments. Anyways, as on the date of reclassification, if current is forwarded or changed to long-term investment, then this has to be revalued or reclassified at cost or fair value, whichever is lower. If long-term is revalued to current investments, as at the date of reclassification, it has to be reclassified to cost or book value, whichever is lower. Respond everybody, clear? Now, the difference between the book value and reclassified value, or the difference between initial measurement and subsequent measurement, will obviously be transferred to P&L account either as profit or as loss. Respond everybody, clear? Difference between initial measurement and subsequent measurement, or difference between book value and reclassified value, will be transferred to P&L account either as profit or as loss. Respond everybody, clear? My dear children, these are the rules and regulations with respect to investment accounts, that is AS 13. One more important provision where you need to remember for sure. Current investment has to be valued at cost or fair value, whichever is lower. Long-term investment has to be valued at, but if there is a permanent decline, then you need to record it at. Am I correct or wrong? Sir, please concentrate carefully and answer. Say for example, there is an inventory where the inventory cost price is equal to 100 and fair value is equal to 80. So you need to value it at cost or NRV, whichever is lower. So you need to value it at 80. Hey, yes or no? Option 1, closing stock 80. Option 2, closing stock in trading account recorded at 100. And 2, provision for diminution in the value of inventory, you are recording 20. Hey, is my point clear? Now tell me which option is correct. Option 1 or option 2? Option or both? As per S2, which option is correct? How many of you vote for option 1? Yeah, raise your hands. Option 2? Less. Both? Mar remaining aim chesaru? Oh, sorry, you started sleeping. Fine. To tell you, as per S2, both the options are correct. As per AS2, both the options are correct. But Jagrata, as per AS 13, you can't write off directly the investment to P&L account. It is mandatory to create provision for diminution in the value of investment. Sir, Arthamainda, as per AS2, directly writing off to P&L account is correct. And creation of provision is also correct. But as per AS 13, you cannot directly transfer to P&L account. It's mandatory to you to create a provision for diminution in the value of investments. Respond everybody, clear? So please be careful. As per AS 13, PFDI creation is mandatory. Now, moving on to the next thing. So, my dear children, all the rules relating to accounting standard number 13 were completed. And now let me continue with the problematic related section. Now, coming to the problematic related section, coming to debentures or bonds or government securities or what is it called? Fixed income bearing securities, except preference shares. Because preference shares, even though there is fixed income, they will not be actively traded. So, fixed income bearing securities for the purpose of AS 13 is limited only to any other securities except preference shares. In this context, is the interest fixed or not? So, please respond, is the interest portion fixed or not? So, you just always need to remember one important thing. X interest price plus interest is equals to cum interest price. Hey, what is the notation, my dear children? X interest price plus interest is equals to cum interest price, and you have to compute the interest for break up period. What do you mean by break up period? Ante last date of interest to date of transaction is called as break up period. Is it clear? So take care, ma. Interest is to be computed for breakup period, which is nothing but last date of interest to date of transaction, or it can also be called as date of transfer, like one person transferring to another person. Is it clear? Now, very important, my dear children. X interest price ante without adding interest, cum interest price ante with adding interest. Be careful, X interest price is called either as cost price or selling price, whereas come interest price is called either as payment or as receipt. Difference is there, be careful. So, while checking the profits or loss, you always need to consider dash price, amma, X interest price. While checking the profits or losses, you always need to check out X interest price. But what is a total receipt or what is a total payment ante? You need to consider come interest price. Is the point clear, everybody? Because come interest price is including interest, and hence it will be nothing but receipt or payment. But take more care, my dear children. I mean to tell, like to check profits or loss, you always need to consider X interest price. Now one more important thing, you need to compute direct expense. Say brokerage 5%, 0.5%. Like that, you have to compute direct expense on X interest price or come interest price. On quoted price. You can't tell it is to be computed on X price, come price, nothing like that. Whatever is given in the question, you have to compute on that. So if at all come interest price is given, add direct expense on come interest price. And then you need to deduct interest. And then you are going to get X interest price. If at all X interest price is given, you have to compute direct expense on that. Then you have to add interest for that. Then you are going to get come interest price. Respond, everybody, clear? In a single shot, X interest price plus interest is equals to come interest price. Check out what is given in the question. The other will become balancing figure. And interest is computed for breakup period, last date of interest to date of transaction or transfer. And if X interest price is given, come will become balancing figure. If come is given, X will become balancing figure. And direct expense is always to be computed on the quoted price, which can be either X interest price or it can be either come interest price also. Respond, everybody, clear? So now one more important thing, amma, direct expense has to be added if it is purchases and direct expense has to be deducted if it is sales. I hope even this is also absolutely clear. And my dear children, this is the end of investment in debentures, but we are having some special cases to discuss. Please concentrate carefully. If at all date of interest is equals to date of transaction, then breakup period is equal to total period. If date of transaction is exactly a day after date of interest, then breakup period is equal to 0. I hope you have understood. Say for example, due dates are 31/3 and 30th September. What are the due dates? Sir, good morning. Due dates, what are the due dates, Amma? 31st March and 30th September. You are actually selling the investment on 30th 9. So what is the breakup period? 6 months is the breakup period, because last date of interest to date of transaction. My date of transaction is 39. Last date of interest under 31/3 kada. Is it clear? And next, say for example, if the transaction is 1/4, then date of transaction is 1/4, but last date of interest under 31/3. What is the breakup period here? 0. I hope you have clearly understood. If date of transaction is exactly a day after date of interest, breakup period is 0, which implies that come interest price is equals to X interest price. And if at all date of interest is equal to date of transaction, then breakup period will become the total period. And if at all breakup period is 0, then come is equal to X. But breakup period, some period is there. But in the question, he did not give the quote. Is my point clear? Some breakup period is there, but in the question he did not give the quote whether is it X or come. In such a case, you need to consider it as X interest price. If no quote is given, you need to consider it as X interest price. Respond, everybody, clear? This is one more important thing that could be appreciated. And yeah, next one. Be careful. Interest shall be received by the holder of debentures for the total period. I hope it's clear for you. Interest will be received by the holder of debenture for the total period. Say for example, interest dates are 31/3 and 39. Mr. A had purchased a debenture somewhere on 1/8. Is it clear? Frankly speaking, he is the holder from 1/8 to 39. Ante 2 months. Hey, yes or no? So frankly speaking, company has to give how many months interest to him, Amma? 2 months. But company will give the interest for total period until 6 months. Respond. Don't think that undue advantage is gained by Mr. A, because Mr. A at the time of purchasing, he is already paying 4 months interest to somebody else. Is the logic understood? So now interest is received by holder of debentures for the total period. Don't forget. Shall I proceed further? And here is the investment account in debentures format. Investment in so and so debentures or bonds or government securities, whatever. Take care. Particulars. If you want, you can write number, or if you want, you can write face value. Then interest, then amount, and of course date. Replicate the same columns even at credit side also. I mean to tell, like date, particulars, number or face value, interest, amount. Now, very, very important, take care. If opening balance is there, fill everything. Closing balance is obviously credit side, fill everything. Now, very, very important. If at all your opening balance date and date of interest or differ, then you need to book something called accrued interest. Okay, is my point understood? If at all closing dates are differing from date of interest. Okay, is my point clear? Again same, say for example, here the due dates are 39 and 31/3. These are due dates of paying the interest. But you are closing your books of accounts somewhere on 31/12. You are closing your books of accounts somewhere on 31/12. You have already received the interest on 39, correct or wrong? You will receive in future interest on 31/3 once again. Am I correct or wrong? Check out. You have already received the interest on 39 and again you will be receiving the interest on 31/3. So frankly speaking, my closing date is 31/12, wherein 3 months is completed. Interest accrued but not due. Concept gurtochinda? Because interest will become due only on the due date. Before the due date, it will not be due. After the due date, it is called as overdue. Is the concept clear? Expense will become due on the due date. After due date, overdue. Before due date, not due. So now 39 to 31/3, 6 months interest will be paid by the company on 31/3. But you are preparing your books of accounts somewhere on 31/12. So now answer me. Is it due or not due? Answer. Not due. But accrued or not? Did you earn 3 months interest or not? So that is your asset. Is the point understood? That is your asset. So interest accrued but not due. You will get this concept when your closing date is actually differing from the date of interest. Respond everybody, clear? So if any accrued interest is there, then you need to book even accrued interest also. Next one, if any purchases are there, debit side. If any sales are there, credit side. Very important. How many number or face value purchased, book here. Interest for breakup period, you need to book here. Very important. Amount column, you always need to account only for X interest price. By sales, same number, interest for the breakup period, X interest price. But whenever you are selling, you will be having either profit or loss. You need to book even profit or loss in investment account. You need to book profit or loss in investment account. So be careful, to P&L account which is representing profit by P&L account which is representing loss. Reverse. Because P&L account lo debit side kada, loss. If profit, what is a journal entry? Profit has to be credited kada. With what you will credit the same? Investment. So what is the journal entry, amma? Investment account debtor to P&L account with profit. Is my point everybody clear? Now the last and final one more thing, very very important, interest. So you just need to book the interest. You need to just book the interest, something like by cash or bank account. In interest column for the which period? Breakup period. By cash or bank ante you are receiving the interest from the company for total period. Is the concept clear everybody? Sir, please be careful. Whatever purchases breakup period here you are writing, that is called as pre-acquisition interest. Priya kada? Because you are purchasing now and you are paying 4 months interest. Is that your interest or not your interest? Ayyo. You are purchasing after 4 months from K amma. Who is the holder for the first 4 months? But now you are purchasing. Say Mr. A is purchasing. So A has to pay 4 months interest to K. Am I correct or wrong? Is that A's interest or not A's interest? It's not A's interest. It's whose interest, amma? And hence he is paying, yes or no? This is called as pre-acquisition interest. Is it clear everybody? And A, at the end of 6th month, he will be receiving the total interest for 6 months. So he will be receiving the total interest for 6 months, already paid pre-acquisition interest for 4 months. Finally, he is left with post-acquisition interest for 2 months, which has to be transferred to P&L account. Is it clear? So total interest balancing figure, whatever is there, it has to be transferred to P&L account. Respond everybody, clear? This is the end of investment in debentures account format. And one more important thing, that the last and final part has to be valued at cost or fair value, whichever is lower. Because all the problematic parts are considered as if they are current investments. All the problematic parts, every investment is considered as a current investment, and hence it has to be recorded at cost or fair value, whichever is lower. If it is recorded at cost price, absolutely no problem. But if it is recorded at fair value, then the difference has to be transferred to P&L account. Respond everybody, clear up to this part? Pakka? Quickly answer me. Purchase will be posted at dash side of the account, debit side. Sale will be posted at credit side. Sir, okka nimisham. And pre-acquisition interest will be posted at debit side. Post-acquisition interest will be posted at credit side. Because at the time of purchase you will be getting pre. At the time of selling you will be getting post. And you will be receiving total interest from the company. The balancing figure of interest has to be transferred to P&L account. And you will be posting accrued interest only if date of interest is differing from date of transaction. Closing date, amma. Accrued interest will be booked if the closing date is differing from the date of interest. Respond everybody, clear? And the closing time, it has to be recorded at cost or fair value, whichever is lower. Understood? Amma, I don't know why you're listening partly, you're listening totally, I don't know. And I hope you have understood this account format. కానీ తప్పులు చెప్తున్నారు. Purchase will be at dash side, amma. Sale will be at dash side, amma. Opening will be at, closing will be at. Accrued interest you will be booking when dash and dash or differ. Closing date and date of, and at the time of purchasing you will be paying dash, pre-acquisition interest. At the time of sale you will be receiving dash, post-acquisition interest. From the company you will be receiving dash, total interest. Finally, interest balancing figure has to be transferred to. I hope it's clear for you. Closing has to be valued at cost or fair value, whichever is lower, because you need to consider that Every investment is current investments for the purpose of problems. Respond clear. If it is recorded at cost price, again no problem. But if at all there is a difference between cost price and fair value, that has to be transferred to P&L account. Cheppandi clear. And now the last and final part relating to investment in debentures. How to find profit or loss? How to find profit or loss? Selling price minus cost price. So please concentrate carefully. Profit or loss is equal to selling price minus cost price. Selling price is nothing but X interest price. Is it clear? But how to find the cost price ante? There will be multiple number of debentures. So to find the cost price of multiple number of debentures, you need to follow either FIFO basis or weighted average basis. If it is FIFO basis, then again it is normal. First in, first out you have to consider. But if it is weighted average method, then you have to follow weighted average price first. What is weighted average price, sir? My dear children, remember, weighted average price always changes only with purchases. Weighted average price changes only with. So by the moment of selling every time, no need to consider the sale in the context of computing weighted average price. Sir, ardhamainda? Weighted average price is nothing but total cost price divided by total number of debentures. Total cost price divided by total number of debentures. You are going to get weighted average price, and hence comfortably you can ignore dash transactions in computing weighted average price, sale transactions, and finally find the weighted average price. Respond everybody clear. Generally in all our problems we will compute weighted average price only once. That is applicable for all the transactions. In all our problems, aim jarugutundante, he will be giving opening balance. He will be giving purchases. He will be giving purchases. He will be giving sale and then closing balance. Respond clear. Huh? With this weighted average price will change. With this weighted average price will change. With this also weighted average price will change. With this and this, weighted average price will not change. Is it clear? Huh? So whatever the weighted average price that you have computed by considering these three, you can use the same for sale. Also you can use the same for closing balance. Respond everybody clear. Huh? My dear children, be careful. If at all, the question is modified like this. Opening balance, purchases, sale, purchases, closing balance. Now, with this weighted average price will change. With this weighted average price will change. With this it will not change. With this it will change. With this it will not change. Ante, for sale you have to use one weighted average price. For closing stock you have to use another weighted average price. Is it clear? In all our materials it will be like this. In all the institute questions also it will be like this. But if at all like this, if the question is modified, then you have to compute weighted average price 2 times. And for sale you have to compute separately. For closing stock also you need to compute separately. Respond everybody clear. My dear children, investment in debentures is completed. Now let me start with investment in equity shares. Sir, this is so simple. Equity shareholders will get the return in 3 types. Number 1, dividend. Number 2, bonus. Number 3, rights. Sir, no concept of doing X dividend price plus dividend is equal to come dividend price. X bonus price plus bonus is equal to come bonus. X right plus right is equal to come right. Such concept not needed here. Is it clear everybody? Sir, be careful. Identify what is a type of dividend. Is it pre-acquisition dividend, post-acquisition dividend? Already since you have learned something called consolidation, you will be learning the meanings of pre and post. Pre-acquisition dividend ante dividend which is declared out of pre-acquisition profits. Post-acquisition dividend ante dividend which is declared out of post-acquisition profits. Up to this clear? But take care, my dear children, in this context of investment accounts, it is not like that. And It's not like that, Kada. It is like that only. But to identify, you are having simple technique. Shall I start now? If you are receiving the dividend for holding period, then it is called as post-acquisition dividend. If you are receiving the dividend for non-holding period, it is called as pre-acquisition dividend. Clear, everybody? To tell you again, dividend is of two types. Interim dividend, final dividend. Interim dividend will be received on the shares that are there till that point. Interim dividend will be received on all the shares that are there till that point. And interim dividend is always post acquisition dividend. Is it clear, everybody? Final dividend ante dividend which is received for the previous year in the current year and simply after the completion of the year. So concentrate carefully, everybody. In 12-13 you are having 5,000 shares. In 13-14 you have purchased 2,000 more shares. If at all interim dividend is declared at this point of time, you will receive the dividend on how many shares? 7,000. If interim dividend is declared at this point, on how many shares you will receive? 5,000. If at all, be very, very careful, my dear children. Final dividend is declared at this point. You will receive on how many shares? Kadu, you will receive on entire 7,000 shares. Because dividend will be paid by the company to the holder of shares. By the time when the dividend is declared, you are having how many shares? By the time when dividend is declared, you are holding how many shares? So you will be getting dividend on entire 7,000 shares. Is it clear? But this is dash dividend, amma. Cheppali, dash dividend. Final dividend ante 12-13 dividend declared in 13-14. Am I correct or wrong? In 12-13 you are holding how many? And you have received the dividend in 13-14 for 5,000. So this dividend on 5,000 is called as post acquisition dividend. But in 2012-13 you are not holding this 2,000 shares, but you are getting dividend on 2,000 shares in 13-14 for 12-13. Holding or not holding? Pre or post? Pre-acquisition. Is the concept clear? Is concept. But in examination, who cares about concept? Yes or no? So conclusion, on opening balance, it is called as post-acquisition dividend. On current year purchases, it is called as pre-acquisition dividend, provided if it is a final dividend. If it is interim dividend, it is always treated as post-acquisition dividend. Very, very important. On bonus issue and rights issue, you will be getting interim dividend, but you will not be getting final dividend. On dash and dash, bonus and rights, you will be getting dash dividend, interim dividend, but you will not be getting final dividend. Respond, everybody, clear? Up to this, absolutely understood. Now some other clarification, as I have come across with some of the students with respect to the investment exam. In one of the questions given in investment exams, it's an RTP problem. In that RTP problem, it was given that no dividend is to be given on bonus and rights. Is the point clear? In that problem, there was a statement given, no dividend should be given on bonus and rights. The meaning of no dividend should be given on bonus and rights, it is only final dividend, but every shareholder will be getting interim dividend. Is the concept understood? But in that RTP problem solution, he did not give even interim dividend also. But that is wrong. Sir, em cheppano ardhamainda? No dividend is to be given on bonus and rights ante. It means that no final dividend, but you have to give interim dividend. You are having similar line even in our material also. Their dividend means only final dividend, but interim dividend can be given. Is this point clear? Hey, everybody pakka. Sir, chala jagratta, please concentrate. Normally, I told you one thing, if you have remembered, like weighted average price changes only with purchases, it will not change with sale. But in this context, it is very, very different, a very peculiar case where sale has to be considered. Only then your weighted average price is correct, otherwise it is wrong. Sir, is my point clear? First of all, what happened in all our materials? Again, same opening balance of equity shares, purchases, and then bonus, and then rights, and then sale, and then closing stock. Hey, respond yes or no. So now, frankly speaking, your weighted average price changes with purchase, bonus, rights, but it will not change with sale and closing stock. Find the weighted average price once and apply the same for both sales and closing stock. Is my point clear, everybody? But if at all the question is like this, opening balance, sale, and then bonus. Sir, is my point clear? Opening balance, purchases, sale, and then bonus. Is it clear? And then something like closing stock. In this context, obviously, your weighted average price changes because there is something called bonus issue. If at all bonus is issued before sale, then obviously it will not change. But if at all bonus is issued after sale, then obviously it will change. Why? Cost of bonus shares is 0, but number of shares will increase, kada? In this context, you cannot simply do like cost price of opening balance plus cost price of purchases plus 0 towards bonus divided by number of opening balance shares plus number of purchased shares plus number of bonus shares. If you have done like that, it is wrong. Sir, ardhamainda? Why this is wrong ante already some of the shares were sold kada. So you can't apportion the total bonus shares on the total cost price. In this case, what you are supposed to do? Deduct the sale portion and start computing the weighted average price. Sir, em cheppano ardhamainda? I have told you specifically because this was given in your weekend revision examinations. Meeku gurtundo ledo, these two things were given in your revision examinations. Ante in your main examination already I told you the gameplay will be with the existing questions only, but he'll do minute modifications. Akkade dorikpotaru. But please do take more care, that should not happen. Hey, respond everybody, understood? Sir, be careful. With all our material knowledge, you will be computing weighted average price only once. That could be done. But take more care in these two situations, where situation number 1, there are 1 purchase, 1 sale and 1 purchase. Then automatically your weighted average price will change. You have to compute 2 times. And next one, very important, be careful. And something like, what is it called? Bonus issue. If at all bonus issue is done after sale, your weighted average price is different. Bonus issue is given at before sale, your weighted average price is different. Sir, ardhamainda? If bonus issue is given before sale, normally not a big deal. But if bonus issue is given after sale, then you need to consider only the available number of equity shares and then you need to compute the weighted average price. Respond everybody, clear? My dear children, dividend is completed. Now coming to bonus issue, it's very simple. Cost of bonus issue is 0. But weighted average price will change with bonus issue. Reason being, cost of bonus is 0, but number of shares will increase. And hence, bonus issue will not be recorded in books of accounts, but this will be posted in investment account number column or face value column you have to post. Respond everybody, understood? The next one, last and final, rights issue. There are 3 options for rights issue to the shareholders. Number 1, subscribe. Number 2, renounce. Number 3, ignore. If he ignore, you also ignore. Because no accounting treatment for that at all. If at all he is subscribing, then the same has to be posted in investment account debit side similar to purchase. If at all you are renouncing, then that has to be recorded in P&L account credit side as an income from sale of rights. Up to this clear, everybody? Now, special situation. What is that special situation, sir? So simple, amma. Be careful, my dear children. Sale of rights. Generally, it has to be transferred to P&L account as income. But in the following case, where you are purchasing the shares on cum rights basis, and after that shares had become X rights, and price had fell down, this is representing some loss. And if you are having sale of rights, you can set off this income with this loss. Is my point clear, everybody? Say for example, you are purchasing shares on cum rights price by paying 1 lakh. After becoming X right, the price fell down to 75,000. How much loss is there? Keep this loss as 25,000 and then check out whether did you sell any rights or not. If not there, this loss no need to touch at all. Just it will continue to be shown in investment accounts. Understood? But if at all sale of rights is there to the extent of 30,000, then set off 25,000 with sale of rights and remaining 5,000 sale of rights will be transferred to P&L account. Is it clear? So just concentrate on the account how it will be. To cash or bank, you are purchasing shares on cum rights basis by paying 1 lakh. After becoming X right, it had become 75,000. How much loss is there? Sepali. Don't do anything. Keep it like that only. Because you have to revalue the investments only in 3 situations. Initial recognition, subsequent recognition, reclassification. Not at the time of rights. So even though X rights price is 75,000, don't do anything. Keep it like that. Shall I proceed? Now, very important, amma. If at all you are having sale of rights and you have sold it for 30,000, what is the journal entry? Cash or bank account debtor to sale of rights account 30,000. Now close sale of rights 30,000 to set off this loss of 25,000 by transferring it to investment account. And remaining 5,000 will be transferred to P&L account. Clear? If at all sale of rights are not there, don't do anything. It will be like that only. Sir, sale of rights exactly 25,000 is there. Set off and nothing will be transferred to P&L account. Sir, if sale of rights only 20,000 is there, you can set off only up to 20,000. Remaining 5,000 will be like that only. Cheppandi, clear? Last and final. Weighted average price of debentures is equal to total cost price divided by total number of debentures. But weighted average price of equity shares is equal to total cost price minus pre-acquisition dividend. Don't forget. Pre-acquisition dividend and dividend which is received on non-holding period. And opening balance a current year purchase. Cheppali. Current year purchase relating to final dividend. Because interim is always post. Dash is always post. Interim is Cheppalamma. Dash is always post. Interim is always post. Final current year purchases will become 3. Such kind of dividend has to be deducted. And very important, minus sale of rights special condition is satisfied. Special sale of rights is generally to be transferred to P&L account. But special condition ante to set off the loss. Shares are purchased on cum rights basis. After that they have become X right. And finally sale of rights income is there. Hey, is it clear? Shares are purchased on cum rights. After that they have become X rights. Decrease in value is there representing loss. On the other hand, you are having sale of rights income. Set off this income with that loss. Is it clear? Divided by total number of equity shares. Is it clear, everybody? Now, some special conditions. Point number 1. You may need to compute weighted average price for debentures 2 times if at all purchases is there after sale. And weighted average price of equity shares, you may need to deduct the sale number and cost price of sales provided if at all there is bonus issue after sale. I hope it is absolutely clear. Sir, ఈ లాస్ట్ పాయింట్ అర్థమైందా? బోనస్ ఇష్యూ ఆఫ్టర్ సేల్. ఈజ్ దట్ పాయింట్ క్లియర్ ఎవ్రీబడి? సే ఫర్ ఎగ్జాంపుల్, ప్రీవియస్లీ 1 lakh shares are there, purchased at 10 lakhs, bonus issue given 1 lakh, అంటే ఏమవుతుంది? 10 lakhs divided by 2 lakhs. బోనస్ ఇష్యూ ఎగ్జిస్టింగ్, weighted average price అంటే 10 lakhs by 2 lakhs కదా, where you will be getting 5 rupees. Originally it is 10 rupees. Is my point clear? Now concentrate. Existing 1 lakh, 10 lakhs. Now sale. Like say for example, you have sold 20,000 debentures, 20,000 equity shares costing 2 lakhs. And the balance, how many are there, amma? 80,000 equity shares valuing at 8 lakhs. Now this time you have got a bonus of 1 lakh equity shares where cost is 0. Is it clear? Now you are supposed to do 8 lakhs divided by 1,80,000. Respond everybody, clear? And automatically the price will differ kada. So take more care, amma. If at all bonus is given with the existing share and then sale is there, your weighted average price is different. But bonus is given after sale, then your weighted average price is different. Respond everybody. Is the concept clearly understood? And my dear children, that is the end of phase 13. Investment accounts is totally completed, and let us start with AS 17 and AS 24. Of course, these two things will not take more time at all. Hardly, if I was not wrong, 2 things could be completed just within a span of 20 minutes. Because 24 is very small. Is it clear? And 17 is also small. Max 20 to 30 minutes will be completing these 2 things in this session for sure. Is it clear? Let us start with AS 17 and AS 24. And be careful, in AS 24, I am going to tell you one advanced point also. Advanced and mari advanced and kadu, it's there in our material. Provision is there, but problem is not there. But we can't take risk for the main examination. And anyways, let me start with something called accounting standard number 17. What is accounting standard number 17? Segment reporting. And segments, there are 2 types of segments. Number 1 is business segment, number 2 is geographical segment. Again, geographical segments 2 types: location of assets and location of customers. This is all about dealing with products or services. And location of assets ante you are having a physical branch. Location of customer ante you are just exporting the goods. Is it clear, everybody? And now moving on to the next thing. Listen, amma, whether it is segment income or segment expense, inclusions, direct revenue, inter-segment revenue and allocable revenue, or direct expense, inter-segment expense or allocable expense, and what are all excluded. One more important thing, these items should be from operating and ordinary. So what are excluded ante? All the operating revenue or operating expense is included. So if it is financing expense, it is excluded. If it is investing expense, it is excluded. If it is financing income, it is excluded. If it is investing income, it is excluded. And all the ordinary were included here, and hence all the extraordinary has to be excluded. And all the allocable were included, and hence all the unallocable will be excluded. And very important, tax expense is also excluded. Because tax is something which will be paid by the enterprise but not by the particular segment. Respond everybody, clear? Now very important, be careful. Interest expense. Sir, is interest expense to be included in segment expense or not to be included in segment expense? Interest expense include in segment expense or not to be included? Not to be included, because interest expense is a finance expense and hence it has to be excluded. Exception: in the following 2 situations you have to include. Situation number 1, if at all the segment itself is financial in nature, banking segment, financial institution, then automatically you need to include interest in the segment expense. Ante kada? Because for bank interest is operating. For bank interest is operating. If the segment is of financial or investing in nature, then interest will be included in the segment expense. Is this point clear? Now, point number 2, this is important, take care. Say for example, you have taken a loan in order to manufacture inventory. An inventory satisfies the definition of qualifying asset. And hence, on this loan, whatever the borrowing cost, that is interest expense is there, it is added to the inventory value. It is added to the cost of production of inventory. And cost of production is segment expense. Am I correct or wrong? And indirectly in this context, interest is also a part of segment expense. Understood? You have borrowed a loan and you are paying some borrowing cost on that. You have utilized this loan for producing an inventory. Inventory had satisfied the definition of qualifying asset. And hence borrowing cost has to be capitalized and it has to be added to the cost of production. Up to this clear, everybody? Next, what is cost of production? Operating, financing, investing? Operating, and hence this will be included in the segment expense. Whenever this cost of production is included in the segment expense, indirectly borrowing cost is also included in the segment expense. Is it clear? This has to be disclosed separately as per accounting standard number 17. Up to this clear, everybody? Now next one, segment asset, segment liability. Sir, for segment expense and segment income, I told you all the operating and ordinary will be included. For segment assets and segment liabilities, all those assets which are used for operating purpose, all the liabilities which are arising in operating purpose will be included. Remaining all common. Ante direct asset, inter-segment asset, allocable asset. Direct liability, inter-segment liability, allocable liability. And exclusions are also common. If at all asset or liability is used for investing or financing purpose, then that should not be considered. Is it clear? Unallocable should not be considered. Tax items should not be considered. Is it clear? Tax asset ante? Tax asset, will it be a part of segment asset or not? Tax liability, will it be a part of segment liability? Tell me the example of tax asset. Deferred tax asset. Idokkate agipotaru jagratta. Tax expense does not mean only deferred tax asset amma. It can be deferred tax asset, it can be advance tax, it can also be TDS receivable. These three things will not be included. Sir, did you remember there is one question relating to A, B, C segments? In segments, there are some segment DTA. Let me remind you. A company is operating in 3 segments. A, 5 crores, B, 3 crores, C, 2 crores. In the total segment assets, deferred tax asset is included. Gurtochinda? A company is operating in 3 segments, namely A, B and C. And the segment assets of these companies are 5, 3, 2. And in this segment assets, DTA is included. And after deducting DTA, you will be getting 8.8. For segment assets test, you need to check out 8.8 into 10%, where you will be getting 0.88. Gurtostunda? Sorry, adanta akkarledu. At least one thing, 532 is included as segment assets. And say for example, DTA included in each segment is 1, 1.5, 0.5 ankondi. Respond. So total segment asset should include DTA, should not include DTA. 5 minus 1, 3 minus 1.5, 2 minus 0.5. So total segment assets 5 plus 3 plus 2, 10 correct. 4 plus 1.5 plus 1.5, 7 correct. And hence you need to apply 10 into 10% segment asset test, 7 into 10% segment asset test. Because DTA will not be included. Am I correct or wrong? Okay. Now this is an institute material question. In your main examination, same question copy paste. He will change TDS receivable antadu. Same, but you have to think that segment assets also does not include any tax asset. It can be either DTA or it can be either advance tax, TDS receivable. Clear everybody? And coming to segment liability, of course tax liabilities are not included. Say for example DTL, TDS payable, even provision for tax also. Even current tax or provision for tax, even that is also not included. Respond everybody, clear? Now be careful, concentrate and answer. Say for example, company had taken a loan of 1 lakh. With this loan, it is investing in machinery to the extent of 1 lakh. And machinery is used for the purpose of producing inventory. Is it clear everybody? And cost of inventory spent is 2 lakh. Now, chalu. ఏం చేస్తున్నారా? Now, can this loan be treated as segment liability? Can this asset be treated as segment asset? Can this inventory cost be treated as segment expense? Question అర్థమైందా? Answer చెప్పండి. Point number 1. Is this 2 lakh segment expense or not? Is it good doubt? Obviously yes. Because this is operating and ordinary. Machine. A machine is an investing activity kada. But you should not check the activity. You have to check out the usage. Since the machine is used for producing inventory and the machine is used for operating purpose and hence it is segment asset. What about loan? Loan. Why no? Hey, with loan you are investing in a machinery and machinery is ultimately for operating purpose and a loan is for operating purpose kada. Sir, అర్థమైందా? Sir, answer me first of all. You have taken a loan for working capital purpose. Is this loan a segment liability or not? Of course, yes. Loan is a financing activity, but you should not check the activity. You are using the loan for operating purpose and hence it's a segment liability. Clear everybody? Now tell me here in this context. Loan is used to purchase a machine. Machine is used for operating purpose. So ultimately loan is used for operating purpose and hence it is called a segment liability. Correct or wrong? Wrong. Because you should not see the ultimate purpose. అలా అయితే ultimate purpose everything is operating only. అంతే కదా? So here loan is used for dash purpose amma, investing purpose and hence it is not included in the segment liability. Respond everybody, clear? Last and final concept that I am dealing with AS 17 and AS 17 disclosures I am not dealing at all. And AS 17 very important concept, tests for reportable segments. Test 1, segment revenue test. Segment revenue test is equal to, segment revenue should be greater than or equal to 10% of total segment revenue. Test number 2, segment assets test. Segment assets should be greater than or equal to 10% of total segment asset. Test number 3, segment result test. Segment result should be greater than or equal to 10% of total segment result, where total segment result is nothing but total segment profits or total segment losses, whichever is higher. Test number 4 is management discretion, that is their wish, no need to bother at all. And last and final test number 5. What is test number 5? Overall external revenue test. What is this test, sir? whatever the reportable segments that you have chosen, they should satisfy greater than or equal to 75% of enterprise revenue. If they are not satisfying more than 75% condition, add some more segments so that the external revenue should become more than 75%. Respond everybody, clear? And what are reportable segments in the current year ante? Those segments which satisfy test number 1, test 2, test 3, test 4, test 5 of current year and test number 1, test number 2, test number 3 of last year. అర్థమైందా? అంటే ఈవెన్ ఇఫ్ at all a segment is not satisfying any of the tests in current year but satisfied test 1, 2 and 3 of previous year, then even that is to be reported in the current year. In the current year, what are reportable segments? It can satisfy either 1, 2, 3, 4, 5 of current year or 1, 2, 3 of previous year. Any of these tests are satisfied, then you need to treat that as a reportable segment. Clear everybody? And indirectly how many tests are there annattamma? 8 tests are there. Current year test 1, current year test 2, current year 3, current year 4, current year 5, last year 1, last year 2, last year 3. Respond clear? Any of these segments is satisfied, then you obviously need to report the same in the current year. Respond everybody, clear? Shall I proceed further? And the next standard, AS 24. What is AS 24, amma? Discontinuing operations. Two important things in discontinuing operations. Number 1 is definition. Number 2 is examples that are not discontinuing operation. Shall I start now? My dear children, as per accounting standard number 24, you should not tell that stopping an operation is discontinuing operation. Is my point clear, everybody? As per AS 24, you should not tell that stopping an operation is discontinuing operation. Very, very important to make it as a discontinuing operation. An operation which is discontinued through single or overall formal plan, through single or overall formal plan, where it should include either sale or intention to sell. And sale can be either done in its entirety or piecemeal. Clear everybody? Sir, point understood? Now the next one. Sir, what do you mean by operation? What is the segment as per AS 17? The same is operation as per AS 24. But 17 principles 17 way, 24 principles 24 way. Meaning is one and the same. Sir, Jagrata, control as per AS 21. Okay, control as per law or same, but law, Companies Act is Companies Act, AS 21 is AS 21. Alane segment as per AS 17 is exactly equal to operation as per AS 24, but 17 principles 17 way, 24 principles 24 way. Respond everybody, clear? Now tell me, what is a discontinuing operation? And participate. An operation which is discontinued either through single or overall formal plan. In that plan, there should be either sale or intention to sell. Clear everybody? Sale can be again in its entirety or piecemeal. Entirety ante normal sale avvachu, it can be either demerger avvachu, it can be either spin off. Spin off ante transferring the ownership from company to the shareholders. Simply to tell you, company is selling its company to the shareholder anamata. Who is selling? Company is selling its company to whom, amma? Shareholder. It is called as dash, amma, spin off, or it can be either demerger or it can be either sale. General sale. Piecemeal ante, hope you know that. Piecemeal is nothing but individually selling the assets and settling the liabilities. Intention to sell ante termination through abandonment. As of now, we have stopped the operation. As of now, we have stopped the operation and stopped the production. but we are not selling it immediately, but we are having intention to sell that. Selling immediately or not selling immediately? Not selling immediately, but we are having intention to sell that. Respond everybody, clear? And which is nothing but discontinuing operation. And very, very important, amma, the following are not to be considered as discontinuing operation. Number 1, what is that called, amma? Discontinuing several products or services of a particular operation is not called as a discontinuing operation. Number 2, discontinuing all of a sudden, relatively abruptly an operation does not mean that they are discontinuing operation. Let me tell you an example. Say for example, there is stationery division. In stationery division, you are producing pens, pencils, scales, erasers. You have stopped immediately producing eraser. Can you tell that it is a discontinuing operation? No, because the division is being continued, kada. Is it clear? Now, example number 2. Already you have seen many examples in that. There is cold cream and vanishing cream. There is passenger car vehicle segment and there is commercial car vehicle segment. There is cold cream segment, vanishing cream segment. There is passenger car vehicle segment, commercial car vehicle segment. Another question. There is dishwashing bar segment and there is cloth washing bar segment. Now, company has decided to stop one segment, but it is not having any sale or intention to sell. It will divert the production to another segment. Is it clear? Even this case also, it is not to be treated as discontinuing operation. Clear, everybody? Stopping several products or services individually cannot be called as discontinuing operation. Stopping a segment or stopping an operation with a view to divert its production to another segment is also not called as a discontinuing operation. Shall I proceed further? Next one, shifting of one location to another location. From one location to another location, if you are shifting, then it is also not called as a discontinuing operation. And moving on to the next thing, Amma. You are closing an operation in order to achieve cost efficiency or productive efficiency. Cost reduction or productive efficiency. If you are closing an operation, then that is also not considered discontinuing operation. In this connection, you are having a question also. Did you remember process 1? Process 2, process 3, and you will be getting a finished good. Over the period of time, the company had found that cost of process 1 is 10% higher than direct purchase and hence decided to close process 1. Can this be called as a discontinuing operation? No. Why no? You have closed in order to achieve cost reduction and productivity efficiency and hence it is not at all called as a discontinuing operation. Clear, everybody? A last and final, very, very important. Selling of subsidiary which are in same line of business with respect to consolidated financial statements. Is my point clear? Selling of subsidiary which are in same line of business, and the holding is also in textile business, subsidiary is also in textile business. While preparing CFS, it needs to consider the data of holding and subsidiary company, but it had sold subsidiary company. Is it clear, everybody? It had sold investment in subsidiary company. It doesn't mean that it is a discontinuing operation. Reason being, holding is also in textile, subsidiary is also in textile. Say for example, holding is in textile, subsidiary is in beauty care. Now holding company is selling subsidiary company which is in beauty care, and indirectly this is called as a discontinuing operation because you are selling your beauty care segment. Sir, logic understood? My dear children, this is what your AS 24 discontinuing operation. Of course, disclosures are there. And also even initial disclosure event. Did you remember? Initial disclosure event. Sir, you are telling it is a discontinuing operation. Yes, Babu, it's a discontinuing operation. Then when I have to start disclosing about the discontinuing operation? Whenever initial disclosure event occurred, from that financial year you have to show. Sir, అర్థమైందా? Yes, it's a discontinuing operation. I have to start disclosing about the discontinuing operation. When I have to start disclosing, sir? Start disclosing when initial disclosure event occurred. What is initial disclosure event, sir? Date of binding sale agreement or date of formulation, approval and announcement of detailed formal plan, whichever is earlier. What is date of binding sale agreement, sir? Date of signing the agreement or date of fixation of terms and conditions, whichever is earlier. What is date of FAA, sir? Date of formulation or date of approval or date of announcement, whichever is later. Jagratta. Initial disclosure event. What is initial disclosure event? Date of binding sale agreement or date of formulation, approval and announcement, whichever is earlier. What is date of binding sale agreement? Date of signing the agreement or date of confirmation or fixation of terms and conditions, whichever is earlier. Inception of lease గుర్తుందా? AS 19. సరే నేను చెప్తా తర్వాత. దిస్ ఇస్ సిమిలర్ టు ఇన్సెప్షన్ ఆఫ్ లీజ్ కండిషన్ ఓన్లీ. నౌ కమింగ్ టు డేట్ ఆఫ్ ఫార్ములేషన్, అప్రూవల్ అండ్ అనౌన్స్మెంట్. 3 థింగ్స్ షుడ్ కంప్లీట్ అమ్మా, ఏదో ఒకటైతే అవ్వదు. ఆల్ ది 3 థింగ్స్ షుడ్ కంప్లీట్. సో డేట్ ఆఫ్ ఫార్ములేషన్, డేట్ ఆఫ్ అప్రూవల్, డేట్ ఆఫ్ అనౌన్స్మెంట్, విచ్ ఎవర్ ఈజ్ లేటర్ హ్యాస్ టు బి కన్సిడర్డ్. Respond, is it clear? It's my duty to tell, so please spare for 10 more minutes. I'll be leaving you. First point, as I said, there is little bit advanced point, so please concentrate. If at all in an year it is a discontinuing operation, then you have to restate that this operation is discontinuing operation even in previous year column of current year while presenting it for comparison purpose. Meaning అర్థమైందా? Sir, in current year you will be presenting current year data and previous year data. Am I correct or wrong? If in current year any operation is discontinued, originally in the previous year, even though it's a continuing operation, while presenting in previous year column of current year, you have to treat as if it is discontinued operation. Concept అర్థమైందా? Sure kada? Now check out the example, you will better understand. You are having 3 operations, 1, 2 and 3. In the current year, all the 3 operations are being run in year 1. In year 2, you have decided, let us close operation 3. How this has to be presented? In year 1, you will be telling that 1, 2 and 3 are continuing operations only. But in year 2, you will be presenting year 2 data and year 1 data also. 3 operations are there kada? In year 2, operation 1 is continuing, operation 2 is continuing, but operation 3 is discontinuing. So while presenting year 1 information in year 2, you need to present 1, 2 are continuing, but 3 is discontinuing. అర్థమైందా? But what is originally operation 3 in year 1? But while restating, you have to make it as a discontinuing. Logic is so simple. You have to do the same for comparison. You are telling user that, hey, operation 3 is discontinued. Okay, fine. Then as per AS 24, you need to separate disclosure, separate presentation for continuing and discontinuing operations kada. Then automatically operation 3, you are telling that if it is discontinued in the current year, you have to present the comparative figures of previous year as if it is discontinued. But originally in year 1 it is continued. But in year 2, while presenting in year 1 column, you need to treat it as discontinuing operation. Is this point clear, everybody? Fine, my dear children. In this session, actually, we have completed AS 13, AS 17, AS 24. Frankly speaking, AS 24, there are only 2 CRDs. That is cold cream and vanishing cream problem. So no need to discuss the specific problems relating to that. And AS13 is obviously problematic. I have told you the peculiar aspects where you have to be careful. So not even discussing separately problematic relating to AS13, because I told you while telling the class itself. Now AS17. I have one last point to discuss in AS17. Amma. AS17. You're very lucky. It's exactly we had got that. Concentrate on this. Identify the reportable segments. I hope you have known this example, but be careful. I'm concentrating this example in order to give a clarification with respect to overall external revenue test. Start everybody. What is test number 1, Amma? Segment revenue test. Sir, segment revenue ante, please concentrate, my dear children. Do you need to concentrate on A1, A2, A3? A3 is total, Nana. A1 is external. A2 is intersegment. A3 is total. You need to concentrate on dash now. A3, that is total. So total, what is segment revenue test? Segment revenue should be greater than or equal to 10% of total segment revenue. Total segment revenue is 600 into 10% and 60. If you observe A, S, B, C, D, E, F, G, H. And ultimately A and B are reportable segment as per segment revenue test. Now moving on to the next one, segment assets test. Segment assets should be greater than or equal to 10% of total segment assets. Total segment assets is 100 into 10% and start telling A, B, C, D, E, F, G, H. Ultimately dash or reportable segments. A, B and D are reportable segments. Is it clear? Segment result test, Amma. What is segment result test, Amma? Segment result should be greater than or equal to 10% of total segment result. But total segment result ante total segment profit or total segment losses, whichever is total segment profits. 5, 15, 8, 5, 7, 40. Total segment losses 95, 5. So you need to consider 100 into 10% and you need to concentrate on 10. Start everybody. A, B, C, D, E, F, G, H. So that is segment result test. So management discretion not there. Be careful with the last and final one. Overall external revenue test. As of now, what are the reportable segments to me, Amma? A, B, C, D. You need to concentrate on dash revenue in test 5. External revenue or total revenue? External revenue on point number 1. That is 250 plus 255 plus 15 plus 10. Total entama? 280. It should be greater than or equal to 75% of the enterprise revenue. Enterprise revenue ante external also internal. Enterprise anna external anna same amma. Enterprise ante entity. Intersegment should not be considered. So it is also again 400. Is the point clear? External anna, enterprise anna same. So 400 into 75%. 300 you have to report. But how much you are reporting? 280. So minimum you have to report 20. Yes or no? Shortage minimum enta. So you need to pick a minimum of 20. So check out what to pick. E, F, G, H. Picking F is the best answer. Meeru exact 20 you are concentrating, but minimum 20 antunam kada. Hey, is it clear? So if you are picking F, it will become 50. 280 plus 50. 330. Is 330 greater than or equal to 300 or not? And hence F is the best option. Sir, I will write G. Is there any wrong? No, that's correct. But F is best. Sir, Even you pick H, that is correct. If you pick E, is it correct or wrong? That may be correct, but along with E, again you have to pick one more segment. Is my point clear? And my dear children, that is the end of AS 17 and AS 24 and also investment accounts. Fine, let us start amalgamation of companies, which is guided by accounting standard number 14. And damn sure you are going to get a question from this topic, that too for 14 marks. And what is the heart of amalgamation is all about PC. If you have got PC, entire amalgamation is actually over. And coming to amalgamation, frankly speaking, there are three types in general whenever we speak. One is like merger, and the next one is like absorption, and the next one is like external reconstruction. Merger is nothing but two companies are forming into a single company, where we will call it as merger. Absorption is nothing but one company acquiring another company. External reconstruction is nothing but the management of the old company will be floating a new company, and the company will be transferred to the new company. The management of old company will be forming a new company, and then the old company will be transferred to the new company, which is called as external reconstruction. Frankly to tell you, reconstruction is of two types. Whenever a company is incurring with continuous losses, or whenever a company is over capitalized, or whenever a company's fictitious assets are more, then immediately you can do something called reconstruction. There are two types of reconstruction. One is internal reconstruction, the other is external reconstruction. Internal reconstruction is nothing but the same company will be continuing, but you will be doing lots and lots of reconstruction. External reconstruction, there will be no that company, management of that old company will be starting a new company with lots and lots of modifications. So external reconstruction will be treated at par with amalgamation. Internal reconstruction is separately dealt. Respond, is my point clear? So now moving on to the three things as we said. Number one, merger, absorption, and external reconstruction. For your kind information, my dear children, as per accounting standard number 14, no merger, no absorption, no external reconstruction. AS 14 is classifying that two types of amalgamations. Number one is amalgamation in the nature of merger and amalgamation in the nature of purchase. And AS 14 is actually telling 5 conditions to become a merger. If all the 5 conditions are satisfied, all the 5 conditions are satisfied, it is amalgamation in the nature of merger. If any of the 5 conditions are not satisfied, then it will be treated as amalgamation in the nature of purchase. Now what are the 5 conditions? So simple. All the assets and liabilities of old company should become assets and liabilities of new company. Old and new, my intention is like old is like transferor company, new is like transferee company. Old is like selling company, new is like purchasing company. So all the assets and liabilities of old company should become assets and liabilities of new company, and such transfer should be made at book values only. And if assets and liabilities at whatever values you are having in old company, at the same value you need to transfer the same even in the new company also. Is it clear, everybody? And the next one, 90% of the equity shareholding, shareholders holding 90% of the equity share capital should accept for the amalgamation, and the consideration should be given only in equity shares. Last but not least, whatever the business of transferor company is there, transferee company should continue the same business. Respond, everybody, clear? So all these are the 5 conditions which are so simple. Take more care, my dear children. Number 1, assets and liabilities of old company should become assets and liabilities of new company. And the next one, such transfer should be made at book values. Shareholders holding 90% of the equity shareholding should accept for the amalgamation. And condition number 4, consideration to such people must be discharged only in equity shares. Last and final, business of transferor company should be continued by transferee company. Up to this clear, everybody? Now, 3 special things that you need to learn. Number 1, with condition number 2. Sir, transfer of such assets and liabilities must be made at dash value, amma. But in order to maintain the uniformity in accounting policies, you can change the book value. You might have learnt this in consolidation. Gurtunda, uniformity in accounting policies. But that is applicable not only for consolidation, even for amalgamation also. Let me tell you, say for example, transferor company is valuing its stock by following FIFO basis. Whereas transferee company is valuing its stock at weighted average basis. And transferee company is acquiring transferor company. And automatically at the time of acquisition, stock of transferor company is at dash basis, FIFO basis. How can it add the value of stock on the FIFO basis directly to the weighted average basis? Is it correct or wrong? Correct or wrong? And hence, stock of transferor company has to be revalued by considering weighted average basis. Respond everybody, clear? Huh? And my dear children, that's the reason. So be very, very careful. Concept here is all about, in order to maintain the uniformity in accounting policies, can you alter the book values or not? Yes, you can alter the book values. Is it clear? Shareholders holding 90% of the equity shareholding. Shareholders holding 90% of equity share capital had to accept for the amalgamation, and the consideration should be discharged in equity shares only. Exception: if any fractional shares are there, instead of equity shares, you can also give cash. Is it clear? Let me give you an example. There are totally 1 lakh equity shares, where the exchange ratio is 3:5. And for every 5 shares, 3 shares are given. Is it clear? And yeah, 1 second, let me modify. Say for example, there are 98,513 equity shares where the exchanges happened in 3:5. Is it clear? So how many shares you will get, amma? 98,513 multiplied by 3/5. 59,107.8. So obviously you have to give 59,107 shares, and since you cannot give 0.8 share, for this 0.8 share you have to give cash. Is my point clear, everybody? Everybody will be doing if the problem is like this, but take care, there are 1 lakh equity shares this time. And the share exchange ratio is 3:5. Mr. A is holding 32 shares, Mr. B is holding 48 shares, Mr. C is holding 9 shares, and all the others, how much? 2 plus 8, 10, 1 second, 47, and this total 79, okay, 6 shares. Remaining 32 plus 47 plus 6, 85. 1 lakh minus 85, 915. So remaining people are holding 99,915 shares. Is it clear, everybody? Now my question is all about, for how many shares you have to give cash? Question clear? Huh? Is the question clear? Answer. Is the everything exchange happens? Is the exchange happens only in shares, or even you have to give cash? This is the question, amma. You have to give PC, amma. How many shares you have to give towards PC? And for how many shares you have to pay cash? Fine, not taking much of your time, and I'm telling you the answer. Actually, you will be thinking something like 1 lakh shares into 3/5. then you will be getting an exact multiple to the extent of 5, which is nothing but 60,000 equity shares. You may be thinking why to give cash. But the biggest point is that Mr. A is holding 32 shares. So for your kind information, 32 into 3 by 5, 19.2. So next one, B is holding 47 shares. 47 into 3 by 5, 0.2. And C is holding 6 shares. 6 into 3 by 5, 3.6. Which implies that for Mr. A, you have to give 0.2 cash. For Mr. B, you have to give 0.2 cash. For Mr. C, you have to give 0.6 cash. Is it understood, everybody? So on total, 0.2 plus 0.2 plus 0.6, which comes to 1 share, for which you have to pay cash. And all the remaining 59,999, you can comfortably give equity shares. Ardhamainda? You told the total multiple is 60,000 kada. Out of 60,000, you have to pay 1 share towards cash. 0.2 cash towards A, 0.2 share cash towards cash to B, 0.6 share towards cash to Mr. C. And balance 59,999 equity shares can be comfortably given to every party. Respond, everybody understood. And be careful, fractional shares in the sense not only sometimes in the gross values, even in individual figures also they might change. Shall I proceed further? And moving on to the next thing, one more exception. The business of transfer or company should be continued by transferee company. Business of old company should be continued by new company. But if it is not continuing at the same point of time, at least there should be an intention to continue. Respond, everybody, clear? So transferee company should continue the business of transferor company. If it is not continuing immediately, there should be at least intention to continue. Up to this clear, everybody? Now, one more important thing, concentrate and tell me the answer. Say for example, business of transferor company, and the balance sheet is given like this. Assets 1 lakh, liabilities 20,000, share capital 80,000. Sorry. Share capital 20,000, liabilities 81,000, and there is some other asset called discount on issue of debentures, which is 1,000. Is the point clear? Now, transferee company is taking the business of transferor company in the nature of merger. Is it clear? Except discount on issue of debentures. Point clear? How is this possible? Perfect. Sir, question ardhamainda? Likewise, frankly speaking, if it is amalgamation in the nature of merger, every asset and every liability should be taken by the new company. But now the new company is telling it would like to acquire the company in the nature of merger, but it would not like to take discount on issue of debentures. Is the point clear? Frankly speaking, it is not amalgamation in the nature of merger because one asset is not being taken, but clearly telling that it should be exchanged in the nature of merger only. In this situation, what are you supposed to do is all about adjust the assets and liabilities which were not taken by the transferee company towards the reserves and surplus. Is it clear? Whenever you are adjusting discount on issue of debentures towards reserves and surplus, automatically this will become 0. Sir, ardhamainda? And hence transferee company will be taking the remaining things. Is it clear? Sir, to make it better understanding, one more example. Likewise, balance sheet of transferor company. Fixed assets 1 lakh, debtors 60,000, other current assets 9,000, discount on issue of debentures 2,000. What's the total? 1 lakh 71,000, and share capital 70,000, reserves and surplus 60,000, and other liabilities which should be Clear everybody? Now the business of transferor company should be taken by transferee company and it should be amalgamation in the nature of merger. But highness is all about transferee company is not taking debtors and discount on issue of debentures. Is it clear? Transferee company is not taking debtors and discount on issue of debentures. Frankly speaking, if one asset is not taken, is it amalgamation in the nature of merger or purchase? Purchase. But in examination, the same question is given and asking you to solve in the nature of merger. Then how are you supposed to solve? Answer is so simple. First of all, you have to assume that the debtors were realized. Assume that debtors were realized. And hence, total debtors will be added to cash. And other current assets including cash will become 69,000 and debtors will become 0. Discount on issue of debentures is also not wanted to be taken by transferee company kada. So adjust this discount on debentures to reserves and surplus. So discount on issue of debentures should be closed by transferring it to reserves and surplus. So reserves and surplus account debtor to discount on issue of debentures account. This will become 58,000. Now this is the balance sheet. Now this balance sheet is taken by the transferee company. Now tell me, all the assets are taken or not? All the liabilities were taken or not? At book values or not? And hence this is amalgamation in the nature of merger. Respond everybody, clear. Sometimes these kind of things also might happen. Be careful. And my dear children, this is what amalgamation in the nature of merger. If any of these conditions are not satisfied, then it will become amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, you are supposed to use pooling of interest method. If it is amalgamation in the nature of purchase, you need to use purchase method. Merger aithe dash method amma, pooling of interest method. Purchase aithe dash method amma, purchase method. Up to this clear everybody? Now, whenever we speak about amalgamation, there will be two parties. Number one is transferor company. Number two is transferee company. Who is transferring its business amma? To whom it is being transferred? And who has to give PC to whom? Transferee company has to give PC to transferor company. Who has to close its books of accounts? Who has to incorporate its books of accounts? Clear everybody? And transferor company, to close its books of accounts, it has to follow IGAAPs, Indian Generally Accepted Accounting Principles, and in that you are supposed to use liquidation proceedings. What is the concept you are supposed to use, Amma? Liquidation proceedings. That is nothing but closing and transferring to realization account. Whereas coming to transferee company, it has to follow accounting standard number 14. And as per AS 14, there are two types of amalgamations for transferee company. Amalgamation in the nature of merger, amalgamation in the nature of purchase. If it is merger, transferee company is supposed to use pooling of interest method. If it is purchase, the transferee company is supposed to use purchase method. Respond everybody, clear up to this concept? Now, let me start with closing the books of accounts of transferor company. But before that, we have to complete with one more important concept, that is all about PC. My dear children, remember, PC is being dealt as per AS 14 only. PC is being dealt by Seppali, PC is being dealt by AS 14. But AS 14 did not tell the types of PC. AS 14 defined what do you mean by PC. Is my point clear? AS 14 did not tell the types of PC, like net assets method, net payments method, intrinsic value method, lump sum method. That methods were not discussed by AS 14. AS 14 simply discussing only what will be included in PC. PC is something which will be given for the owners. Who has to pay PC, Amma? Transferee company has to pay PC too. Frankly speaking, to the owners of transferor company. Owners are nothing but shareholders. So PC is nothing but, PC includes everything, whatever is paid to the shareholders of transferor company. Shareholders can be either equity shareholders or preference shareholders. Shareholders can be either equity shareholders or preference shareholders. Who has to pay PC? To the shareholders of transfer or company. Who can be either equity shareholders or preference shareholders? Respond everybody, clear. And my dear children, yeah, and what can be included in PC? You transferee company transferee company may pay cash. It can give some check. It can give some equity shares. It can give some preference shares. Getting my point, everybody? So whatever, it can even give some debentures also. Whatever transferee company is paying to the owners or shareholders of transfer or company, that will be included in PC. What is PC, Amma? Purchase consideration. Types of PC is not dealt as per AS 14. But on a general sense, we will be dealing something called lump sum method, intrinsic value method, net assets method, net payments method. Now, the first one, what do you mean by lump sum method? On a whole sum basis, transferee company will pay some amount to transferor company. How much is to be given per equity shareholder? How much is to be given to per preference shareholder? Nothing will be discussed. What is PC to equity shareholders? What is PC to preference shareholders? Nothing will be discussed. In dash method, Amma? Lump sum method. Please take care. Total on a whole sum basis, transferee company will be paying huge sum of amount to the liquidator of transferor company. How much is to be paid to the equity shareholders? How much is to be paid to the preference shareholders? That will not be discussed. How much is to be paid per equity shareholder? How much is to be paid per preference shareholder? Even that also will not be discussed at all. Respond everybody, clear. This is dash method, Amma? Lump sum method. And the next one, net payments method. If everything is given in the question, that is called as net payments method. If everything is given, then that is called as net payments method. And to equity shareholders, what is to be paid? To preference shareholders, what is to be paid? Like that, every consideration part will be given in the question itself. Everything will be discussed in the agreement, and we will be generally calling it as net payments method. And be careful, my dear children, if at all some PC is intentionally missed. Some PC is intentionally missed. Say for example, equity shareholders were paid equity shares and necessary cash. Okay, is my point clear, everybody? Equity shareholders were paid equity shares and necessary cash. How much is that necessary? We don't know that, and that should be based on net assets. Is it clear, everybody? Even preference shareholders will be given preference shares and also some portion of debentures. How much? That also will be depending on net assets method. Respond everybody, clear? And now moving on to the next thing, intrinsic value method. What do you mean by intrinsic value method? Whenever the PC is exchanged with respect to intrinsic value, then we will be calling it as intrinsic value method. What is intrinsic value? It will be given in the question. If at all intrinsic value is not given, then again you need to follow net assets method only. Is the point clear? Shares must be exchanged on the basis of intrinsic value. That is dash method. Intrinsic value method. What if intrinsic value is not given in the question? You have to follow simply net assets method. Respond everybody, clear? Now, lump sum method, we don't care in the problems at all because you are not having anything. An intrinsic value can be like this. Say for example, A limited and B limited are there, and B limited is being acquired by A limited. Number of equity shares in A limited 1 lakh and in B limited 60,000. Intrinsic value of A limited 60 rupees and intrinsic value of B limited 40 rupees. Is it clear? So now A limited is giving PC to B limited on the basis of intrinsic value. Is it okay? How many equity shares? And the answer is nothing but 40,000. because A limited is giving to B limited. So totally B limited intrinsic value is 60,000 into 40 rupees. And it has to give on the basis of A limited. So it is nothing but divided by 60. Is it clear? In another words, to tell you something like number of equity shares of transferor company multiplied by intrinsic value of transferor company divided by intrinsic value of transferee company. That is 60,000 into 40 divided by 60, where you are going to get 40,000 equity shares. Now next task. This is okay, sir. At what price the shares were issued? Question clear? At what price each and every share is issued? If nothing is mentioned, each and every share is issued at 60 rupees ani ardham. And 40,000 equity shares are issued at 60, wherein 10 rupees will become face value and remaining 50 rupees will become securities premium. Is it clear? Now the same question is given and telling that shares are issued at par. Same question is given and telling that shares are issued at par. Now what to do, sir? How many equity shares you are supposed to give? 40,000 multiplied by at par ante 10 rupees. Then consideration will become only 4 lakhs. Otherwise here consideration will become 40,000 into 60 rupees. 24 lakhs. Is it clear, everybody? Yes, like that obviously your total PC will differ. Be careful whether the shares are issued at par or nothing is mentioned. If nothing is mentioned, you have to issue at full intrinsic value. Face value will become 10 and remaining will become securities premium. Respond, everybody, clear? Now moving on to the next thing, net assets method. While computing net assets method, you have to compute net assets. Net assets is nothing but assets minus outside liabilities, and you need to consider at agreed values or takeover values or re-values or realizable values or market values or fair values. One thing, Nana, except book value, if any other value is available, take that value. If no other value is there, then take book value only. Is the point clear, everybody? How to compute net assets, everybody? Dash minus dash. Assets minus outside liabilities. Consider a dash value sum. Any other value except dash value, book value. If no any other value is given, then you have to consider it book value only. Respond, everybody, clear? While computing net assets, you have to be very careful, because you have to read the question once or twice. You have to read the question twice. You have to read the question thrice also, because you must need an information. Which asset is taken? Which asset is not taken? At what value it was taken? That is the toughest point ever. So to get this, first of all, you must get command on English language. So be careful, read the question thrice, read the question twice, especially in the examination, and decide which assets were taken and which assets were not taken. And the assets were taken is fine. At what values also, you have to read the question twice or thrice to decide this carefully. Respond, everybody, clear? Okay. Sir, 99.999% is under net assets method, net assets is equal to PC. 99.999% is under net assets method, net assets is equal to PC. You can check out any question in your institute material except Sun and Neptune Limited. Gurtunda? There's a problem called Sun and Neptune Limited, wherein Sun and Neptune are closed and Jupiter is formed. And Jupiter is giving PC to Sun and Neptune on the basis of their average profitability for the past 3 years. Did you remember? In that problem, even you have to compute net assets. But only in this problem, net assets is not equal to PC. Apart from this, in every other problem, net assets is obviously is equals to PC. Respond, everybody, clear? Fine, sir. It is something like net assets is equal to PC. Be careful. And whenever purchase method is given, 99.9% you will be given net assets or net payments or even intrinsic value. And first pick, if it is purchase, amalgamation in the nature of purchase aithe net assets method. If that is missed, net payments method. Even if that is missed, intrinsic value method. But remember, whenever if it is amalgamation in the nature of merger, 99.99% PC will be only in net payments method. Sorry, keeping all these things aside, whatever is the method, absolutely not needed for solving a problem. Because in a problem, he will not test you which method the exchange has been made. Nobody cares that. You read the question and you decide how to compute PC. Whatever the method of PC that you are following in the problem, that is obviously not at all needed. But since there are methods, I told you, you have to learn. Maybe it might be helpful for you while solving MCQs, but solving amalgamation related problems, types of PC is absolutely not required. Respond everybody clear. So, one or two important points relating to PC. Be careful. Say for example, this is the balance sheet. Equity share capital. 1 lakh equity shares at the rate rupees 10 each, which is like 10 lakh. Preference share capital. 2 lakh equity shares, 20,000 equity shares. 20,000 equity shares at the rate rupees 100 each, which comes to 20 lakhs. Now, in PC terms and conditions, 2 points are given. Point number 1, preference shareholders were given necessary preference shares at 5% premium. Equity shareholders were given necessary equity shares at 5% premium. Is it clear, everybody? And some other data, like all the other assets comes to 40 lakhs and all other liabilities comes to 10 lakhs. Is the point clear? Is the point clear? Now, for your kind information, you can't tell me the answer clearly, but tell me how to compute PC. How to compute PC? Sorry, let me give you some more data. And some more data is all about point number 3. Assets agreed value is equal to 60 lakhs and liabilities agreed value is equal to 12 lakhs. Now compute PC. This is your exhaustive question. Compute PC and tell me the answer. 48 lakhs. Okay. And how much is given to equity shareholders and how much is given to preference shareholders? How much is to be given to equity shareholders and how much is to be given to preference shareholders? And those students who are actually watching on YouTube, please do comment your answer if you know the answer. Otherwise, wait till the answer is taught. You people answer. What is consideration to be given to preference shareholders? 20. Okay. To equity shareholders? 20. 10 lakh? 50,000. Then 21 plus 10.5 is not 48. 27 lakhs. What is correct now? Sorry. Now if you are observing these points, these 2 points are actually similar. Even in the, sir, since this is hardly a marathon class, even if you tell the wrong, nothing will happen. Whether you are confident or not confident, nobody cares. But especially in the examination, if you are even when you see this, nothing will be striking to you at all. When you read the question, because lengthy question will be there. Every asset, every liability, every terms and conditions, a very lengthy question will be given. This will be given somewhere at point number A. This will be given somewhere at point number A. You actually don't care and you may not identify that the 2 points are same. You will be getting and you will be into the trap actually when you have started solving the solution. Alright, these two are similar kada? Of course, yes. Sorry, I'll tell you two possibilities and I'll tell you what is correct first. Chichi, what is correct first kadu? What is correct last? Now, possibility number one. Preference shareholders were given necessary preference shares at 5% premium. How much preference share capital is there? 20 lakhs. And that will be given with necessary preference shares at 5% premium. Is it clear, everybody? Ante 20 lakhs divided by 105 is the correct answer. Is it clear? Preference shareholders were given necessary preference shares at 5% premium and the shares were issued at premium ani ardham, not redeemed at premium. Sir, understood? Discharged at 5% premium ante 20 lakhs plus 5%, then you will be getting 21 lakhs. Cheppali clear? As of now, it is something like issued at premium. So 20 lakhs divided by 105. You will be getting 19,047 point. So forget about that 0.6 for our better understanding. 19,047 లేదా 0.6 preference shares must be given. Respond everybody clear? Hey, how to give 0.6 preference shares? You don't worry. If at all any fractional shares are there, you have to give cash. There ends the matter. Respond everybody clear. Next, equity shareholders were given necessary equity shares at 5% premium. And frankly speaking, how much equity share capital is there? 10 lakhs. Even they were given necessary equity shares by follow issued at 5% premium, which is nothing but 10 plus 5%, which comes to 10.5. Where it will become 95,238.09 equity shares are given. Respond everybody clear? Ante you can answer like this in your main examination, but frankly speaking, this is correct, this is wrong. Sir, ardhamainda? Preference shares correct, equity shares wrong. Then sir, 2 points are same kada? Of course, yes. 2 points are same. 2 points are absolutely same. But preference shares, whatever you have done is correct. Equity shares, whatever you have done is wrong. Reason being, equity shareholders are having right on the net assets of the company. So whenever this kind of term you have come across with, you have to compute the net assets, where assets is equal to agreed value 60 lakhs, liabilities agreed value 12 lakh. So your PC should become 48 lakhs, out of which this total net assets, whatever total net assets are there, it is belonging to both preference and equity shareholders. So deduct PC to preference shareholders. How much is the PC to preference shareholders, amma? Enta? 20 lakhs. 19,047.666 something multiplied by 105, where you will be getting 20 lakhs. And PC to equity shareholders will become 48 minus 20. 28 lakhs. And how many equity shares you are supposed to give ante? 28 lakhs divided by 10.5. 6 whatever 0.77 something, that many equity shares you are supposed to issue. Respond everybody clear? Sir, please don't concentrate on the numerics here, concentrate on the concept here. Whenever these kind of similar points are given, preference shareholders you need to compute with the existing number and existing value. But whenever equity shares this kind of point is given, then you need to compute net assets, because equity shareholders are having right on net assets of the company. Respond everybody clear? For your kind information, there is these kind of points in our material. There's a problem. In that problem, same point you will be having, but only one thing that could be appreciated is all about preference shares. You need to consider the face value and number. Equity shares, you need to consider the net assets. Respond, is it clear? And my dear children, this is all about one more special adjustment. And yeah, so now listen very carefully. Let us start learning the closing the books of accounts of transferor company. It is so simple, amma. So transferor company, closing the books of accounts implies actually closing the balance sheet. Remember, your balance sheet will be something like this: share capital, reserves and surplus, outside liabilities, and all the fixed assets, current assets and miscellaneous assets. Now, share capital, equity share capital, preference share capital, reserves and surplus. Those reserves and surplus which belong to shareholders, some reserves and surplus which belongs to outsiders also will be there. Shall I start now? My dear children, net assets have to be computed with any value except book value. But realization account is always to be considered with book values. Don't forget. Teliyakunda, in a very hasty and hurry way, in the examination, we will be doing this wrongly. అది ఎప్పుడో కానీ రియలైజ్ అవ్వం. So please be very careful. Realization account will be closed with, net assets will be computed with agreed values. Shall I continue? Sir, equity share capital has to be closed and transferred to equity shareholders. Preference share capital has to be closed and transferred to preference shareholders. Reserves and surplus which are belonging to shareholders have to be transferred to equity shareholders. Reserves and surplus belonging to outsiders. Then sir, even like that also you'll be having a, yes, example, workman compensation fund, retirement gratuity fund. Frankly speaking, these things are something which are relating to employees, and hence these must be transferred to realization account. Is it clear, everybody? And even sir, frankly speaking, in our problems, every reserve has to be transferred only to equity shareholders account. Only in one problem you will be having something called retirement gratuity fund. In that problem, that has to be transferred to realization account. Shall I continue? Outside liabilities, yes, it has to be transferred to realization account. Fixed assets and current assets, yes, even this has to be transferred to realization account. Miscellaneous assets has to be transferred to equity shareholders account. Respond, everybody, clear? Pakka. To make this concept more clear, be careful. Identify those items which are belonging to shareholders and identify those items which are actually belonging to company. What are the items that are belonging to company? Assets and liabilities. What are the items that are belonging to shareholders? Equity share capital, reserves and surplus, preference share capital. These two things must be transferred to equity shareholders. This must be transferred to preference shareholders. Reserves and surplus, so be careful. Retirement gratuity fund has to be transferred to realization account. Now coming back to assets and liabilities. Identify those assets and liabilities which are taken over by transferee company and which are not taken over by transferee company. Whatever are taken over by transferee company will be outright transferred to realization. If at all that asset is not taken over by transferee company, you have to sell the asset or you have to settle the liability. At the time of selling the asset and settlement of liabilities, you might get some profit or loss. That profit or loss will be transferred to realization account. Respond, everybody, clear? Even you are having two problems like this in your material, something like debtors and creditors were not taken by the transferee company and debtors realized some amount, creditors realized some amount, and even liquidator will be appointed. Liquidator will be given his commission also. Did you remember? That is one problem. And in another problem, only bills payable, creditors, debtors will be taken. Bills receivable will not be taken and it will be settled. And there will be some sort of profit or loss. Even that profit or loss also will be transferred to realization. Respond, everybody, clear? So frankly speaking, your realization account will be appearing like this. Two assets at book value with items that were taken over. By liabilities, those items which were taken over will be appearing at book values. Is it clear? Take more care, my dear children. If at all an asset is sold at a higher price, you will be getting some profit. Even that profit also will be transferred to realization account. Something like by profit on sale of asset or profit on settlement of liabilities. 2. Loss on sale of asset or loss on settlement of liabilities. I mean to tell, to make it more clear, say for example, cash or bank, you got 1 lakh where the debtors, say for example, machinery which is 80,000 only. Automatically 20,000 is the profit which will be transferred to realization account, which is nothing but by cash or bank profit on sale of machinery, where you will be putting the profit. Respond everybody, clear? So it is something like by cash or bank, either profit on sale of asset or profit on settlement of liabilities. 2. Cash or bank, something like profit on loss. You will be getting 2 asset or 2 liability, something like loss on sale of asset or loss on settlement of liabilities, whatever is that. Is it clear? Okay, now moving on to the next thing. I mean, to asset ani kaadu, whatever you get, you write that one. You'll be getting either 2 asset or 2 cash. Sir, whatever, amma, say for example, liability 1 lakh. But unfortunately, you are supposed to pay 1.2 lakh. Then automatically realization 20,000 is the loss. So automatically 2 cash or bank, loss on settlement of liabilities. Whatever you get, you write that. One thing remember, profit will be credited to realization account, loss will be debited to realization account. Up to this clear everybody? And next one, you might also incur some realization expenses. You might also incur some realization expenses. Coming to realization expenses, there will be actually 3 cases. Number 1, borne by transferor company and paid by transferor company. Then realization account debtor to cash or bank account. Next one, borne by transferee company and paid initially by transferor company. Let me make it clear. Borne by transferee company as per the agreement, but it is paid initially by transferor company and we are paying the expense, so to cash or bank. But it is borne by whom, amma? Transferee company. So they need to reimburse for us. So transferee company account debtor to cash or bank account. Whenever they are reimbursing, the journal entry will become cash or bank account debtor to transferee company account. Is it clear everybody? Next case, borne by transferee company and paid by transferee company. So simple. What is the journal entry in transferor books? No entry, because it is borne and paid by transferee company. We are least bothered. Is it clear? So Oste, you will be getting only one case. To cash or bank account, realization expenses borne by transferor company, paid by transferor company. Clear everybody? Hey, pakka. Fine. Till now, this is what realization account. And moving on to the next account, amma, equity shareholders account and preference shareholders account. So simple. Equity shareholders, something like by equity share capital, by reserves and surplus, to miscellaneous or fictitious assets. And preference shareholders law, by preference share capital. Up to this clear everybody? This is what generally we will be writing from part 1 to close the balance sheet. Now the real work start. PC. Who has to give PC to whom? Transferee company has to give PC to transferor company. Am I correct or wrong? So what is the journal entry for PC, amma? First of all, you have to write due entry. Hey, one second. You are in transferor company books. Business purchase gaadu. Yes, it is due entry. Transferee company has to give it to you. So transferee company account debtor to realization account. Is it clear everybody? After due entry, you might receipt it. So at the time of receiving, whatever PC you receive, just debit that. And you can receive either cash or bank or debentures Am I correct or wrong? Or you can receive asset, or you can receive equity shares, or even you can receive preference shares. My dear children, you cannot call it as equity share capital. Gurtupettukondi, you have to call this as equity shares in transferee company. Is the statement clear? So the PC will be equity shares or preference shares in transferee company account debtor to transferee company account. Is it clear? And the next one, disbursement. You will be distributing the same to the shareholders, and hence the journal entry will become shareholders account debtor to PC. Sir, is it clear? Please participate. What is the due entry? Transferee company account debtor to realization account. If receipt, what did you receive, Amma? PC account debtor to transferee company account. Distribution, shareholders account debtor to PC. And PC can be in any form, whichever form you receive, you write that. But please don't write equity share capital and preference share capital. It's equity shares or preference shares in transferee company. Is this point clear? Now, very important, transferee company cancel. PC cancel. So finally speaking, you have to post only in two accounts, realization account credit side, shareholders account debit side. Post only in two accounts. What are those? Realization account credit side, shareholders account debit side. So go to realization account, post here by transferee company PC, and then distribute the same to the shareholders to PC, preference shareholders to PC. Is it clear? Last and final, you have to close these three accounts. You have to close these three accounts. So while closing, please don't close realization account first. You have to close shareholders account and transfer the profit or loss to realization, and automatically realization account will get closed. Babu arthamainda? Now check out, say for example, you have to give preference share capital of 4 lakh. But you are giving in the form of PC to the extent of 4.4 lakh to preference shareholders. So to preference shareholders, is it profit or loss? To preference shareholder, profit or loss? Profit. How much is the profit? Like this, you find that first and transfer the same to realization account. In the similar way here also, in equity shareholders, by realization account if profit, to realization account if loss. Even to realization account if loss. And transfer these things to realization account, and ultimately to equity shareholders or preference shareholders if profit, or by equity shareholders or preference shareholders if loss, and ultimately all the three accounts will get closed. And this is the end of closing the books of accounts of transfer or company. Clear everybody? Frankly speaking, totally closing the books of accounts of transfer or company is totally done, and we have to start with the opening the books of accounts or incorporating the books of accounts of transferee company. Is it clear everybody? Opening the books of accounts or incorporation of books of accounts of transferee company. Sir, so simple. But first of all, you are supposed to decide what is the nature of amalgamation. If it is amalgamation in the nature of merger, you are supposed to follow pooling of interest method. If it is amalgamation in the nature of purchase, you need to follow purchase method. First of all, let me concentrate on the entries relating to purchase method. Now, sir, as usual, the first entry, PC due. Business purchase account debtor to liquidator of transfer or company account. And the next one, for acquiring the business, what is a journal entry? Assets account debtor at agreed values, to liabilities account at agreed values, to business purchase account with PC. Is it clear everybody? If at all this PC is computed by considering net assets method, then this net assets okay. Say, if at all this PC is computed by using net assets method, net assets is nothing but assets minus outside liabilities by considering agreed values. In this context, net assets is automatically equal to PC. So absolutely no problem. Up to this clear, everybody. But take more care, my dear children. If at all PC is more than net assets, then automatically it is nothing but capital loss, and hence balancing figure you have to debit the same to goodwill. And if at all PC is less than net assets, it is nothing but capital profit, and that has to be transferred to capital reserve. Up to this clear, everybody. Now moving on to the next thing, settlement of PC. You have to settle the PC by paying to the liquidator of transfer or company account debtor to equity share capital. Sir, while writing in the transfer or company books of accounts, you have written equity shares in transferee company, but now you are supposed to write equity share capital or preference share capital, and automatically if issued at premium, you are supposed to write securities premium. Respond everybody, clear? And settlement of PC is also done. Now these are the three main journal entries for opening the books of accounts of transferee company. So now three sub journal entries, be careful. Supporting journal entry number 1, settlement to the debenture holders. Settlement to the debenture holders, be careful. While going with the settlement to the debenture holders, the journal entry will become percentage debentures of transfer or company account debtor to percentage debentures account. No need to tell of transferee company because you are passing the entries in transferee company books only. Respond everybody, clear? And supporting journal entry number 2, elimination of mutual owings or intercompany owings. So while eliminating these mutual owings or intercompany owings, there will be two things. Number 1, eliminating liabilities and assets, where the journal entry will become liabilities account debtor to assets account. Say creditor account debtor to debtor account, liability account debtor to asset, loan liability to loan asset, or bills payable account debtor to bills receivable account. And the next one is eliminating stock reserve. What is a journal entry, Amma? Yes, sir, frankly speaking, stock reserve ante some stock is overrated. So you need to bring down the value of the stock automatically to stock account. Then debit what, sir? Goodwill or capital reserve. If already you are having capital reserve, you can debit capital reserve. If no capital reserve is there, you have to debit the goodwill. Respond everybody, clear? And the last and final, realization expenses. If at all the realization expenses are borne by transfer or company and paid by transfer or company, then no entry in transferee company books of accounts. But if it is borne by transferee company and paid by transferee company, then you are supposed to write an entry like goodwill or capital reserve account debtor to cash or bank account. Yes, you are paid. Since you are bearing the expense, you have to debit, frankly speaking, to expense account. Since this expense is nominal account, you have to close and transfer it generally to P&L account if it is your expense. But frankly speaking, is it your expense or transfer or company expense? And hence it's a kind of capital loss, and hence it has to be debited to goodwill or capital reserve. Again same, if you are having capital reserve, you need to debit it to capital reserve. If capital reserve is not there, you just need to debit the same to goodwill. Respond everybody, clear? And yes, and in this course of action, you can also write two entries. Number 1 is due entry, number 2 is payment entry. Due entry, what is the entry? Goodwill or capital reserve account debtor to liquidator of transfer or company account. At the time of payment, liquidator of transfer or company account debtor to cash or bank account. Respond everybody, clear? This is what amalgamation in the nature of purchase. So now let us start with amalgamation in the nature of merger. Coming to amalgamation in the nature of merger, the first entry is copy paste, no change. Next, third entry is also copy paste, no change. Settlement of PC. Now, settlement to debenture holders is also copy paste, no change. Elimination of mutual owings, liabilities and asset, copy paste, no change. Elimination of stock reserve. You should not debit goodwill or capital reserve. You have to debit P&L account. Next one. For realization expense also, you should not debit goodwill or capital reserve. You need to debit P&L account. Ante, in a single word, wherever goodwill or capital reserve is debited for amalgamation in the nature of purchase, you need to debit P&L account for amalgamation in the nature of merger. Up to this clear, everybody? But there is a real entry waiting for you, that is for acquiring the business. Now let me write the entry for acquiring the business for amalgamation in the nature of merger. What is the entry? You will be writing assets account debtor at book values to liabilities account at book values. My dear children, you have to take all the assets and liabilities at book values if it is amalgamation in the nature of merger. Am I correct or wrong? And you need to follow dash method, amma. Pooling of interest method. While following pooling of interest method, you have to do something called genuine pooling. What do you mean by genuine pooling? Think with common sense, everybody. All the assets of old company have become assets of new company. Cheppali. At dash values. All the liabilities of old company had become liabilities of new company at dash values. Almost every equity shareholder, frankly speaking, shareholders holding 90% had become shareholders kada. And frankly speaking, this is something like, be careful my dear children, this is something like old people in a new company. Hey, clear? Or new company with all the old data. Same asset, same liability, same shareholder also, same book values. Frankly speaking, same business also. So you have to do something called genuine pooling. Genuine pooling is nothing but not only take assets, not only take liabilities, but also take all the reserves and surplus, because 90% of the shareholders are becoming shareholders kada. So you are supposed to take not only the assets and liabilities, but also you are supposed to take all the reserves. You have to take all the free reserves at book values, and you have to take all the statutory reserves at book values, and you have to take all the specific reserves at book values. And finally, something like to business purchase account, PC. Is it clear up to here? Now, very, very important. So, frankly speaking, in amalgamation in the nature of purchase, you have compared dash and dash, PC versus net assets. Am I correct or wrong? Here net assets is nothing but assets minus outside liabilities, if it is amalgamation in the nature of purchase. Now coming to amalgamation in the nature of merger, you need to compare dash versus dash, PC versus net assets only. But here net assets implies not only assets minus outside liabilities, but since also you have taken reserves and surplus, deduct even reserves and surplus also, which implies that in a single term, this is nothing but share capital. So you need to compare dash versus dash and PC versus share capital. Shall I continue? Be careful. If at all PC is exactly equal to share capital, no problem. If PC is if PC is greater than share capital, this is loss. This loss has to be adjusted in the following ranks. Rank number 1, adjust against the free reserves of transferor company. If all the free reserves of transferor company are completed, adjust against the free reserves of transferee company. If all the free reserves of transferee company were also exhausted, simply at the third stage, debit P&L account. Is it clear, everybody? Pakka. So, while writing this journal entry, this free reserves may change. With PC is greater than share capital. If at all you have adjusted all the free reserves and free reserves had become 0, simply use free reserves of transferee company. If all the free reserves of transferee company were also over, simply you need to debit P&L account. Respond everybody, clear? Pakka. Done with PC is greater than share capital. Now, if at all PC is less than share capital, it is nothing but profit or loss. Profit. No, so now profit has to be credited. Be careful. Credit P&L account as per AS 14. Even in your institute material, the same is followed. But be careful, you have to credit capital reserve account as per the notification released by Expert Advisory Committee of ICAI. Is the point clear? As per AS 14 and as per institute material, simply you have to credit P&L account. But as per Expert Advisory Committee release notification, you have to credit capital reserve account. So frankly speaking, now what is correct ante? Practically crediting capital reserve is correct, which is a clarification given by EAC. But as per your institute material, they are simply crediting it to P&L account. So now what if we face in the examination? First you write credit P&L account as per AS 14. After that, note, as per the clarification released by EAC of ICAI, if PC is less than share capital, the difference has to be transferred to capital reserve account. Is it clear? If you write this note, this will become too safer side. You are supporting your textbook and also you are supporting the Expert Advisory Committee clarification given by institute. Respond everybody, pakka. So the journal entry will become assets account debtor at book values, to liabilities account at book values, to free reserves account. Yes, again at book values. No need to adjust kada. Yes or no? To specific reserves at book values, to statutory reserves at book values, to business purchase with PC, and one more time you will be crediting P&L account as per AS 14 or capital reserve as per clarification released by EAC. Respond everybody, clear? This is the end of opening the books of accounts or incorporating the books of accounts of transferee company. Clear everybody? But some other clarifications to give you which are important for problematic parts. Already I told you some things like intrinsic value I told you. PC with respect to equity shares and preference shares I told you. So now like that, as far as I have remembered, I am going to tell you some of the important points. If you have remembered something like Galaxy, Glory, something, one problem will be there. In that debentures will be quite confusion. So he will be giving something like debentures of Glory Limited has to be discharged by issuing debentures of some sort of Galaxy Limited at 5% premium. Anukondi. Frankly speaking, it's 10% premium. And debentures of Glory Limited is equal to 3,30,000. Hey, is my point clear, everybody? The biggest problem intante, debentures of Glory Limited has to be discharged by the issue of debentures of Galaxy Limited at 10% premium. Students ella confuse aitarante whether is it discharging at 10% premium or issuing at 10% premium. Is my question clear, everybody? But no need to confuse at all. Always remember, by is the separating preposition. By is the separating preposition. Up to by, where, after by, where. Now, debentures of Glory Limited has to be discharged. At what price? Not given kada. So discharged at par. So you have to pay 3,30,000 only. Issued at 10% premium. So divided by 110. Is my point clear, everybody? So be careful. This is one of the important points where you need to take more care. Shall I proceed further? And next one, very important. Likewise, intercompany transactions. Listen very carefully. Say for example, creditor has to pay to debtor. I mean to tell, in another words, say A Limited has to pay to B Limited. Creditor has to pay to debtor, debtor has to pay to creditor. Say A Limited has to pay to B Limited. Some sort of intercompany transactions are there. Remember, while closing the books of accounts, don't eliminate intercompany transactions. While computing the PC, don't eliminate intercompany transactions. While acquiring the business, don't eliminate intercompany transactions. Is my point clear, everybody? Sir, is my point clear, everybody? Even though you are having intercompany transactions, while closing, don't eliminate. While computing PC, don't eliminate. Even under net assets methods also, don't eliminate. While acquiring the business also, don't eliminate. Then when to eliminate, sir? After acquiring the business, you have to write one more special entry for elimination of ICTs. Like liability account debtor to asset account. With this entry, you have to eliminate. My point clear, everybody? No need to eliminate at the time of closing. No need to eliminate at the time of computing PC. No need to eliminate even at the time of acquiring also. Eliminate only after acquiring by passing a special entry. By passing a special entry, and the special entry is nothing but liability account debtor to asset account. Respond, everybody, clear? But take care, in one of the problems in institute material, he had eliminated at the time of acquiring the business only. Sun and Neptune problem. But don't do it like that. In all the other problems, he had eliminated separately by passing the journal entry. But only in that problem, he will be writing at the time of acquiring. So don't do like that. You follow like this only. Respond, everybody, clear? Okay, done with even elimination of ICTs. Now one more point. Issue 5% debentures so as to maintain same amount of interest. And given in the question something like 6% debentures is equal to 90,000. I hope it's clear for you. So in this context, how you are supposed to do ante, remember amma, 6% of debentures of transfer or company should exactly equal to 5% of debentures of transferee company. So now how many debentures we need to issue, we don't know, but this one we know. So 6% of 90,000 is equal to 5% of debentures of transferee company. So debentures of transferee company is equal to 6% of 90,000 divided by 5%. Whatever is the answer, I'm telling you the concept. Sorry, entamma? 1 lakh? You have to issue 1,08,000 value of debentures in order to maintain same amount of interest. Respond, everybody, clear? And in one of the problems, similar point you will be having, preference shareholders must be given, 6% preference share capital has to be given so as to yield 8% return on net assets entered. Is it clear, everybody? 6% preference shares must be given so as to yield 8% return on net assets. Again same, 6% on preference share capital is equal to 8% on net assets. You know net assets, am I correct or wrong? So preference share capital is equal to 8% on net assets divided by 6%. And net assets you need to compute assets minus outside liabilities by considering agreed values. Respond, everybody, clear? This is one more important point that could be appreciated. Even while computing net assets, don't eliminate ICT. securities, intercompany transactions or mutual owings. Is this point clear? Now, one more important point. In LK Limited problem, there is a point. Be careful. 5% debentures given in the question like 2 lakhs. Now, the company is acquiring 5% debentures and settled at 5% discount after takeover. Gurtunda? Fine, whatever. Even if you did not remember, just check out. The company is acquiring 5% debenture and settled at 5% discount after takeover. My question, what is the agreed value? What is the agreed value? 5%. So agreed value is equal to 2 lakhs. In this context, agreed value is equal to 2 lakhs. And a company is taking over 2 lakh value of debentures and after takeover, it is settling at 5% discount. Respond everybody clear. Say for example, if this statement is not given, then what is the agreed value? 2 lakhs minus 5%. Whatever, just with that phrase, your answer is going to change. Respond everybody clear. So, yes, I've covered almost all the special points relating to the problems relating to amalgamation, but I need to cover 2 more points. Point number 1. Me gurtunatlaite, I told you something like, don't eliminate intercompany transactions while acquiring the business antam. Am I correct or wrong? And in some problems, in one problem he will be giving like create provision for bad debts at 5% antadu. In one problem, he will be computing 5% on all the debtors without eliminating intercompany transactions. But there is a special problem, VTMG problem. In that problem, he will be computing 5% provision after deducting intercompany transactions. Did you remember? So when this is correct and when this is correct. 2 things are absolutely correct. Don't think that it is printing mistake. It's absolutely correct. Listen and concentrate carefully with this last and final point. Say for example, there are 2 companies, A Limited and B Limited. Debtors and creditors, something like 1,60,000, 45,000 and 30,000. Say for example, A Limited is acquiring B Limited and B Limited is transferor company and A Limited is transferee company. There is a statement given in the question that A Limited has to receive 10,000 rupees from B Limited. This is point number 1. And point number 2. While acquiring, debtors of B Limited create 5% provision. Shall I decode these 2 points now? Concentrate. If you observe carefully, A Limited has to receive. From whom it has to receive? B Limited. And B Limited has to pay. Who has to pay? To whom it has to pay? Ante for B Limited it has to pay kabatti A Limited is like a creditor. And who has to receive amma? A Limited has to receive. So for A Limited, B Limited is a debtor. Am I correct or wrong? So frankly speaking, in B Limited creditor, in A Limited debtor, it is included. Is that point clear? Who has to receive? Ante debtor hai kada. So in that debtor, there is an amount of 10,000 which has to be received from B Limited. So B has to pay to A to the extent of the 10,000. Respond everybody clear? Okay. While taking the assets, debtors of B Limited, you need to create 5% provision. So simple. How much debtors of B Limited are there? So take 60,000 by creating a provision of 5% which becomes rupees 3,000. Respond everybody clear? Sir, Chapali, is it clear? My dear children, this is happened in each and every problem. This is happened in each and every problem. Ante transferor company has to pay to transferee company. Is it clear? But in VTMG problem, it is quite opposite. So let me modify the same question in a different style. Like B Limited has to pay 10,000 to A Limited. Ade kada. Fine. B Limited has to receive 10,000 from A Limited. This time who has to receive? B Limited. From whom it has to receive? And it is like this. Hey, is it clear? Hey, Pakka. Sir, be careful. Now what is happening? A Limited is taking over B Limited. A Limited is also taking over the debtors of B Limited. In that debtors of B Limited, 10,000 is A Limited only. Is it clear? B Limited has to get how much amount? 60,000. Out of that, it has to receive 10,000 from A Limited, and remaining 50,000 it has to receive from the outsiders. Now A Limited is taking over the debtors of B Limited, and A Limited is taking over the 60,000 relating to B Limited. Sir, while taking over, you should not eliminate ICT. Am I correct or wrong? So A Limited has to take how much amount? Participate. A Limited has to take how much amount? But at the time of taking that 60,000, you have to create a provision of 5%. Now create provision of 5%. Use your common sense and tell me 5% on 60 or 5% on 50? 5% on 50. Arre yaar, I am the debtor to the extent of 10,000. Why I have doubt on me? Provision for doubtful debts ante doubt ane kada. I am the debtor for the 10,000 and I am taking that 10,000 only. Why I will be having doubt on me? And moreover, no need to pay the 10,000 kada. You will eliminate that entire 10,000 kada. Why to create provision on that elimination amount? Is it clear? So you need to create a provision of 5%, this time only on 50,000. Be careful that this problem, this adjustment appears to be very small, but it is having too much logic to understand. Ante, before creating a provision, first of all, you need to check out who is the debtor and who is the creditor. Basing on that, you need to take a decision. Respond everybody clear. If at all, conclusion amma. If at all, transferee company himself is a debtor, then eliminate ICT to create provision. If at all transferor company is a debtor, I hope you might have understood with this point. Check out who is debtor and creditor. If transferee himself is a debtor, he is not having doubt on him. He has to eliminate that, and hence he need to create provision only after eliminating ICT. Respond everybody clear. My dear children, this is the end of amalgamation, and successfully we have completed, and I hope you have actually got some important points in this. But how to incorporate statutory reserves for amalgamation in the nature of purchase. Sir, coming to amalgamation in the nature of merger, there will be no specific entry for statutory reserve at all, because you will be taking over each and every reserve, free reserve, specific, statutory. But coming to amalgamation in the nature of purchase, you are not going to take any reserve. But as per law, you have to maintain statutory reserve. So you have to pass a special journal entry, which is amalgamation adjustment reserve account debtor to statutory reserve account. Is it clear everybody? So take care. The reserves and surplus after acquiring statutory reserve in transferee company will appear like this. Free reserves relating only to transferee company. Specific reserves relating only to transferee company, but statutory reserves, transferee company plus transferor company. Then you will be having something called total. Very, very important. Minus amalgamation adjustment reserve. And finally, you will be having the net amount which is to be transferred to balance sheet. Other if it is amalgamation in the nature of merger anko, this concept will not be there. This is also relating to transferor company. I mean to tell, if it is amalgamation in the nature of merger, no need to open a special account called amalgamation adjustment reserve account. And all the reserves and surplus accounts will include amount relating to transferee company and amount relating to transferor company, subjected to the adjustment of reserves with respect to PC versus share capital. Because in that you may have to adjust kada. Fine, my dear children, this is what your reserves and surplus. And sometimes you might also have capital reserve provided if PC is less than share capital. That's it. Okay, let us start with accounting standard number 25, 29 and 26. And let us complete all these three standards. And first of all, AS 25. Ma, what is AS 25, Mama? Interim financial reporting or interim financial statements. Don't change the name of the standard. What is AS 25 name? Interim financial reporting. So better use the same name. Now, frankly speaking, AS 25 is not mandating anybody to prepare interim financial statements. Whichever company or whichever enterprise has to prepare interim financial statements as per law, that has to follow AS 25. Is my point clear, everybody? Nobody is asking to prepare interim nobody ante, I mean to tell AS 25 is not asking to prepare interim financial statements at all. Whichever enterprise has to prepare interim financial statements as guided by law, it has to follow AS 25. Let me give you some of the examples. Sole proprietorship, no interim financial statements is required. Partnership firm, no interim financial statements is required. LLP, no interim financial statements. Cooperative society, all these things, no interim financial statements are required. Did we discuss this one? Gurturavatledha? Introduction to accounting standards. In the morning session of today, while telling introduction to accounting standards, MSME category 1, MSME category 2. After telling these two statements, I told you some other things. AS 14, AS 21, AS 23, AS 27 and AS 25. Especially non-corporate entities generally will not follow these accounting standards because there will be no transactions relating to these items for non-corporate entities. But if at all there are transactions, then they have to follow. Is my point clear? But frankly speaking, sole proprietorship, partnership firm, LLP and cooperative society, nobody asking to prepare interim financial reports. So obviously these people no need to follow AS 25. But company, if it is listed company, then SEBI is asking the listed company to prepare quarterly financial statements. And if at all it is an insurance company, then it is being asked by IRDA. If it is banking company, then it is being asked by RBI to prepare interim financial statements for each and every quarter. Is it clear, everybody? And hence, whichever enterprises which have to prepare interim financial statements, then they have to follow AS 25. And frankly speaking, AS 25 is something like interim financial statements, where the financial statements are prepared for interim period. What do you mean by interim period, sir? Period for which less than or equal to 12 months is there, it is called as interim period. And a full financial year should include 12 months. A full financial year should include 12 months. But if it is less than or equal to less than full financial year, then we will be calling it as interim period. Clear? Less than or equal to kadu, less than 12 months aithe, we will be calling it as interim period. For your kind information, special attention, be careful. If at all, if any company in its first year of operations, in the first year of operations, company might incorporate during the year. Then at the end of the year, it may need to prepare the financial statements for less than 12 months for sure. In such a case, this should not be called as interim financial statements. Is my point clear? Because it is the first year of operations, kada. In the first year of operations, company had incorporated during the year, not at the starting of the year. So since it is operated and existence for less than 12 months, it has to prepare the financial statements only for less than 12 months. In such a case, it is not called as interim financial statements. Respond everybody clear. And the next one, interim financial statements. There are two types of interim financial statements. Number one is complete set of interim financial statements. Number two is condensed set of interim financial statements. What do you mean by complete set of interim financial statements? Complete set of interim financial statements are similar to normal financial statements itself. Until you have to prepare balance sheet, you have to prepare P&L, you have to prepare cash flow statement, and you have to prepare notes to accounts as if you are preparing a financial statements. And whatever the rules that you follow to prepare financial statements, each and every rule you should also follow to prepare interim financial statements. Respond everybody clear. Whereas coming to condensed set of financial statement, it is similar to extract of financial statements. And frankly speaking, if you have chosen to prepare condensed set of financial statements, your financial statements may not tally. Anyways, as per accounting standard number 25, it is prescribing the minimum contents with respect to the condensed financial statements. What are the minimum contents with respect to the condensed financial statements? You have to prepare the financial statements by considering at least the heads and subheads that are there in the previous financial year. Is it clear, everybody? You have to prepare interim financial statements with those heads and subheads which are there in the previous financial year. Let me tell you more clarity. Let me give you an example. Say for example, even we have a question in the material. Last year, company is going with cash sales only. Last year, company had sold only on cash basis. In the current year, company had also started on credit basis. Frankly speaking, in the last year, since no credit sales are there, debtor item is not there. In the current year, if company had chosen to prepare interim financial statements with condensed set, since debtors is a head which is not there in the previous financial statements, it can avoid debtor to show in the condensed set of financial statements. Is my point clear? Those heads and subheads which are there in the previous year, every head and subhead has to be included in the condensed set of financial statements. If that head and subhead is not there, then you can also avoid it. But management can take a decision even to include that item also, if at all it disclosing or presenting that item will give more clarity to the users. Is my point clear, everybody? Pakka. Sir, condensed set, what are the minimum contents you need to present? Those heads and subheads which are there in the previous interim statements, kadama, previous financial statements. In previous financial statements, whatever heads and subheads are there, every head and subhead has to be included in the current year financial statements. Interim condensed. Respond everybody clear. In current year interim financial statements with respect to condensed, you have to prescribe such minimum contents which are there in the previous year financial statements with respect to the heads and subheads. Is it clear? Now moving on to the next thing, listen very, very carefully. Even in interim financial statements also, you are supposed to prepare balance sheet, you are supposed to prepare P&L account, and you are supposed to prepare cash flow statement. And even while preparing interim financial statements, you need to give a comparative information with respect to the previous year. So shall I start now? Sir, concentrate. What is the balance sheet you need to prepare in interim financial statements? Take your last year balance sheet as base and adjust all the transactions till we have completed right from the starting of the year, which is technically called as YTD. What is YTD, Amma? Year to date. So while preparing balance sheet for an interim period, you need to prepare the balance sheet by considering the previous year and YTD. All the transactions happened during the year till the end of the interim period. Is it clear, everybody? And corresponding comparison figure, you have to give previous year balance sheet. You have to give the previous year balance sheet as a comparative figures. And next one, coming to P&L account, you have to prepare the P&L account for the respective interim period. And also you have to prepare for YTD. YTD is nothing but year to date. Right from the starting of the year till the close of interim period, you have to prepare one P&L account and you have to give. And comparative figures, you need to give corresponding interim period of previous year and corresponding YTD of previous year. And coming to cash flow statement, YTD and comparative figure corresponding YTD of previous year. Is the provision clear? Please respond, is the provision clear? Now, concentrate carefully. I am giving you an example. Generally, interim period is equal to quarter. Generally, interim period is equal to quarter. All silver teacups. Whatever. But here all silver teacups kaadu. Q1 is something like April, May, June, July, August, September, October, November, December, and January, February, March. Where Q1, Q2, Q3, Q4. Now, say for example, you are in Q3. So you have to prepare the financial statements for Q3. That is, you are at year ending. I'm sorry, not year ending. Quarter ending December 2016. So what are the interim financial statements you have to prepare? Concentrate. Balance sheet. You have to take the balance sheet. Interim period quarter ending December 2016 ante the financial year is 16-17. Am I correct or wrong? Respond. What is the current financial year? 16-17. What is the previous financial year? So now, while preparing the balance sheet current year, you have to take the balance sheet of 15-16 plus all the transactions right from April 2016 till December 2016. Hey, respond clear, And frankly speaking, you have to prepare balance sheet as on 31/12/2016. Is the statement clear, everybody? And comparative figures, you are supposed to give the financial statements balance sheet relating to 15-16. Sir, next one. P&L account. Sir, is this absolutely clear? And the comparative figures you have to give relating to last year. And you have to prepare the balance sheet till this date. And the next one, P&L account. Take care, my dear children. Current quarter. Ante October, November, December of 2016. And comparative figure will become October, November, December of 2015 you are supposed to give. And also you need to give YTD, that is from April to December 2016. Comparative figure will become April to December 2015. And you have to prepare the cash flow statement from April to December 2016 and the comparative figure will become April to December 2015. Hey, respond, everybody understood? My dear children, this is what the interim financial statements with respect to the inclusions. Now, one more important thing. Sir, what if my company for the first ever time it is preparing interim financial statements? If my company is preparing the interim financial statements for the first time, then you have to give this part. Just wait. Idi. If at all first time you are preparing the interim financial statements, then last year data will not be available. Am I correct or wrong? So you cannot give corresponding interim period of previous year, corresponding YTD will not be available. But corresponding previous year balance sheet is available. Am I correct or wrong? Amma. Yes, anandi chalu. Are you listening? Are you not listening? Anyways, fine. So if at all you are preparing the interim financial statements for the first time, last year interim period data will not be available, and hence you cannot give these as a comparative figures. But since last year balance sheet is available, you have to give this as comparative figure. Respond everybody, clear? Okay. Now some special points to deal with. Point number 1, how to compute tax expense. How to compute tax expense. Be careful, my dear children. While computing tax expense relating to a single financial year, you need to compute weighted average tax rate. Weighted average tax rate is nothing but total estimated tax divided by total estimated profit multiplied by 100 is nothing but weighted average tax rate. Apply weighted average tax rate in order to find tax expense for a particular year. If it is relating only to a particular financial year, if at all the tax expense is relating to two different financial years, then you should not compute weighted average tax rate combinedly. You have to compute the tax rate separately for each and every financial year. Provision clear? Application kaadu, provision clear? If at all, be careful amma, how to compute tax expense. How to compute tax expense. If it is relating to a single financial year, you have to compute weighted average tax rates. If it is relating to multiple financial years, you should not compute weighted average tax rate combinedly. You have to separately compute. Is the point clear? And my dear children, this weighted average tax rate is applicable only for slab rates. It is not applicable for flat rates. Because flat rate ante how much ever you consider, the rate will be same kada. Response, sir. So weighted average tax rate is applicable only for slab rates. It is not applicable for flat rate. Shall I proceed further? Be careful and concentrate. Say for example, what is India's financial year? April to March. You cannot change this. Am I correct or wrong? But say for example, you are following an year from January to December. You are following accounting year from January to December. You cannot change India's financial year. Am I correct or wrong? So there is a possibility. Sir, I hope you know that Finance Act is applicable from April to March. Finance Act is applicable from April to March. So if you concentrate carefully, in the accounting year that the company is following, January, February, March, April to December. Ante previous Finance Act, current Finance Act. Two Finance Acts are there. Here you may get one different rate. Here you may get one different rate. For these two different rates, you cannot apply weighted average tax rate. Example clear? Since the tax rates are relating to two different financial years, you can apply weighted average rate. You cannot apply weighted average rate. You cannot apply weighted average tax rate. Respond everybody, clear? But if at all it is relating only to a single financial year, then you have to apply weighted average tax rate. Respond everybody, understood? Okay, and it is applicable for slab rate, flat rate, both. Okay, this is the last, this is the example relating to this context. Q1, Q2, Q3, Q4. Where in Q1 the profit is 1 lakh, Q2 2 lakhs, Q3 4 lakhs, and Q4 50,000. Now, company sold an asset and make some capital gain in Q3 to the extent of rupees 1.5 lakh. Tax rates. On capital gains it is 10%. On normal income or on normal profit, first 2 lakhs 10%, in excess of 2 lakhs 20%. Is it clear? Sir, example clear? Find tax expense for every quarter. Find tax expense for every quarter. Those students who are watching on YouTube, if you know the answer, please do comment. And you people, if you know the answer, please do tell the answer. What is weighted average? Tell me weighted average tax rate. That's enough. 15.33. Okay. Fine. Not taking much of your time. And point number 1, weighted average tax rate is applicable only for one financial year. Am I correct or wrong? Since nothing is given, you have to assume that every quarter is belonging to the same financial year. And it is applicable only to dash rate sum. It's not applicable for flat rate. So capital gains flat rate or slab rate? Flat rate. So separate that first. Is my point clear? So now be careful, my dear children. What is the total profit? 1 plus 2 plus 4 plus 50,000. Chappandra. 7 lakh 5,000. So out of 7 lakh 50,000, some capital gains tax is there. How much is capital gains portion, amma? 1.5 lakh. This is capital gains portion, and balancing figure, normal profit. How much is that, amma? 6 lakhs. Shall I continue? So now flat rate, tax expense, 1.5 lakhs into 10%, which comes to 15,000. You hold it aside. Next, for this 6 lakhs, 0 to 2 lakhs, 2 lakhs into 10%, in excess of 2 lakhs. That is 2 lakhs into, 2 lakhs to 6 lakhs, 4 lakhs into 20%. This is 20,000 and this is 80,000. So weighted average tax rate is equal to 20,000 plus 80,000 divided by 6 lakhs into 100. 16.66%. Clear, everybody? Now tax expense. Be careful, huh? Tax expense relating to Q1, Q2, Q3, Q4. How much is the profit, amma? 1 lakh into 16.66%. Q2, how much is the profit? 2 lakhs into 16.66%. Q3, total is 4 lakhs. Out of which 1.5 lakhs into 10% capital gains tax. Balance how much is there, amma? 2.5 lakh into slab weighted average rate 16.66%. And Q4 50,000 into 16.66%. Respond, everybody, clear? So this is relating to weighted average tax rate. My dear children, you have to apply weighted average tax rate only if it is relating to a single financial year slab rates. If at all they are relating to different financial years, apply weighted average rate. Don't apply weighted average rate. Don't apply weighted average tax rate. Respond, everybody, clear? And important provision as per AS 25. Sir, AS 25 is interim financial reporting, and you need to prepare interim financial statements. So everybody will be confusing that AS 25 is dealing with presentation aspects. But remember, AS 25 will never deal with presentation aspect, because to present the financial statement, you obviously need to follow Schedule 3. Then AS 25 deals with what aspects, sir? Recognition and measurement aspects. Of course, disclosure is common for each and every standard. Now coming to recognition and measurement aspects, be careful. When to recognize asset, when to recognize liability, when to recognize expense, when to recognize income, when to recognize profits, when to recognize losses. If asset definition satisfied, then recognize it as an asset at the end of reporting period. If liability definition satisfied, recognize it as a liability at the end of interim reporting period. And coming to expense losses, you need to follow accrual concept, and you need to recognize as and when incurred. Whereas coming to income, profits and gains, you need to recognize as and when earned. Respond, everybody, clear? Now very, very important, be careful. If at all such expense or income is relating for the entire financial year, then you need to amortize or defer for the entire financial year. Otherwise, you need to charge only in that particular interim period itself. Is my point clear? So you are paying an expense in the particular quarter. Check out, is that expense relating to that quarter or entire year? If that is relating to that quarter, you need to put only in that quarter. If it is relating for the entire year, you need to defer and postpone the recognition criteria. Understood? In the context of this criteria, you need to check out one more principle, that is, costs which do not qualify as an asset at the end of financial year are also not qualified as an asset at the end of interim period. Is my point understood? Be careful. What are the things that I told you? Asset definition satisfied, liability definition satisfied, record in that particular quarter. Expense, income, liability, profit, gain. If at all they have satisfied, I mean as per accrual concept, as and when incurred, as and when earned. Up to this clear. Now special point, if that is an expense that is relating for the entire year, then don't put that expense only in that quarter. It has to be amortized for the entire year. Provision clear? Now example, if you have remembered, there is a question something called property taxes. You have paid a total property taxes of rupees 60,000 in Q1 only. But this property taxes is paid for the entire financial year. Sir, existing question in your material is different and this question is different. Be careful. You are paying 60,000 property taxes for the entire financial year in Q1 only. Is it clear? And is the 60,000 property tax expense relating only to Q1 for the entire year? And hence this 60,000 has to be amortized for 4 quarters. And in every quarter you need to recognize 15,000 expense. Is it clear? So now how much is paid in Q1? Chichi, how much is paid in Q1? 60,000. But Q1 expense is 15,000. Remaining 45,000 has to be treated as asset. Something like prepaid property taxes. Is my point clear, everybody? Pakka. Now listen to one more example, very very important. You have paid advertisement expenses of rupees 40,000 in Q1. And these advertisement expenses are relating for the entire financial year. Question clear? Paid dash expense. Paid dash expense. Advertisement expense of rupees 40,000 in Q1. And this is relating to the entire year. So quickly answer me. How much amount you need to put in Q1? Is it 40,000 or 40,000 divided by 4? The correct answer is 40,000, but you may be getting it out. Sir, for property taxes, you have done something like 60,000 divided by 4, but for advertisement, you are telling something like 40,000 divided by 4. In this context, you must remember one more provision. Costs which do not satisfy as an asset at the end of the financial year will not qualify as an asset at the end of reporting period. Provision understood? Provision clear? And whichever expense is not to be treated as an asset at the end of financial year, also at the end of interim period, it will not become an asset. Now, advertisement expense. Do advertisement expense qualifies as an asset at the end of the year? No. As per AS 26, it has to be written off in the first year of incurring itself. Since advertisement expense will not qualify for asset at the end of the year, also you should not treat advertisement expense as an asset at the end of interim period. Sir, logic understood? Conclusion enti sir? You check out whether that expense is relating to that quarter, entire quarter. You check out whether that income is relating to that quarter, entire year. That expense and that income relates to that quarter or entire year. If it relates to that quarter, put it in that quarter. If it is relating for the entire year, you have to amortize. Up to this clear? At the time of amortizing, be careful whether such expense can be qualifying as an asset at the end of the year or not. If yes, then you can also treat here as asset. If that expense cannot be treated as asset at the end of the year, then for interim period also you should not consider that as an asset. Respond everybody, clear? My dear children, the last and final point relating to interim financial statements. Sir, think with common sense and answer me. For Q1 following FIFO method and for Q2 following weighted average method for valuation of inventory, possible or not possible? Is it possible or not possible? Enduku not possible? In Q1 they are valuing FIFO method. In Q2 they have decided to change their method. What is so special in that? Is my point clear? Yes, it is absolutely possible. But the problem here is all about 1 year, one method. Sir, are you getting my point? In one quarter, one method, another quarter, another method followed. Yes, that can be absolutely followed. But the biggest point that you need to understand here is all about generally 1 year, one method. So conclusion, at the end of the year, which method you are following? Weighted average method. Ray, ante kadara. At the end of the year, which method you are following? Weighted average method. But here what happened, amma? Q1 FIFO method, Q2 weighted average method. Automatically valuation will differ. Am I correct or wrong? This is nothing but change in accounting policy. If any change in accounting policy is there, you have to give dash effect, amma. Retrospective effect right from Q1 itself. Right from Q1 itself. And whatever the change in amount is there, you have to book in that respective quarter. Now you are changing in which quarter? You are changing in which quarter? Second quarter. Followed FIFO in Q1, followed weighted average in Q2. You are changing from FIFO to weighted average in Q2. So automatically some valuation difference will be there. Am I correct or wrong? You have to transfer to P&L account relating to Q2. Simple. Whenever you are changing, put that in that quarter. Is it understood? Next one. Be careful, huh? Change in accounting estimate. In one quarter, you are estimating differently. In another quarter, you are estimating differently. You have to give dash effect. Prospective effect. Is it clear? But there is an important point. Change in method of depreciation. It is an accounting estimate only. But you have to give retrospective effect right from Q1. Reason is again same. 1 year, one method. 1 year, one quarter following SLM, another quarter following WDV will not make sense. 1 year, one method. Is it clear? So be careful. Change in accounting policy in between the quarters. Dash effect. Retrospective effect right from Q1. Change in accounting estimate between the quarters. Prospective effect. Change in method of depreciation. Even though it is change in accounting estimate, you have to give dash effect, amma. Retrospective effect. Reason being 1 year, one method. And at the point of change, check the valuation difference, and that difference will be taken to P&L account in that quarter only. Respond everybody clear, huh? And my dear children, this is the end of phase 25. Clear everybody? Just have a look with respect to age 25. If you observe, the financial year ends on 31st March. Until this one. But the company is following the accounting year ending on 30th September. Until from 1st October to 30th September. So frankly speaking, 2 quarters fall in different financial year and 2 quarters fall in different financial year. So for computing tax expense, you cannot average is 2 different financial years. So for one quarter, you need to apply 20% and for another quarter, you need to apply 30% as it is. Is it clear? But if you observe this problem, Q1, Q2, Q3, Q4, 4 different quarters with different slab rates. Up to 5 lakhs it is 30% and on the balance income it is 40%. Here since everything is relating to the same financial year and slab rates are there, in this context you are supposed to apply weighted average tax rate, or it is also called as ETR antaru, effective tax rate. Is it clear everybody? Fine. Sir, now to tell you this question, this is simple but just listen carefully. Dividend income of 4 lakhs, we are in third quarter, amma. We are in Q3, you remember that. Dividend income received 4 lakhs. But the company is recognizing only 1 lakh anta. You have received 4 lakhs in Q3, but the company is thinking, let me amortize this 4 lakhs for 4 quarters and I need to record only 1 lakh in Q3 antundi. Now tell me what is correct. Recognizing 4 lakh correct? Only 1 lakh correct? 4 lakhs, because as and when the income is earned, you have to record in that quarter only. So dividend is earned in Q3. So you need to record in that quarter only, kada? So how much you have to record? But how much they have recorded? So automatically 3 lakhs short recorded, kada? So you need to add back 3 lakhs for that. Is the point understood, everybody? Next, be careful, huh? Total sales promotion expenses are 15 lakhs. We have incurred the same in third quarter. But company would like to postpone 80% of sales promotion expenses to the last quarter. Is it clear? How much you have incurred in the current quarter? 15 lakhs. How much you have to book in the current quarter? 15 lakhs. So amortizing or deferring 80% to the next quarter. Correct or wrong? Wrong. So 80% of 15 lakhs, which comes to 12 lakh. Company did not book the 12 lakh in this quarter. So now to rectify the error, you need to book 12 lakhs in the current quarter. So minus 12 lakh. Hey, is it clear? You have to deduct 15 lakhs, but you are not deducting 80%. So you need to deduct that 80% now. Shall I proceed further? 2 lakhs extraordinary gain received in third quarter. And company is amortizing equally to third and fourth quarter. Correct or wrong? So 2 lakhs gain received in third quarter. And company had recorded that for 2 quarters. Is it correct or wrong? How much gain you have received? You have to book the 2 lakhs in which quarter? But company is amortizing it for both Q3, Q4. Ante it had recorded only 1 lakh in this quarter. How much you have to record? 2 lakhs. But how much you are recording? So rectify the error. You have to add 1 lakh. Is it clear, everybody? Next one. Sale of investment in first quarter. You are in dash quarter now. Sale of investment in first quarter and you have got a profit of 20 lakh. So you have to record this profit of 20 lakhs in Q1, because that is a point where you have got the income, earned the income. Am I correct or wrong? But company is apportioning equally to this 4 quarters. Ante 20 lakhs divided by 4 quarters ani. For each and every quarter, company had recorded 5 lakhs annamata. Is it clear? So now answer me. Recording 5 lakhs in Q3, correct or wrong? So take off the profit and the rectification of error minus 5 lakhs. Hey, up to this clear, everybody? Now check out the point what I left, C and E. Point number C. In the third quarter, company had changed the method of depreciation from WDV to SLM. So this is nothing but change in method of depreciation. Give dash effect. Retrospective effect right from Q1. Whenever you are giving that retrospective effect, you have to book excess depreciation 12 lakhs in that quarter. Is it clear? You have to book 12 lakhs excess depreciation. Now answer me, when should you book that extra 12 lakhs? In that quarter, amortizer. Changed the method of depreciation in Q3. In Q1, Q2, they have followed WDV. In Q3, they have shifted to SLM. So you have to give retrospective effect. Whenever you are giving retrospective effect, you have to book extra 12 lakhs. When should you book this extra 12 lakh? In that quarter, amortize for every quarter. In that quarter only. నేను ఒక పాయింట్ చెప్పా, ఇఫ్ ఎనీ చేంజ్ ఇన్ మెథడ్ ఈస్ దేర్, వెనెవర్ యు ఆర్ గివింగ్ రెట్రోస్పెక్టివ్ ఎఫెక్ట్, ఫైండ్ ద వాల్యుయేషన్ డిఫరెన్స్ అండ్ బుక్ ఓన్లీ ఇన్ దట్ క్వార్టర్. సర్, ఈస్ ఇట్ క్లియర్? Hope you might have understood why I am dealing with these questions now. Application will make more clear. Anyways, so ultimately you have to book 12 lakhs in dash quarter amma Q3. Assala enta great ante sometimes examiners will confuse you like this. Chudande, entire amount has been debited in the third quarter even though the share of third quarter is 3 lakhs. నువ్వేమనుకుంటావు? Oh, company has done wrong. Share of third quarter is only 3 lakhs, but company had booked 12 lakhs, extra 9 lakhs booked. Take off that 9 lakhs and rectify the error. అదే కదా మనం అనుకునేది. Frankly speaking, that will happen కదా. But frankly speaking, company debited entire amount in the third quarter is correct. Share of third quarter 3 lakhs point wrong. But deliberately is confusing you. Take care. Shall I proceed further? Next student, point number E. This is different. Cumulative loss arising from change in method of inventory valuation. Sir, point number 1. You have changed the method of inventory valuation. If you changed in Q2, difference should be booked in Q2. If you change in difference should be booked in Q3. And in whichever quarter you have changed, book the difference in that quarter. Am I correct or wrong? But check out what happened here. Change in method of inventory and cumulative loss resulting was recognized in the third quarter is 3 lakhs. Out of this, 1 lakh relates to the previous quarter. How much cumulative loss recognized, Anta? In Q3. Out of which 1 lakh is relating to the previous quarter. And which implies that 2 lakhs is relating to Q3. Is my point clear, everybody? Now answer me. How much you have to book in Q3? 3 lakhs or 2 lakhs? Question clear? Cumulative loss recognized in third quarter 3 lakhs. This is done. But in the question telling that is relating to the previous quarter, which implies that 2 lakhs is relating to Q3. Is it clear? This is given in the question. Now my question to you, what is the correct amount to be booked in Q3? 3 lakhs or 2 lakhs? Enduku 3 lakhs? Generally, ఇప్పుడు మీరు ఏమనుకుంటారంటే change in method of inventory happened in Q3 కదా sir, and hence entire amount of 3 lakhs has to be booked only in Q3. అంతే కదా? Now check out this point. Where did he tell that method of inventory is changed in Q3? A logic చూడండి. How is he framing? You have to understand. In point number C, in third quarter company changed depreciation method. In point number E, he did not tell in which quarter it was changed. Method of inventory valuation is changed. Okay. That's okay. When did it change? He did not tell that. Is it clear? Ante, as per the question, they might have changed 2 times. In Q2 they might have changed and also in Q3 they might have changed. Is it clear? Asala adanta enduku? Change in method of inventory, some loss is there. What is the total loss given? 3 lakhs. He did not tell for which quarter it is relating to. He did not tell in which quarter the change is done. He did not tell for which quarter the change is done. But given 2 points. For the last quarter it is relating to 1 lakh. For Q3 it is relating to 2 lakhs. There ends the matter. How much you have booked? 3 lakhs. But relating to current quarter it is only 2 lakhs. So 1 lakh loss extra booked. So you need to take back and rectify by adding that loss of 1 lakh. So is my point clear? Ante please be careful how differently he is asking the points. Point number C lo, in third quarter depreciation method is changed. So whatever the difference is there, it has to be booked only in third quarter. In point number E, yes, there is a change in method of inventory. But in which quarter it was changed, he did not tell. But he is telling total loss is 3 lakhs. Out of which 1 lakh is relating to previous quarter. So in Q3 you should book only 2 lakhs. But you have booked how much? 3 lakhs. Extra booked how much? 1 lakh. Take it off and rectify. Respond everybody clear. Fine, my dear children, that is the end of AS 25 even with respect to the problematic part. Okay. Sir, AS 29. What is AS 29, Amma? Provisions, contingent liabilities and contingent assets. So simple standard, nothing great at all. But you have to analyze a lot while solving the questions. Likewise, whether there is present obligation or not. That is all the standard is all about. Now, sir, AS 29 deals with such kind of provisions which are not being dealt by any other standard. Is it clear? Respond, is it clear? Any doubts to anyone? With respect to AS 4, I told you the same thing actually. Such kind of contingencies and such kind of provisions which are not dealt by any other standard will be dealt by AS4. And now also I am saying the same, which are not dealt by any other standard, dealt by AS29. So then what are being dealt by AS4 and what are being dealt by AS29? It's very simple. Sir, as per AS29, provision should become a liability. So, as per AS29, that's a provision which is a liability which is not dealt by any other standard is dealt by AS29. Now, if any provision is not also being dealt by AS29, then it is being dealt by AS4. Example, impairment of current asset. That is nothing but provision for bad debts. You are creating provision for bad debt. You are creating provision for bad debts as per AS4. Did you remember? Likewise, if at all there is a condition existing on the balance sheet date, say for example debtor's premises was caught by fire and declared insolvency after the balance sheet date but before the date of approval of the financial statements. In this context, you need to create a provision. Am I correct or wrong? Chapandi. Take care. So provision for bad debts is some provision which is not dealt by any other standard including AS29 and hence it is being dealt by AS4. So now what is the order? If there is a provision and if it is dealt by any other standard, make it deal with that standard only. If it is a provision and it is in the nature of liability and if it is not being dealt by any other standard, then AS29 will deal with it. Even if that provision is not being dealt by AS29, then AS4 will enter into the picture. Is my point clear? Sir, already I have discussed some things. Provision for diminution in the value of inventory. AS2 will deal with it. Provision for diminution in the value of investments. AS13 will deal with it. Provision for loss on contracts when contract cost exceeds contract revenue. AS7 will deal with it. Is it clear, everybody? So, if at all there is any provision for warranty, since provision for warranty is not dealt by any other standard and also it is in the nature of liability, AS29 will deal with it. Respond, everybody, clear? Sir, what do you mean by a provision? Point number 1, provision is a liability. Provision is a liability which is measured with substantial degree of estimation. This is the definition given as per AS29. And schedule 3 is giving another definition for provision. Provision is a liability which cannot be measured with substantial accuracy. This is the definition given as per schedule 3. Whatever, provision is something where estimation is there. And as per AS29, provision is something like a liability. Respond, everybody, clear? Okay, now moving on to the next thing. What do you mean by a liability? Liability is something which is having present obligation. First of all, what do you mean by obligation? Obligation is nothing but responsibility which is arising either by law or by contracts or in order to maintain some good relations. What do you mean by law? Say for example, a law is asking you to pay something, EPF. You have to pay provident fund as per law. Am I correct or wrong? Hey, respond, Ra. You have to pay provident fund as per law itself. Yes, and hence it's obviously an obligation arise to you. And say for example, warranty. Provision for warranty. No law will be asking you to provide provision for warranty, but you will be providing warranty out of the contract. By the time when you are purchasing my product, then I will be providing warranty for 2 years. So it is arising from contract. Sometimes obligation might arise. Best example, creditor. Best example, creditor. Sir, listen very carefully. I have purchased goods on credit basis. Do I need to pay the creditor or not? Sir, answer. Purchasing goods from creditor on credit basis. Do I need to pay him or not? Why? Frankly speaking, no law is asking me to pay the creditor. Even creditor and me did not enter into any contract. But to maintain some good relations. Tomorrow I may need the help of the creditor once again. Am I correct or wrong? I may need to return the goods. Sir, after purchasing the goods from creditor, I cannot tell, hey creditor, no law is asking me to pay you. There is no contract between you and me, and hence I don't pay. Frankly speaking, he can't do anything because ownership transferred, invoice given. What can he do now? Frankly speaking, he can't do anything. But in order to maintain some good relations, even obligation will be arising. Clear? So obligation is nothing but a responsibility which is arising either by law or by contract or in order to maintain some good relations. Clear, everybody? Now obligations are of three types. Number one is present obligation, number two is possible obligation, number three is future obligation. Is it clear? What do you mean by present obligation? As on the balance sheet date, outflow of future economic benefits is considered as probable, or it is nothing but more likely than not to occur a liability. Is it clear? Present obligation, as at the balance sheet date, an obligation is considered to be probable. What do you mean by that, sir? More likely than not to occur a liability. Is it clear? What do you mean by possible obligation? As at the balance sheet date, equally likely to occur or less likely to occur a liability. What do you mean by future obligation? Obviously, that obligation is not there as on the balance sheet date at all. Is it clear? And hence, no need to create a provision for future obligations. Now, you need to create a provision only for present obligation. Clear, everybody? If it is a possible obligation, equally likely chances to occur a liability or less likely chances to occur a liability, and hence no need to create a provision, just disclose it as a contingent liability. Now, very, very important, as at the balance sheet date, there is an obligation which is considered remote. What do you mean by remote, sir? Chances of occurring the liability is very less. In such case, simply disclosure is also not needed. Is my point clear, everybody? Sir, obligation. If it is future obligation, no need to create a provision. If it is present obligation, ante more chances of occurring a liability, so you need to create a provision. If at all the obligation as at the balance sheet date is possible and equally likely or less likely to chances, then obviously it is a contingent liability and disclose the same at footnote of the balance sheet. And if at all as at the balance sheet date, the obligation is considered as remote and a very less likely chances to occur, so no need to create anything, no need to disclose anything also. Respond understood? Okay. Example to support this concept. Sir, say for example, you have given guarantee. You have given guarantee to Mr. B. And you are something like Mr. A. Mr. A had given guarantee to Mr. B on behalf of the loan which is taken by Mr. C. So who has to pay to whom? Chala kashtaమైన question kada. Who has to pay to whom? C has to pay to B. But if at all C is not paying, then who has to pay? A has to pay. So as at the balance sheet date, how Mr. C's position is there, you need to check out. Sir, Mr. C is operating his business from right 20 years. He is absolutely financially sound. Absolutely no problem at all. And budgets are prepared by the management of Mr. C for the next 25 years. The company of Mr. C is super profitable. So what is the obligation chance? Present, possible, remote. Remote. So no need to do anything. Is it clear? So now, as at the balance sheet date, Mr. C's position is good. Mr. C's position is absolutely good. But you cannot tell what may happen in future. So it will become possible and you need to show it as a contingent liability. As at the balance sheet date, Mr. C's position is worst. So chances are high that Mr. C will evade the payment to Mr. B. Then who has to pay? A. And hence he need to create a provision. Respond everybody, clear? So now moving on to the next thing, something like provision. You should not create provision for dash obligation at all. But if at all future obligation is virtually certain ante 100% chances of occurring, then you need to create a provision for all such obligations. You understood? If at all future obligation is virtually certain, then you need to create a provision for all such future obligations. Respond, everybody understood? Okay. Now moving on to the next thing. What do you mean by a contingent liability? చాలా జాగ్రత్తగా వినండి. Number 1, a possible obligation is obviously always a contingent liability. Possible obligation ante as at the balance sheet date, equal chances of occurring or less likely chances of occurring. It is always a contingent liability. A present obligation which cannot be measured with substantial degree of estimation, even that also will become a contingent liability. A normally present obligation is dash. Present obligation, liability. Liability is dash obligation, right? So a present obligation is dash liability. If present obligation is exactly measured, it's a liability. If present obligation is measured with substantial degree of estimation, it is a provision. If a present obligation is cannot be measured reliably, that is a contingent liability. And if any contingent liability is there, you obviously need to disclose the same at footnote of balance sheet. And the last and final one, contingent asset. Sir, contingent asset is again same as at the balance sheet date. There is a possible asset whose existence shall be confirmed in future upon happening or non-happening of one or more uncertain future events. In this context, whatever the contingent assets are there, it should not be disclosed in the financial statements at all. And they have to be disclosed in approving authorities report. That is dash report, board of directors report. Till now we have learnt in AS4, dash events will not be disclosed at all. Non-adjusting event. In the similar way, even contingent assets are also not at all to be disclosed in financial statements. They shall be disclosed in approving authorities report. Respond, everybody, clear? One more small clarification with which I am going to close the class. You need to create a provision only for present obligation where it is possible to measure with substantial degree of estimation. You should not create a provision for future obligation. But take care, my dear children, if at all virtual certainty is there, then you need to create a provision. Example in this context, which is given in the standard only. Say for example, you are contaminating the environment. You are causing damage to the environment, and hence government had identified this, and government is going to bring a law in future wherein you have to clean up the environment. This is almost certain. Internally it is circulating, which is almost certain. Is it clear? Ante point number 1, as of now you are causing damage to the environment, but is there any obligation to clean the environment? No. But in future when law comes, hey, is my point clear? Now you are damaging the environment. Yes. But is there any responsibility to clean up the environment damage? But whenever the law is introduced in future, yes, you need to. And point number 1, you have to clean up the environment. Is it a future obligation or present obligation? That's obviously a future obligation. So point number 1, no need to create a provision. But if law is going to enact for sure, whenever there is virtual certainty, then obviously you need to create a provision. Respond, everybody, clear? Edo aipoyindi. And anyways, my dear children, ultimately for your kind information, accounting standard number 29 is also completed. Shall we start now? So tell me, my dear children, what is the chapter that we are going to start? Buyback of what? Buyback of securities, which is very simple, very easy chapter also. What do you mean by buyback of securities? A company buying back its own securities. This is purely similar to your redemption of preference shares, but not exactly same. Now, coming to buyback of securities, listen, a company can buy back the securities, but it needs to fulfill the tests for buyback, which is very, very important. Take care. A company can buy back how many securities it wants, it can buy back that many securities. But in this course of action, it needs to fulfill the tests for buyback. In the sense, maximum number of buyback. How many shares does a company can buy back? List of the following tests. Totally 3 tests were given. Test 1, outstanding shares test or shares outstanding test. Maximum number of shares that it can purchase is 25% of outstanding number of equity shares. Test number 2, resource test. Maximum resources that can be utilized for the purpose of buyback is equal to 25% of share capital plus free reserves. Inka clear ga aithe share capital plus reserves and surplus. Now what do you mean by share capital, sir? It includes both paid up. Share capital includes paid up share capital, that is paid up equity share capital, and paid up preference share capital. And coming to reserves and surplus, it includes all the free reserves and also securities premium. And maximum number of equity shares under buyback test is equal to maximum resources that are used for buyback divided by buyback price. You will be having a buyback price given in the question. You have to use that buyback price and you have to find how many maximum number of equity shares that you can purchase as per test number 2. And the last and final test number 3, debt equity test. What is test number 3, Amma? Debt equity test. What is debt equity test? My dear children, debt is to equity. You have to maintain a minimum ratio of 2:1, which implies that debt by equity is equal to 2/1. So maximum equity that you can utilize is equals to half of debt. Is it clear? Maximum equity that can be bought back is equal to half of debt. Is it clear? But very, very important, you have to maintain this ratio after buyback. In the sense, after buying back, you should have a minimum ratio of 2:1. So maximum equity that you have to maintain is half of the debt after buyback. So maximum equity that could be utilized for buyback is half of debt after buyback. Is it clear, everybody? Now the biggest point. What do you mean by debt here? And what do you mean by equity here? Debt is nothing but all the outside liabilities are considered as debt, which implies all the current liabilities and non-current liabilities. Take care, as per your FM, debt includes only long-term or non-current, but as per buyback chapter, debt includes both current liabilities and non-current liabilities, including outstanding expenses, including creditors, including current maturities of long-term debt. Everything will be included. And now coming to equity, what includes in equity, sir? So simple, Amma. Whatever is shareholder funds as per test number 2, that is nothing but equity as per test number 3. Whatever is shareholders funds as per test number 2, that is nothing but equity as per test number 3, which is nothing but resources. Whatever resources as per test number 2, the same is nothing but equity as per test number 3, which implies that equity includes paid up equity share capital plus paid up preference share capital plus paid up free reserves plus securities premium. My dear children, for the purpose of section 68 of Companies Act 2013, that is for the purpose of buying back of securities, even securities premium can also be considered as free reserves. Respond, everybody. Clear? So understood? Now very, very important is test number 3 only, because you have to frame the equations properly. Sir, listen very, very carefully, everybody. Say for example, there are 10,000 equity shares at the rate rupees 10 on a whole, which comes to rupees 1 lakh. and there are free reserves and securities premium to the extent of 20,000 and 30,000, and total amount of resources available is 1,50,000. Now, say for example, debt in total is equal to 3 lakhs. Sorry, debt in total is equal to 1.5 lakh. How much debt in total available? 1.5 lakh. As per test number 3, you have to maintain debt is to equity in the ratio 2:1. That is, maximum equity that should be used is half of debt. That is equal to half of 1.5 lakh, which comes to 75,000. My dear children, you can utilize 75,000 for the purpose of buyback after buyback. Sir, you have to utilize 75,000 for the purpose of buyback after buyback. In the sense, it is something like you can give 5% managerial commission after charging commission. You can give 5% managerial commission after charging commission on the net profit. And a managerial commission is equal to 5% of net profit after charging commission. Hey, is it clear? And a managerial commission is equal to 5 by 105 into net profit before charging commission. Am I correct or wrong? Similar way, maximum equity that could be utilized is 75,000 after buyback. But you would like to know before buyback ante 75,000 divided by face value plus buyback price. Is the point clear? Huh? Maximum equity that you can utilize is equal to 75,000 after buyback. For buyback, you can utilize 75,000 after buyback. But we don't know exactly how many shares we are going to bought back. Am I correct or wrong? To crack that, maximum funds that can be utilized divided by face value plus buyback price. Is the point understood? But to crack this, you have to frame two simultaneous equations. And be careful for framing these simultaneous equations. Sir, observe carefully. How many maximum number of equity shares that you can buy back is equal to? Maximum number of equity shares that you can buy back is equal to, from the maximum resources, you need to set aside some portion for CRR. Am I correct or wrong? Sir, from the maximum resources, you need to set aside some portion for CRR, whole divided by buyback price. Now, how much amount I have to transfer for CRR, sir? Maximum number of equity shares that are to be bought back multiplied by face value. Is the point clear, everybody? Please participate. Is the point clear, everybody? What are the maximum number of equity shares that you would like to buy back? Maximum resources that you can use minus CRR divided by buyback price. How much CRR you need to create, Amma? Maximum number of equity shares that are to be bought back multiplied by face value. Is the point clear, everybody? So now say for example, maximum number of equity shares to be bought back. Let me call this as X is equal to maximum resources that you can utilize is 75,000 as per our example, minus CRR, we don't know, divided by, say for example, the buyback price is 20 rupees. What is the buyback price, Amma? 20 rupees. That implies X is equal to 75,000 minus CRR, let me call it as Y, divided by 20. Respond, is the equation clear to each and everyone? Now the next one, equation number 2, CRR, I have assumed it as Y, is equal to maximum number of equity shares to be bought back, X, multiplied by face value is nothing but 10. which implies y is equal to 10x. Y is equal to 10x. So now substitute the same in the equations so that you are going to get the final answers. Shall I start now? So now y is equal to 10 into x amma. X ante 75,000 minus y divided by 20. Am I correct or wrong? Sir, please participate. That is equal to 10 into 75,000 minus y divided by 20 and y. That implies 20y is equal to 10 into 75,000. 7,50,000 minus 10y. That implies 20y plus 10y is equal to 7.5 lakh. That implies y is equal to 7,50,000 divided by 30, which is nothing but 25,000. Is it clear? Y is nothing but total CRR. And CRR is equal to 25,000. Am I correct or wrong? CRR is equal to number of equity shares that are to be bought back multiplied by face value. That implies 25,000 is equal to number of equity shares that are to be bought back multiplied by rupees 10. Therefore, number of equity shares to be bought back is equal to 2,500. Respond everybody, clear? Like this you are supposed to solve in the examination for sure by framing the simultaneous equations. Now let me tell you the shortcut here. Just breaking this. Y is equal to 7,50,000 divided by 30. Am I correct or wrong? Sir, cheppali. That is equal to, can I write like this? 7,50,000 divided by 20 plus 10. So please participate. Can I write like this? 75,000 divided by 20 plus 10. Am I correct or wrong? So check out, you will be getting something like 7,50,000 divided by 20 is nothing but buyback price. 10 is nothing but face value. Is it clear? So that is obviously nothing but maximum resources that can be utilized for the buyback divided by buyback price plus face value. Then you are going to get the number. Adega cheppindi. If at all you are solving like this, you are going to get the maximum CRR. So check out. What is the maximum resources now you can utilize as per our example, amma? 75,000. Am I correct or wrong? So 75,000 maximum resources divided by buyback price 20 plus face value 10. That is 75,000 divided by 30. Where you are going to get the final answer. I hope you know the two alternatives. But which alternative is to be used in the exam depends on the time that is available in the exam. 99.9% is highly recommended to solve under simultaneous equation basis only. But if at all you were asked in MCQs, then automatically this shortcut is going to help you a lot and lot. Shall I proceed further? Okay. What is test number 3? Debt equity test. My dear children, what is test number 3? Maximum ratio, minimum ratio that you are supposed to maintain is 2:1 after buyback. So maximum equity that you can utilize for buyback is equals to half of debt after buyback. Maximum equity you have to utilize for buyback is equals to half of debt after buyback. Respond everybody, clear? And the remaining half, whatever is there, you can you have to maintain. One half you can utilize, another half you can maintain. Respond everybody, clear? So now actually you have to solve test number 3 in some tabular format. What is that, sir? Maximum resources available. As per our example, maximum resources available are maximum resources available. First of all, sir, just wait. Let me tell you test number 3 in the tabular format. Something like resources. Resources includes equity share capital plus preference share capital plus free reserves plus securities premium. Put all the resources here. Is it clear, everybody? Next one, debt available. As per our example, debt is 1,50,000. Minimum equity to be maintained. Minimum equity to be maintained is equal to half of debt. That is equal to half of 1,50,000, which comes to 75,000. So maximum equity that can be utilized is equal to existing equity minus minimum equity to be maintained. Sir, ante kada? Existing equity minus minimum equity to be maintained. What is our existing equity on a whole? 1,50,000. What is minimum equity we have to maintain? 75,000. What is the maximum equity you can utilize? 1,50,000 minus 75,000, where it comes to 75,000. Respond, everybody. Clear? Let me give you one more example. Last and final example relating to test number 3 to get more clarity. Equity shares is equal to say for example, this time 50,000 equity shares at the rate rupees 10, where it comes to 5 lakhs, and all other free reserves is equal to 1 lakh, and securities premium is equals to 2 lakh. On a whole, you are going to get 7 lakhs. 8 lakhs. I'm testing you. And you are sleeping, kada? Yes, sir. Are you sleeping? But partial sleeping. So maximum amount available to you is like 8 lakhs resources. Now be careful, amma. Current liabilities is equal to 3 lakhs and non-current liabilities is equal to 7 lakhs. Is it clear, everybody? Now buyback price is equal to 25 and face value is equal to 10. Tell me how many number of shares you are going to buy back as per test number 3. As per test number 3, how many shares you can buy back? Zero. 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 I don't think 0 is the correct answer. Eight five 7 1 point something, whatever. Sir, so simple. You are supposed to maintain half of debt. Yes or no? Minimum equity to be maintained is equals to half of debt after buyback. That is equal to half of, what is your total debt, amma? 10 lakhs. That is equal to 5 lakhs you are supposed to maintain after buyback. Am I correct or wrong? So maximum equity to be utilized is equal to, sir, what is the total equity that is available to you? 8 lakhs. Am I correct or wrong? Minimum equity to be maintained after buyback is equal to 5 lakhs. So out of 8 lakh, if you utilize 5 lakh, balance available to you for balance equity to be utilized is equal to 3 lakhs for the purpose of buyback. Sir, understood? Quickly answer me, minimum equity to be maintained is equal to? Please tell me, minimum equity to be maintained is equal to half of debt. Maximum equity that could be utilized is equal to total equity available minus minimum equity. That is 8 lakhs minus 5 lakh. How much you have got, amma? 3 lakhs. So now maximum number of equity shares is equal to simply 3 lakhs divided by face value plus buyback price. That is 3 lakh divided by 10 plus 25. 3 lakh divided by 35, which comes to 8571. Respond, everybody. Clear? Any doubts to anyone? That's it. You can frame simultaneous equations. So for the last and final time, revising debt equity test. Debt equity test. Tell me, what is debt equity test? Minimum debt is to equity ratio you are supposed to maintain is 2:1, which implies that minimum equity to be maintained is equal to half of debt after buyback. So maximum equity to be utilized is equal to present equity or present resources or present shareholders funds minus minimum equity. Is it clear, everybody? This one whole divided by buyback price plus face value. You are going to get the answer directly. So remember, these two things are important. Minimum equity to be maintained is equal to half of debt. Maximum equity to be utilized is equal to present equity minus minimum equity. Number of shares is equal to whole divided by buyback price plus face value. Respond, everybody, clear? So now moving on to a bit further, how to frame the simultaneous equations. Sir, maximum number of equity shares that you can purchase is equal to maximum resources that can be utilized or maximum equity that can be utilized whole divided by face value. But out of this portion you have to utilize some portion for CRR. Now the next one, how much CRR you need to create? Maximum number of equity shares that you are going to buy back multiplied by face value. These are the two simultaneous equations. Is it clear? There wrong, huh? I'm sorry. Yes, this will become buyback price. These are the two simultaneous equations. Respond, is it clear? My dear children, how many shares does a company can buy back? Least of the following three tests. Test number 1, shares outstanding test. What are shares outstanding test? 25% of outstanding equity shares. Test number 2, resource test. Maximum resources that can be utilized is equal to 25% of paid up share capital plus free reserves plus securities premium. Maximum number is equal to maximum resources divided by buyback price. And last and final test number 3. What is test number 3? Debt equity test. Minimum ratio you are supposed to maintain after buyback 2:1. So minimum equity you have to maintain is equal to half of debt. Maximum equity that you can utilize is equal to present equity minus minimum equity to be maintained. In a shortcut, how many number of shares ante whole divided by buyback price plus face value. But while framing equations, two things, be careful. Respond, everybody, clear? Least of the following, these three tests could be considered as number of shares that can be bought back by a company. Up to this, clear, everybody? Now, very important, decide number of equity shares does a company needs to buy back. Decide number of equity shares that a company needs to buy back. And very important, before buying back, sir, once at all, if you are buying back, your capital will reduce. Am I correct or wrong? Whenever your capital is reduced, who will get dissatisfied? Shareholders, creditors or outsiders will get dissatisfied. In order to maintain and protect the interest of outsiders or the creditors, you have to match the capital requirement, or you have to fill the capital gap. Is my point clear? Sir, before buying back, with buying back, number of equity shares will reduce. If number of equity shares are reduced, then the size of your business is getting reduced. If size of your business is getting reduced, then automatically you might feel something like, the creditors might feel something like the company may not be able to do the business properly. So the creditors might not get their dues proper repayments, and hence to satisfy the creditors, to protect the interest of outsiders, you have to fill the capital gap. You have to match the capital requirement, where you can do the same either by issuing new shares, fresh issue, or by creating CRR, or with a combination of both fresh issue and CRR. Is it clear? So now coming to fresh issue, you can issue any other kind of securities. What are the securities you are buying back? Participate, what are the securities you can be buying back? And hence other kind implies you can issue preference shares, or you can issue equity shares with DVRs, differential voting rights. Clear? Say for example, you would like to purchase rupees 10 lakhs face value of equity shares. You would like to buy back rupees 10 lakh face value of equity shares. Now, before buying back this rupees 10 lakh face value of equity shares, first of all, you have to fill the capital gap either by issuing fresh issue or by creating CRR. Now, the company before buying back, it can issue preference shares to the extent of 10 lakhs. How many preference shares issued? How many preference share capital issued? 10 lakhs. How much equity shares is being bought back? So minus 10 lakh plus 10 lakh, it will get matched. Cheppandi clear? Or another option is to create CRR. You can create CRR from free reserves and the journal entry will become free reserves account debtor to CRR account. You can create 10 lakhs. Automatically CRR raised how much amma? 10 lakhs. And how much equity share capital you would like to buy back amma? 10 lakhs. Automatically it gets matched. Or you can also do a combination of both. Company would like to issue preference share capital of rupees 4 lakh. But company would like to buy back how much equity share capital amma? 10 lakhs. But how much preference share capital issued amma? 4 lakhs. Balance 6 lakhs it can go for creation of CRR. Respond everybody clear? There ends the matter. Is it clear? Now take care, in one of our questions, even in the question, redemption of preference shares are also there. Redemption of preference shares is also there. Buyback of securities is also there. So now in this context it's very important. If you would like to buy back 6 lakhs rupees value of equity share capital face value, and if you would like to redeem 2 lakh face value of preference share capital. Now you are redeeming how much capital in total? How much capital you are redeeming in total? So before redemption of this 8 lakh, you must fill the capital gap first, either by issuing a fresh issue or by creating CRR. Is my point clear, everybody? So now one more important thing, you can issue fresh issue from either preference share capital or equity shares with differential voting rights. You cannot issue same equity shares. You cannot issue same equity shares. Point number 1, proceeds from debentures is not considered as fresh issue. Proceeds from securities premium is not considered as fresh issue. Proceeds from debentures not considered as fresh issue. Proceeds from securities premium is also not considered as fresh issue. Respond everybody clear? Now concentrate carefully. Company would like to redeem preference shares to the extent of rupees 2 lakh face value, and company would like to buy back the securities at rupees 10 lakh equity share capital face value. To do this one, company would like to match the capital requirement through both fresh issue and CRR. And company is having 5.5 lakh free reserves with which it had created CRR. And company would like to issue fresh issue, that is preference share capital. Is my point clear? At a price of rupees 12, where the face value is 10 and securities premium is 2. And also company is issuing rupees 1 lakh 6% debentures. Is the question clear? Now tell me, how many number of shares, number of preference shares that the company has to issue to redeem and buy back? 80? 25,000. So question clear kada? Company would like to redeem the preference shares and company would like to buy back the securities. To carry on these things, some portion company created CRR. Now company would like to go for fresh issue. For how many number of preference shares it has to issue? 25,000. Everybody clear? Okay, let me cross check the answer. Sir, originally it comes to how much amount, amma? 5.5 lakh CRR created. What is the total amount you need to match, amma? Out of 8 lakh, if CRR 5.5 is created, balance 2 lakh 50,000. So 2 lakh 50,000 divided by 12 rupees or 10 rupees? 10 rupees. Reason being, premium should not be considered as fresh issue. Debentures should not be considered as a fresh issue. So 2.5 lakh divided by 10, where it comes to 25,000. Respond everybody, clear. And that is the end of fresh issue. And now coming to CRR. CRR can be utilized only for the issue of fully paid up bonus shares. CRR can be utilized only for the purpose of issue of fully paid up bonus shares. Respond everybody, clear. Now concentrate carefully. You are having equity share capital 50 lakhs, but you have decided to buy back 10 lakhs. Is it clear? You have decided to buy back how much, Amma? 10 lakhs. Before buyback, how much capital is there? After buyback, if you have bought back 10 lakhs, then how much capital you will be left with? Am I correct or wrong? And hence, before buying back itself, you need to create CRR. Or simply, you need to go for fresh issue. And fresh issue, have issued preference share capital to the extent of 10 lakh. Is my point clear? Sir, before buyback, how much is there? 50 lakhs. After buyback, 10 lakhs is decreased, but you are issuing preference share capital 10 lakhs, and again the total capital comes to Chapali, and hence it gets matched. Up to this clear, everybody? Now second option. My dear children, company is having equity share capital of 50 lakhs, and company would like to buy back 10 lakhs equity share capital. So after buyback, how much it will be available, Amma? And hence to match the 50 lakhs, company had created CRR to the extent of 10 lakhs. CRR to the extent of 10 lakhs. How much share capital is there now? So please participate. Before buyback, how much share capital? After buyback, how much share capital is there? Capital is not matching, kada. But then how can you buy back? By creating? But even after creating CRR, capital is not matched, kada. Question clear, huh? Sir, if you are going for fresh issue, before buyback 50 lakhs. After buyback also 50 lakhs. Reason being, from 50 lakhs, 10 lakhs bought back, 10 lakhs issued. And the total is again 50 lakhs antunna. Respond. Whereas coming to CRR, before buyback, equity share capital is 50 lakhs. After buyback, equity share capital is 40 lakhs. Of course, you are having CRR of 10 lakhs. But my question is all about, before buyback, what is the share capital? After buyback, what is the share capital? Then how can you go for buyback? Yes, if you have remembered, CRR can be utilized only for one purpose. For the purpose of issuing bonus. Ante, even if you are not issuing bonus today, it's okay. In future, you can utilize CRR only for the purpose of issuing bonus. And you cannot use CRR for any other purpose. CRR can be utilized only for the purpose of issuing bonus. And at any cost, in future, it will be converted into share capital. And hence, the total will become 50 lakhs once again. Respond everybody, clear? And one more important thing. If you are redeeming some preference shares at securities premium, if you are redeeming preference shares at securities premium, if you have remembered in your foundation, you need to check out whether is it section 133 company or not section 133 company. What is section 133 company? Tell sir? Don't know? You know, I taught that in marathon class. In which chapter at least? Introduction to Accounting Standards. After the standards are issued by ICAI, they will be reviewed by NFRA, and then the standards will be released by central government through MCA through section 133 of Companies Act 2013. Section 133 companies ante companies which have to follow section 133. In section 133, what are there ante accounting standards or Ind AS which are released by central government. Is my point clear? So now think with common sense. Section 133 companies are nothing but companies which have to follow AS or Ind AS which are released by central government. Now think with common sense and answer me. Does every company needs to follow accounting standards or not? Generally, yes, every company needs to follow either AS or Ind AS, whatever is applicable. And indirectly, every company is Section 133 company. And hence, while doing the answer, it is told for you to assume that every company is Section 133 company. Logic understood? So, conclusion, you need to assume every company is Section 133 company, and you should not utilize securities premium for the purpose of writing off premium on redemption of preference shares. You should not write off securities premium for premium on redemption of preference shares, provided if you are Section 133 company. Is my point clear, everybody? But in the institute material, in all the foundation, this will be followed. But in buyback of securities, in the institute material, in one problem, along with buyback of securities, redemption of preference shares is also there. But they will be using securities premium for the purpose of writing off of premium on redemption of preference shares. Sir, Ardhamainda? In the institute material, along with buyback of securities, you are also having redemption of preference shares in that question. And in that question, they are using securities premium for the purpose of writing off of premium on redemption of preference shares. But it is recommended not to use, because every company is to be assumed as Section 133 company. Up to this clear, everybody? The last and final part of buyback of securities, that is journal entries. Point number 1, only a fully paid up equity shares can be bought back. Only fully paid up equity shares can be bought back. So if any partly called up and partly paid up are there, make the final call. What is the journal entry? Equity share final call account debtor to equity share capital account. Get the amount. Cash or bank account debtor to equity share final call account. Clear, everybody? And now match the capital requirement. Fresh issue or CRR. For CRR, what is the entry? Free reserves account debtor to, and coming to fresh issue, what is the entry? Cash or bank account debtor to percentage preference share capital account, or you can also equity shares with differential voting rights. But in all our problems, no, this concept is there, only preference share capital is there. And also you can issue the same for securities premium. You can issue for securities premium. Hey, while writing the entry, you have to write the premium entry. But premium is not considered for counting fresh issue. Is my point clear? While writing the entry, you have to write for securities premium. But premium is not considered in counting fresh issue. In the previous example, totally you want 2.5 lakh. And the company would like to issue at a 10 plus 2. Do you need to do something like 2.5 lakh by 12? 2.5 lakh by 10? 10, because securities premium is not a fresh issue. And you have to issue how many shares, amma? So what is the journal entry ante? Cash or bank account debtor 25,000 into 12 to preference share capital, 25,000 into 10 to securities premium, 25,000 into 2. Respond, everybody, clear? And while writing the entry, you will write the entry for securities premium, but it will not be counted for fresh issue. Respond, everybody, clear? And moving on to the next thing, CRR can be utilized only for the purpose of fully paid up bonus shares. So what is a journal entry, amma? CRR account debtor to bonus to equity shareholders account, bonus to equity shareholders account debtor to equity share capital account. Only when given in the question you have to write this, otherwise no need to write. If at all in the question it was given that company is utilizing CRR for the purpose of bonus, if it had told that, you have to write the entry, otherwise no need to write the entries. Respond, everybody, clear? And the final term, entries for buyback now. Be careful, my dear children. Equity share capital account debtor to equity share buyback account. And obviously it will be debited with face value. And equity share buyback has to be credited with buyback price. And the difference has to be debited to premium on buyback account. Is it clear, everybody? Next one. This is called as due entry. And the next, payment entry, equity share buyback account debtor to cash or bank account. Clear everybody? And the last and final, close pop, close premium and buyback. You can utilize any free reserve, or also you can utilize even securities premium account debtor to premium on buyback account, which is like 50. But you cannot utilize securities premium for redemption of premium on redemption of preference shares. Is my point clear? My dear children, can you use securities premium for writing off of premium on buyback of securities? But can you use securities premium for the purpose of premium on redemption of preference shares? No, provided if it is section 133 company. If it is not section 133 company, you can utilize securities premium. Respond everybody, clear? My dear children, this is the end of buyback. So now two special points relating to problems. Point number 1. Sir, రిసోర్స్ టెస్ట్లో 25% ఆఫ్ పేడ్ అప్ షేర్ క్యాపిటల్ ప్లస్ ఫ్రీ రిజర్వ్స్ అని ఉంటుంది. ఫ్రీ రిజర్వ్స్ అంటే ఆబ్వియస్లీ ఎవ్రీ ఫ్రీ రిజర్వ్ విల్ బి ఇంక్లూడెడ్ అండ్ ఈవెన్ సెక్యూరిటీస్ ప్రీమియం. Free reserves or any reserves which can be freely available for distribution of dividend like general reserve, P&L account, reserve fund, dividend equalization fund, etc. Along with that, securities premium is also included. Next, paid up share capital ante, is it paid up equity share capital and preference share capital or only paid up equity share capital? Point number 1, it includes both equity and preference share capital, but in all our problems we are having only equity share capital. Sir, em cheppano ardhamainda? In all our problems to compute tests for buyback, in all such problems relating to tests for buyback, you are having only equity share capital. Sir, ardhamainda? Yes, in one or two questions preference share capital is also there. But in that question, no need to compute test for buyback. Sir, problem ardhamainda? So in all the questions where you have to compute test for buyback, preference share capital is not there in all that questions. Respond everybody, clear? So paid up share capital includes both things, remember. Next special point in CRD number 1, which is one of the examinations question. CRD number 1, which is one of the examination questions. To all my dear children who are watching on YouTube, one of the examination questions, one of the past examination questions which is given by CA Institute, in the balance sheet it was given like this: equity share capital 50 lakh, preference share capital 10 lakhs. And in the adjustments it has given that company would like to purchase 20% of share capital. Company would like to purchase 20% of share capital as buyback. Inka clear ga cheppalante, he had given company would like to buy back 20% of paid up share capital. It was given like that. So now the question of fact is all about in the adjustments it was given that company would like to purchase 20% of paid up capital. Does it mean 20% of 50 plus 10 lakhs? Does it mean 20% of only equity share capital 50 lakhs? Is the point clear? Now the answer is this one as per the institute. Sir, what is this controversy? While solving the tests for buyback, paid up capital is equal to paid up equity share capital and paid up preference share capital. But if at all it is given in a problem in an adjustment that company would like to buy back 20% of paid up capital, implies 20% of equity share capital only. Respond everybody, is point number 1 clear to each and everybody? So this is done, one adjustment. And one more important adjustment, meeku gurtunatlaithe something called ESOPs. Yes, there is a point in one of the adjustments, employee stock options outstanding. Sir, listen very carefully. You are not having entire ESOPs chapter. You will be writing your examination in January. and you are having your CMA examinations in December. In CMA, this chapter is there. In CMA, ESOPs chapter is there. So you will be getting clear-cut understanding with respect to ESOPs at that moment. But now let me tell you one journal entry. Only one journal entry I am going to tell. If you have subscribed, sir, employee stock options outstanding. It's an option given to the employees to subscribe for the shares. So they can pay some cash. They can pay some cash. Say for example, 120 share is offered only at 50. So shareholders are giving only 50. But you have to issue an equity share which is having a market value of 120. But the face value is only 10. Hey, up to this clear, huh? What is the market value? What is the issue price? But what is the market value of 120? What is the face value? So cash or bank account debt or equity share capital. You are getting only 50, but face value is 10. Shall I continue with the entry? To securities premium. 120 minus 10, 110. 120 share is offered at 50 ante 70 rupees is like bonus. 120 share is offered at 50 amma and 70 is like bonus. Am I correct or wrong? For bonus you have to utilize reserves, yes or no? Here also you have to use reserve, and that reserve is a specific reserves employee stock option outstanding account. This is a reserve. Employee stock option outstanding account is a reserve. You have to utilize employee stock options outstanding for the purpose of issuing equity shares to the employees at a concessional price. Is it clear, everybody? Now quickly answer me. What is the market value? What is the issue price? Bonus, how much is given? Use this bonus with a specific reserves called employee stock options outstanding account. And the next one, what is the face value? What is the total market value? Difference between these two things is nothing but securities premium. Respond, everybody, clear. My dear children, this is the end of buyback. I did not go into the legality aspects of buyback. Legality aspects of buyback. I mean to tell, the buyback has to be completed within 1 year from the date of resolution. You cannot issue another similar kind of securities for the next 6 months. Between previous buyback and next buyback, there should be a gap of 1 year. And one more thing, you cannot issue the same kind of equity shares except by way of bonus. Predetermined obligations you can issue. Like that, there are multiple legal aspects, but I did not cover any of the legal aspects. And also there is one more provision. Buyback you can also move by passing board resolution, provided the maximum percentage is 10% of paid up share capital and free reserves. Gurtunda? Resource test aithe 25%, but you can also move buyback not with special resolution, just by passing board resolution, but in such a case maximum will become 10% of paid up share capital plus free reserves. Cheppanantune I told many law provisions, but I did not concentrate especially. Particularly you will be learning all these provisions in your law itself, but for accounting this is more than enough. Respond, everybody, clear. And my dear children, this is the end of buyback. Okay, fine, my dear children, let us continue with the next standard, that is accounting standard number 7. Now coming to accounting standard number 7. Sir, the accounting standard number 7, what is A7? Construction contracts. For every contract there will be 2 parties, and the 2 parties are contractor and contractee. T. A7 is applicable only for contractor but not for contractee. Remember, A7 is applicable only for contractor but not for contractee. For contractee, specific accounting standard is applicable. And now moving on to some important areas of A7. Definition of construction contract is quite normal. Yeah, frankly speaking, there are 2 types of construction contracts. Number 1 is fixed price contracts. Number 2 is cost plus contract. And what is that called? When can you tell that the outcome of the contract is reliably measured? Outcome of the contract is reliably measured. This is very, very important for subject wise in AS 7. There are two types of contract. Number one is fixed price contract. Number two is cost plus contract. Sir, contract revenue should be certainly measured. Percentage of completion should be certainly measured. Contract cost should be certainly measured. And there should be some generation of future economic benefits. If all these four conditions are satisfied, you can tell that outcome of the contract is reliably measured. And coming to cost plus contract, since it is concentrating only on cost, contract cost should be reliably measured, future economic benefits should be reliably measured. If these two conditions are satisfied, we can comfortably tell that cost plus contract is also reliably measured. Is it clear, everybody? Now, be careful how a contract account appears, sir. Sir, very, very important. Whatever we are discussing, something called contract account, in your all examinations and institute material questions, they are asking you to prepare P&L account, P&L account, P&L account. Here P&L account doesn't mean it's general P&L account. P&L account relating to a particular contract is nothing but P&L account in this context. Is it clear? P&L account relating to a particular contract is nothing but P&L account. P&L account is not general P&L account. And how a contract account or P&L account format will be, my dear children, by contract revenue to contract costs. And either you will be getting net profit or you will be getting net loss. This is general tendency. Now, please be very careful. Total contract revenue multiplied by percentage of completion if it is a fixed price contract. If it is cost plus contract, contract cost plus profit is nothing but contract revenue. And contract cost, in some of the questions directly he will be giving contract costs. In some of the questions he is giving something like work certified plus work uncertified. Work certified plus work uncertified is nothing but contract cost. Remember, in some questions directly he is giving 10 lakhs is the contract cost. In some questions he is giving work certified, work uncertified. Those two things altogether comes to contract cost. In some questions he is giving like material cost, labor cost, depreciation, like that he is giving separate items also. So please be careful depending on the problems that you are solving. And very, very important, in one of the problems even you may need to create provision for loss. When to create provision for loss, let us discuss later. Respond everybody, is the whole concept till now understood? So now coming to the first one, contract revenue. Let us start discussing contract revenue. Coming to contract revenue, you have to record the contract revenue basing on the types of contract. Number one, fixed price contract. Number two, cost plus contract. If it is fixed price contract, then you obviously need percentage of completion. And how much is the percentage of completion? For computation of percentage of completion, you are having three methods. Number one, survey method, physical proportion method, cost to cost method, or proportionate cost method. In all our problems, cost to cost method is quite popular. Survey method, one outsider will come, he will do the survey and he will tell some percentage of completion. Whereas physical proportion method, contractor himself will be verifying everything and he is telling that this is the percentage of completion. And now coming to cost method, which is very important for problematics, total cost incurred till now divided by total estimated cost multiplied by 100. So now very, very important. Sometimes in the question he is giving something like 60% of the work is completed. But in the question we are having with cost incurred plus total estimated cost. If you have computed like this, you are getting 58% completion. So is my point clear? In the question you already told 60% work is completed. And while you compute with the given data in the question cost to cost method, you are getting 58%. Now while solving the answer, do you need to consider 60% or 58%? You need to consider as per the method. If in the question he is telling to prepare under cost to cost method or proportionate cost method, then 58%. And if he is telling some survey method, then it is 60%. If no method is prescribed, then which percent you need to consider? 60% you need to consider, not 58. You can't change the question. Since in the question already given that 60% of the work is completed, you need to consider only 60% directly. Respond everybody, clear? And yeah, that is all about percentage of completion. And now coming to cost plus method, it is very, very simple. Cost incurred plus profit, whatever you agreed, it will be added for contract revenue to complete the same. Respond everybody, clear? So now very, very, very important, you need to follow the above principles only when the outcome of the contract is reliably measured. Did you remember outcome of the contract is reliably measured? I mean to tell, if it is fixed price contract, contract cost should be reliably measured, contract revenue should be reliably measured, percentage of completion should be reliably measured, and future economic benefits are probable. And if it is a cost plus contract, contract cost should be reliably measured, future economic benefit should be reliably measured. So you have to follow all such kind of things only when these conditions are satisfied. If these conditions are not satisfied, you should not recognize the contract revenue. Recognize only to the extent of cost incurred. Is it clear? You should recognize or should not recognize it? Should not recognize contract revenue basing on the above rules, and don't follow percentage of completion, don't follow cost plus profit. You simply recognize only to the extent of cost incurred, that too if you are having certainty to receive the same from the contractee. Is it clear? Pakka. To tell you, there will be a one question. Meeku gurtunnatlaithe, it is a cost plus contract, and the company had incurred 99,000 cost, 99,000, but contract revenue is something like 99,000, say for example 10%, which should become 1,09,000. No? 1,08,000. If everything is correct, it should be like that. If everything is correct, it should be like that. But what I wanted ante, company had already incurred a cost of 99,000. ఒక్క నిమిషం, మీకు ఎగ్జాక్ట్ లైన్స్ లో క్వశ్చన్ చెప్పాలి అంటే కాంట్రాక్ట్ కాస్ట్ ఇంకర్డ్ ఇన్ టోటల్ ఈస్ 90,000. ఈజ్ మై పాయింట్ క్లియర్? అండ్ కాంట్రాక్ట్ రెవెన్యూ ఈజ్ సంథింగ్ లైక్ కాంట్రాక్ట్ కాస్ట్ ప్లస్ 10%. అండ్ further non-reimbursable cost incurred will be 5,000. And additional cost around 10,000 is incurred, on which the contract revenue is uncertain. Gurtochinda? This kind of problem you will be having. Sir, at least now is it okay even if you did not remember? Is the data clear? Contract cost incurred how much? Where you are going to get revenue to the extent of 10% on that. But you have also incurred some additional contract cost to the extent of 10,000, where you are not having certainty of any receipt. And further non-reimbursable cost, you are going to incur 5,000. In this context, you have to prepare the contract account. To contract cost, how much you have incurred in total? How much you have incurred in total? 1 lakh. Am I correct or wrong? This is further non-reimbursable cost. Further implies future ani artham. Sir, is the data clear? What is contract cost incurred? Totally 1 lakh. Out of which how much is reimbursable? 5,000. 90,000 amma. Sir, let me reframe the question. Contract cost incurred is equal to rupees 1 lakh, of which 90,000 is reimbursable. Further non-reimbursable cost to be incurred in future is equals to 5,000. Contract revenue is equal to contract cost plus 10%. At least is this framing okay for everybody? Now answer me, what are the total contract cost incurred? 1 lakh by contract revenue. Sir, how much will be reimbursable amma? So 90,000 plus 10%. Only this is reimbursable. And how much is being reimbursed amma? 99,000 you are getting. Ante. So frankly speaking, by net loss, 1,000 is your net loss. Is it clear? Further non-reimbursable cost, and in future you are going to incur a cost of 5,000, but you are not going to get anything in future. And is it your loss or not? And relating to present of future, so you need to create provision for loss to the extent of 5,000, and hence your total loss will become 6,000. Respond everybody, clear? Ante if at all outcome of the contract is not reliably certain, your answer will be like this. If at all outcome of the contract is reliably certain, then what happens, sir? To contract cost 1 lakh, by contract revenue 1 lakh plus 10%, and finally by net profit 10,000. Sir, ikkada to net profit how much? 10,000. That's it. Hey, respond, did you get the difference? So be careful to recognize contract revenue. First of all, you need to check out whether outcome is reliably certain or not. Outcome is not reliably certain, then you need to recognize only up to contract cost. More than that, you should not recognize. Respond everybody, clear? In all our institute material problems, all the outcome of the contracts are reliably measured, except only in this problem. And hence I have told you specifically about this problem. Is it clear everybody? If you are holding material, this is CRD number 4 anta. If you're holding material, this is CRD number 4, which is very different question actually. And moving on to the next thing, be careful my dear children. Now coming to contract revenue, elements of contract revenue. Sir, point number 1, initially agreed amount. Point number 2, escalation clause. Or you can also have de-escalation clause, but which is not popular in problems at all. So simply escalation clause. And the next one, what is it called? Variations. And the next one is claims. And the next one is incentives. And the next one is penalties. All these are nothing but components of contract revenue or elements of contract revenue. Now, initially agreed amount as per the contract. What do you mean by escalation clause? Escalation clause you will be having only for fixed price contract. You will not be having for cost plus contract, because for cost plus contract generally it is a reimbursable in nature. How much ever you incur cost, on that you will be getting some profit percentage. So for cost plus contract there is no worries about cost, but for escalation clause you have to be very careful. For fixed price contract, escalation clause will be there because contract cost is fixed. Now, what do you mean by escalation clause, sir? If at all increase in cost is there, then increase in revenue will be there, which is nothing but escalation clause. And now coming to the variation. Variation is nothing but change. The change can be either proposed by contractor or change can be either proposed by contractee, and hence the other party has to accept. The change can either increase the revenue or the change can either decrease the revenue. But escalation clause will always increase the revenue. Is it clear? Whereas coming to variations, change can be proposed either by contractor or contractee, and the other party has to accept for that. It can be either for increase in change or it can be either for decrease in the change. And now the next one, claims. Claims are something which is proposed by contractor and contractee has to agree for the same. And if at all the negotiations reach the conclusion stage, then you can also add claim to your contract revenue. Is it clear? Best example, yesterday we have seen a problem, if you have remembered, a rocky surface. By the time when you are entering into the contract, there is no rocky, you don't know that there is a rocky surface. By the time when you are entering into the contract, you don't know that there is a rocky surface, and hence you have thought that the cost will be incurred is only 10 lakhs, and you have agreed like that for the contract. But once you have entered into the site, you found the rocky surface where you found that you are going to incur another 10 lakhs. So now contractor needs to ask this from the contractee. And contractee, if he is pleading something like, no sir, I don't pay because already we have agreed as per the agreement, it is your problem if you did not observe rocky surface, then contractor cannot do anything. But if at all contractee is also agreeing for the same, and if he is agreeing to reimburse the cost, then to the extent of claim your contract revenue will increase. Incentive. Whenever you are exceeding the standard performances or meeting the standard performances, you'll get some bonus kind of thing, which is nothing but incentives. And the next one, penalties. If you have done any fault, then automatically your revenue will be decreased, which is nothing but charged your contract revenue with something called penalty. Respond everybody, clear? And all these things are the elements of contract revenue. And now coming to the next one, contract cost. It's very, very simple. Contract cost will be of generally three types: directly attributable cost okati, allocable cost okati, specifically agreed cost okati. Directly attributable cost and costs which are directly attributable for a particular contract. It should be booked only in that contract account. Allocable cost ante costs which are incurred for more than one contract, like designing charges, asset commonly used for more than two contracts. So in such a case, you have to allocate the entire cost to all the contracts in some systematic and rational basis. Now coming to the next one, specifically agreed cost. Frankly speaking, these are not at all the part of cost. Frankly speaking, these are not at all a part of contract cost. But if as per the agreement they have specifically agreed, then they will become part of contract cost. Research and development expenses okati, general administration cost okati. Is it clear, everybody? What are the two things, my dear children? General administration cost and research and development cost. If at all, point number one, they will never become part of contract cost. If they were specifically agreed as per the agreement, then they will automatically become a part of contract cost. Respond everybody, clear? And this is all about contract costs. There is one more specific point to tell about contract cost. That is, I mean to tell, what's that one? Cost for securing a contract. Please be careful. Cost incurred for securing a contract. Listen very carefully. Sir, government will be calling some tenders and bids. Am I correct or wrong? You might have applied for the tender or you might have applied for the bid by incurring a total cost of rupees 1 lakh. Now how to treat this 1 lakh rupees cost? Sir, question clear? Huh? You have incurred some cost in order to secure a contract. Still you did not get that contract, but you have already incurred the cost. So how to treat that cost? It depends on these situations. Number one, whether do you have certainty that you are going to get the contract, or you are not having certainty that you are not going to get the contract. Yes sir, we are going to get the contract. Whatever cost you have incurred, postpone and treat as contract cost after securing the contract. Sir, we are not going to get the contract at all, sir. Very good. In such a case, simply immediately charge to P&L account. If you estimate you are going to get the contract in future, then postpone this cost and treat it as contract cost in future. Otherwise, simply charge it to P&L account. Initially, you thought of like you are not going to get the contract and hence already charge it to P&L account. But further, you are going to think that you are going to estimate that you are going to get the contract. Is it clear? Now, is there any further treatment required? No, because once charged can never be reversed. Once if it is already charged to P&L account, you cannot reverse the accounting treatment. Whereas coming to here, initially you thought of like you are going to get the contract and you are postponing the contract cost. But further you thought like you are not going to get the contract. Very simple. Simply charge to P&L account. Respond everybody, clear? Are you a winner? Cost for securing a contract. If you are estimating that you will get the contract in future, postpone a charge. Postpone. Otherwise you need to charge. If you are thinking initially you are not going to get and already charged, but further thinking that you are going to get the contract, no need to do anything. Once charged, cannot be reversed. Initially thought you will get the contract and postponing the recognition, but further you thought of like you are not going to get the contract. Simply charge to P&L account. Respond everybody, clear? Pakka. Okay. Now, one more important thing with respect to the contract revenue. Point number 1. If at all it is initially certain, postpone, don't recognize the contract revenue. Sir, initially already we have recognized the contract revenue. After that, subsequently it had become uncertain. Now what to do? Don't reverse. You have to create a provision. Is it clear, everybody? So contract revenue initially uncertain. Recognize or don't recognize? Participate. If contract revenue initially uncertain, recognize or don't recognize? You have to postpone the revenue recognition till certainty is established. Clear, everybody? Initially recorded, but subsequently it had become uncertain. Reverse or don't reverse? Don't reverse, but you need to create a provision. Respond, everybody. Clear? Throw this concept aside and moving on to the next concept. Whenever contract cost is more than contract revenue, then automatically you need to create a provision for loss irrespective of whether or not contract is commenced. Even if you are not commencing a contract, if you are estimating a loss, you need to book full loss. Irrespective of percentage of completion, you should not apportion the loss basing on percentage of completion. You have to book full loss irrespective of percentage of completion, and irrespective whether you are going to get profits from the other separable contracts. Sir, whether or not contract is commenced, if there is an estimated loss, book the total loss. Irrespective of percentage of completion, you have to book the total loss. And the last and final one, even though you are having profits from other contracts, we just don't care, don't bother. You need to create provision for loss to the fullest extent for this contract. Respond, everybody. Clear? In this connection, how to solve a problem? First of all, find the percentage of completion and then start preparing some contract account. You will be putting something like by contract revenue. By contract revenue, where you are going to get total contract revenue multiplied by percentage of completion, and you will be having something called to contract cost. If it is profit, absolutely no problem, but if there is loss, immediately you need to check for total estimated loss. Total estimated loss is equal to total estimated profit minus total estimated contract revenue minus total estimated contract cost. Then you are going to get a negative figure, which is nothing but total estimated loss. And you need to book the difference amount as provision for loss. Is the point clear? Pakka? So let us apply the same in with one problem. Check out this one. The total contract revenue is 85 lakhs. Already incurred 64 lakh 99,000. And additional cost we are going to incur is 32 lakh 1,000. So what is the percentage of completion? 64 lakh 99,000 divided by 64 lakh 99,000 plus 32 lakh 1,000 multiplied by 100. How much? Exactly. 67% is completed. Is it clear? Now what is your total contract revenue? 85 lakhs. Check out how the contract account is prepared in this context. By contract revenue. 85 lakhs multiplied by 67%. How much? And to contract cost. 64 lakhs 99,000. Profit or loss? Loss. How much is the loss? Frankly speaking, 8 lakh 4,000 is the loss. But in this context, I ask you to compute one more thing. Total estimated loss is equal to total estimated contract revenue minus total estimated contract cost. What is the total estimated contract revenue? 85 lakhs. What is total estimated contract cost? 97 lakhs. And automatically how much loss you are going to get? 12 lakhs is the loss you are going to get, but already 8 lakh 4,000 is created kadamma. So balance how much? For that 3,96,000, you need to create something called provision for loss, and hence your total loss will become 12 lakhs. Respond everybody, clear? This is how you need to prepare. Shall I proceed further? Now, in the first problem, he is asking you to prepare even contractee account also. In the first problem, he is asking you to prepare contractee account also. So generally students will be confusing to prepare contractee account, but let me tell you the journal entry so that it will become super easy to prepare. Number one, if you sell, what is the journal entry? Sell goods on credit basis, what is the entry? Participate, sell goods on credit basis, what is the entry? Am I correct or wrong? So now here you are undertaking a contract for your contractee. So your contractee is your debtor. So the journal entry will become contractee account debtor to contract revenue account, because the sale is nothing but contract revenue. Is it clear? And next one, contract revenue will be closed and transferred to contract account. Is it clear? And hence in contract account you will be getting something like by contract revenue. And in contractee account you will get, this is nothing but debtor hai kada. You will be having opening balance, you will be having sales, you will be having collections, and finally you will be having closing balance. Modification, opening closing is same, two sales will become two contract revenue, by collection is nothing but by cash or bank. Because when you receive from contractee, what is the journal entry, Amma? Cash or bank account debtor to contractee account, and this is what your contractee account will be. If you know this journal entry, automatically you can do anything, and this is what the contractee account will be. Contractee account, opening balance, contract revenue, collections, closing balance. Respond everybody, clear? And now one more special important point with respect to contract cost, I have forgotten to tell you. There will be some unallocable cost. Unallocable cost under which is not relating to any contract. In such a case, this has to be charged to P&L account. Likewise, administration expenses which are not specifically agreed, research and development expenses which are not specifically agreed, abnormal cost if any are there, and depreciation on idle equipment. Idle equipment, and you might have many equipment, much equipment, you may not be using some of the equipment for any contract. In such a case, it will be charged to P&L account. Is it clear everybody? Unallocable costs have to be charged to P&L account. Up to this clear? Sir, now my next question, does a contractor is having a P&L account? Contractor is having contract account. Am I correct or wrong? Does a contractor is having general P&L account? Of course, yes, he will be having general P&L account also. And in that general P&L account, he might have all the profits which are transferred from different contracts. Sir, for each and every contract, you need to maintain separate accounts or same account? Sir, answer, for different contracts, different accounts or same account? Different accounts. So from different contracts, you might get profits or losses, which will be ultimately transferred to general P&L account. Clear everybody? And even unallocable costs will also be transferred to general P&L account, and hence it's quite common to a contractor to have general P&L account. Respond everybody, clear? And my dear children, I'm not covering the concepts of combining and segmenting. Due to time, due to lack of time, and moreover since the concepts are very easy, I am not covering the concepts of combining and segmenting. If you would like me to tell in one line, different contracts are there. Does they be treated separately or as if it is a single contract? This is called as combining. Is it clear everybody? You have already entered into 3 contracts. Does these to be treated as 3 different contracts or single contract is called as combining. Now you have entered into a single contract for 3 constructions. Now does this to be treated as a single contract 3 different accounts? This is called as segmenting. If combining conditions are satisfied, combine. If segmenting conditions are satisfied, segment. Is it clear everybody? Simple. Overall negotiation, overall profit basis, then it is called as combining. Individual negotiation, contract cost and contract revenue are individually identified, then segmenting. Is the point clear? I did not dealt elaborately, but on his conclusion mode I told you. Sir, answer me quickly. Separate contracts are there. What is the concept you need to check out? Hey, listen carefully. Already contracts are separated. Now which concept you need to check? Whether combining is applicable or not. You have entered into a single contract for pre-construction. Now you need to check out whether segmenting is possible or not. Combining, overall profit margin, overall negotiation. Segmenting, separate profits margin, separate negotiations, contract cost and contract revenue are identified separately. Respond everybody, clear. Two more conditions will be there. Work will be done concurrently or sequentially. That thing will be there. And part of a contract can be accepted, part of a contract can be rejected. Take care. Part of a contract can be accepted, part of a contract can be rejected. This is for combining or segmenting. Segmenting. Condition is very simple. Work should be performed either simultaneously or concurrently, one after the another. This is relating to combine. Is my point clear? Overall profit margin, overall negotiation, and work should be performed either sequentially or concurrently. These are the conditions relating to combining. Separately identified contract cost and contract revenue, separate negotiations, work can be accepted either part or rejected can be either part. That is called as segmenting. Respond everybody, clear. And the last and final point relating to AS7, disclosures. And coming to disclosures, if it is a completed contract, simply you are supposed to tell what is your total contract revenue, what is method for percentage of completion, and what is method for recognition of contract revenue. What do you mean by method for recognition of contract revenue? I deliberately did not tell one point where the time had come to tell. As per accounting standard number 7, there are two types to prepare the contract accounts. Number 1, completed contract method. Number 2, proportionate completion method. Completed contract, proportionate completion method. But accounting standard number 7 strictly prohibits you to prepare completed contract method. So completed contract method concept are not there. Now everything is like proportionate completion method only. But in one situation, completed contract method is possible. Started in the same financial year, completed in the same financial year. If it started and completed in the same financial year, contract is completed, then you can follow completed contract method. Respond everybody, clear. Anyways, my dear children, you are supposed to tell what is the total contract revenue and what is a method that you are using to prepare the books of accounts. And now very, very important, Amma, for a contracts which are work in progress, you are having even a problem on this, and also very famous problem. For contracts which are work in progress, you are supposed to tell what is the contract revenue, what is the contract cost, what is the percentage of completion, what is the contract profit or contract loss, and very important, advances or retentions, progress billings, amount due to or due from customers. What do you mean by advance or retention? More than the billing were given, then that is called as advance. Less than the billings were given, that is called as retention. Now progress billings include amount that is received and amount that is in pipeline. Pipeline is nothing but billing completed, but amount yet to be received. But if billing is completed, we will call it as progress billing received. Hey, concept clear? For contracts which are in work in progress, you are supposed to disclose what is the contract cost, what is the contract revenue, what is the percentage of completion, what is contract profit or contract loss. Up to this clear, everybody? Now in this question, you will be elaborately given with the terms called work certified plus work uncertified. Work certified plus work uncertified is nothing but dash. Contract cost. Now listen very, very carefully, everybody. Sir, you have recognized contract revenue to the extent of 10 lakhs. But one outsider, surveyor had come and he had given a bill only for 8 lakhs. He had given only bill for 8 lakhs, out of which 6 lakhs is received, 2 lakhs is not yet received. Is my point clear? Sir, progress billings include billings completed and amount received, billings completed and amount not received. Is it clear? As per you, as per contractor, how much contract revenue recognized? 10 lakhs. But as per the billings, how much is released, Amma? And even though the work is completed to the extent of 10 lakhs, billings were released only to the extent of 8 lakhs. Out of which how much is received? How much is not yet received? And this 2 lakhs is called as retention. Is it clear, everybody? Sir, respond clear, huh? Now, be careful. Now you have received 15 lakhs. You have received 15 lakhs. Billing is done for how much amount? How much you have received? Ante excess how much received? This 7 lakhs is nothing but advances. Respond, everybody clear. The last and final one, gross amount due to or due from customers. What is a gross amount due to or due from customers? Very, very simple. Check out. Sir, what a customer needs to give you? Contract revenue. Am I correct or wrong? Contract revenue he has to give. Already he had paid some amount. Deduct that. Is it clear? Already he had paid some amount. Just deduct that. This is the amount, gross amount due to or due from the customer. Shall I decode it slowly? Contract revenue is nothing but contract cost plus profit or minus losses. Is it clear? Minus paid is nothing but progress billings. Billings, and it includes both paid and not paid, but billings completed. Is it clear? So gross amount due to or due from customer is nothing but contract cost plus profit minus losses minus progress billings received minus progress billings which are in pipeline. Respond, everybody clear? And let me also show you that problem which is very different. And if you observe, total contract price is 1000, work certified is 500, work uncertified is 105. So what is the total contract cost? 605. Estimated further cost to complete is 495. So what is the total estimated cost to complete? 1100. What is the percentage of completion, Amma? 605 divided by 1100 into 100. 55% is exactly completed. Clear, everybody? Let me prepare a contract account with this. By contract revenue, 1000 multiplied by 55%, which becomes 550. But to contract cost, work uncertified plus work uncertified, which is 605. So you are having a loss of 55. But I told you, whenever this kind of loss is there, you need to check out for total estimated loss. My total contract revenue is 1000 and my total estimated cost is 1100. So my total estimated loss is 100. But how much already you have recognized? So how much provision you need to recognize now? So automatically my total loss will become 100. Respond, everybody clear? So, and moving on to the further question. Progress payment received 400, to be received 140. And billings totally completed for 540. Ante kada? Progress payment received, billing done and received 400, billings done and to be received is 140. Shall I start now? Now quickly answer me the disclosures. What is the contract revenue? Contract revenue recognized 550. Contract cost incurred. Percentage of completion. What is the total loss or profit recognized? 100. Am I correct or wrong? Now moving on to further things. Number 1, advance or retention. Total billings is completed for 540, out of which you have received, out of which you did not receive. So advance or retention. How much is the retention? Progress billings completed for how much amount? Is it clear, everybody? So check out all the disclosures I told you. Contract revenue, contract cost, percentage of completion, total profit or loss recognized, progress billings received 540, retention 140, no advance. Last and final, gross amount due to or due from customer, cost incurred 605 plus profit 0 minus loss recognized 100 minus billings completed 540. So 605 minus 100 minus 40. Negative 35. This is gross amount due to customer. Respond everybody, clear? My dear children, this is the end of accounting standard number 7. One last and final problematic point that you need to remember. In one of the problems, he will be giving something like closing stock or stock at the site rupees 100 not included like this he will be giving. Gurtochinda? Let me tell you, year 2 contract cost 6165 antadu. Now note, he is telling something like 100 closing stock is included in contract cost, which is actually used in year 3 antadu. Hey, did you remember? So 100 is dash closing stock. 100 is closing stock for year 2 and it is used in year 3. So you need to deduct this 100 from 6165 and you need to add that 100 to year 3's cost. Respond everybody, clear? And sometimes in the question he will be giving something like some portion of stock is included in the contract cost. But if it is included in the contract cost, since closing stock is not cost, you need to deduct that. It is consumed in year 3. So you need to add it up in year 3. Respond everybody, clear? And my dear children, this is the ultimate ending for accounting standard number 7. Coming to accounting standard number 9. What is accounting standard number 9, Amma? Revenue recognition. And frankly speaking, I'm not concentrating on the scope at all. In scope, there is applicability, non-applicability and exclusion also. Sir, accounting standard number 9 is applicable for sale of goods, rendering of services and use of enterprise resources by others yielding interest, dividend and royalty. And frankly to tell you, this standard is not applicable for contract revenue where AS7 will take care. This standard is not applicable for government grants. Likewise DGG, GG is there, right? AS12 will take care. Not applicable to leases where accounting standard number 19 will take care. And revenue to insurance company and IRDA is going to applicable for that. And now one very important, remember always revenue is nothing but gross inflow. Revenue is always gross inflow, but in an agency relationship it is not gross inflow, it is limited only to commission, where commission is nothing but net inflow. Respond everybody, clear? And even in accounting standard number 9, not only non-applicability, there are some exclusions also. You just go with the exclusions. I'm not going to deal with exclusions. And now moving on to sale of goods. My dear children, so there will be some rules, something like when to recognize revenue from the sale of goods. Only when the ownership is transferred, only when significant and related risk and rewards are transferred, and only then there is no uncertainty in collection and when ultimate collection is established. These 4 conditions are very, very important. Number 1, ownership is transferred, which implies that significant and related risk and rewards are transferred. These 2 are interlinked conditions. Next one, there should be no uncertainty in collection, which implies that ultimate collection should be established. Standard is telling these 3 conditions, but frankly telling these are 2 sets of conditions with 2 points. Is it clear everybody? Now very, very important, if initial uncertainty is there, what to do? Recognize or don't recognize her? Don't recognize, and you have to postpone the revenue recognition till certainty is established or till the cash is received. So initially it is certain and subsequently it is uncertain. What to do? Reverse or don't reverse? Don't reverse, you need to create a provision. Is it clear everybody? And now moving on to some special cases relating to sale. This is actually very popular sale. Delivery is delayed at buyer's request. Buyer accept the building. Title is transferred. But you are not delivering, which is called as bill and hold sales, which is very, very popular sales. Buyer accepted the billing, title, ownership is transferred, but delivery is delayed at buyer's request. In this context, seller needs to recognize the revenue only when stock in hand, identified, packed and ready for delivery. If all these four conditions are satisfied, seller can recognize it as revenue. Stock should be in hand, it should be identified by the buyer and seller, and it should be packed by the seller, and whenever buyer asks, immediately I have to deliver. So it should be ready for delivery. If all the four conditions are satisfied, you need to recognize the revenue. Goods subjected to installation. Sir, be careful. You need to check out whether first of all installation is rendering of service or sale of good. If it is sale of good, again you need to check out whether installation is a package with respect to sale of good or installation can be separated. Is it clear, everybody? Now, if it is sale of good and installation is provided as a part of package, and if it is inseparable, you need to recognize when the good is installed, when the good is inspected. Installed by the seller, inspected by the customer. Is it clear, everybody? But in these remaining two cases, you need to treat them as rendering of service. You will be having one of the institute questions, something like machine 1, machine 2 will be there. Machine 1 complicated installation, machine 2 simple installation. So machine 2 you can recognize the revenue irrespective of installation. But machine 1 is a complicated installation. But for your kind information, machine is delivered, sale is accepted. Installation will be done in the next financial year. Is my point clear? Machine is delivered, sale is accepted. Installation will be done in the next financial year. Now, can seller recognize revenue for sale of good or not? Answer. Question ardhamainda? One is normal installation, so no need to consider at all. Another is complicated installation. So, the service will get completed only when the good is installed. Up to this clear, everybody? So now my point here is all about, yes, the service gets completed only when the good is installed. But the good is delivered first. Sale is accepted. And the good will be installed in the next financial year. So now you need to recognize the revenue when? With respect to the sale of good. No. For sale of good, you have to recognize in the current year, whereas for service installation, you can do it in the next year because they are separable. I am telling one statement. Machine is delivered, sale is accepted. Machine is delivered, sale is accepted. Ante sale is separated from installation service. Is it clear, everybody? Now, machine is delivered, but sale is not accepted till the installation gets completed. Then you need to recognize revenue only in the next financial year whenever the installation is completed. Respond, everybody, clear? Hey, any doubts to anyone? So that is what goods are subjected to installation. You need to check out whether the good is installed and whether the good is inspected by the customer. But when to recognize depending on the type. If it is rendering of service, after the service is rendered. If it is sale of good, then you need to check out whether installation is separable or inseparable. If it is separable, you can treat it as rendering of service. If it is inseparable, you need to recognize only after the installation is done. Clear, everybody? And the next one. SAR basis. What is SAR basis? Sale on approval or return basis. Coming to sale on approval or return basis, you need to recognize the revenue only when the sale is approved. That approval can be done either expressed or implied. Expressed ante specifically telling, implied ante symbolic acceptance, direct usage of good or lapse of time or sale of good to the third parties. Is it clear, everybody? Next. Guarantee or warranty sales. This is so simple. Recognize the sale immediately. Along with that, you need to create a provision. Sir, is it clear? Say for example, you have sold the goods now and you are providing 2 years guarantee. Do you need to wait for 2 years to recognize it as sale? No, you have to recognize the sale immediately as on the date of sale, but you need to create provision. And the next one, consignment sales. In consignment, two parties are there, consignor and consignee. Every party has to recognize the sale only when the consignee sold the goods to the outsider. But consignor, it is gross inflow, but consignee is an agent, so it is net inflow and his amount will be limited only to commission. Is it clear, everybody? And cash on delivery sales is normal. Installment sales concept is not there for you. Special orders and shipments, I hope you know this one. Just in time strategy. Likewise, only when the order is booked you will be preparing, similar to job costing. Is my point clear? Similar to job costing, you need to recognize the revenue only when the good is manufactured, identified, packed and ready for delivery. Is it understood? Cash on delivery sales is very simple. Only when the good is delivered, cash is received, and there should be no uncertainty kada. And coming to installment sales, it is so simple, amma. It is similar to hire purchase, but what is the difference ante? In hire purchase, ownership will be transferred only at the last installment is paid, but under installment sales you can recognize its sale immediately and ownership is immediately transferred, and hence you can recognize it as sale immediately. Is it clear, everybody? Sir, in the installment sales you can recognize the sale immediately, no need to wait till all the installments are cleared. Now take care, payment was made in installment and good is delivered after the last installment is paid. Installment sales lo good will be delivered first, then you have to pay the installments. Ownership is also transferred first. Hire purchase lo good is delivered first, payment in installment, ownership transferred at last. In this context, first of all you have to pay in installment. After the installments is done, good will be delivered. So simple. You have to recognize the revenue only when all the installments are paid and only when the good is delivered. Is it clear, everybody? There is an exception also. If at all substantial deposit is made and if you so feel that sale is consummate and the sale is absolute, then you can recognize it as sale immediately by the moment when you have got substantial deposit. Say for example, monthly 1 lakh you have to pay. So after the completion of year, it will become 12 lakh and you have to deliver the good. So you have to recognize the sale only when the good is delivered and only when 12 lakh amount is received. But in this, there is a special concept that 10 lakhs he had paid and he is asking that he needs good immediately. So we have delivered the good immediately. For the remaining 2 lakhs, you are having certainty on him and he will become debtor for that. Sir, is it clear? That's it. So simple, amma. You have to pay all the installment and good must be delivered. And next one, sale to intermediary parties. So simple. Check out whether ownership is transferred or ownership is not transferred. Intermediary parties ante manufacturer to wholesaler, retailer, like that. In between, distribution of channels of distribution. Now, if ownership is transferred, recognize immediately. If ownership is not transferred, wait till the intermediary party sold to the third party. Is it clear? Say wholesaler sold to retailer, ownership is transferred. So wholesaler can recognize immediately, but ownership is not transferred and stock is subjected to return of unsold stock. If any return of unsold stock is there, then automatically wholesaler needs to wait. Only when the retailer sold to the third party, wholesaler and retailer both can recognize it as revenue. Respond, everybody. Clear? This is not at all needed. Trade discount and volume rebate, it is not at all a revenue. It is decreasing the cost price. Moreover, it is not at all entered in the books of accounts at all. Is it clear, everybody? Now moving on to the next thing. Coming to rendering of service. Coming to rendering of service, there are two types of services. You can recognize the revenue basing on completed service contract method or basing on proportionate completion method. Now, if only one act is involved, Completed service contract method. If multiple acts are involved, continuously you have to provide the service, then you have to follow proportionate completion method. Is it clear? If only one act, if service includes continuous period, proportionate completion method. Up to here clear, everybody? So now there are some special cases like installation fees, already discussed. And the next one, advertisement. You need to recognize the advertisement revenue only if it appears before public. And coming to financial service commission, financial service commission is nothing but your approach. You would like to get a loan. You are approaching an agent. Agent is helping you to get a loan. So to whom commission will be income? Agent. So agent needs to recognize the commission only when the loan is granted for you. Is it clear, everybody? Insurance agent commission, it is also the same. You need to check out whether is it new policy or renewal policy. If it is new policy, insurance agent needs to recognize the commission only when the policy is approved. If it is a renewal policy, he needs to recognize revenue only when the renewal is done. Admission fees, whenever the event is completed. Admission fees, zoo, circus, exhibition, or IPL matches, cinema tickets, all these things you are going to get admission fees. Just to enter, you have to pay some fees. That is nothing but admission fees. So you need to recognize the revenue when the event takes place. And the next one, tuition fees, which is nothing but coaching fees over the period of instructions. Say if 10 months instructions are provided, fees has to be apportioned for 10 months. And entrance fees, frankly speaking, entrance fees is not dealt as per accounting standard number 9. It has to be capitalized. But in your NPO, some portion of entrance fees can also be treated as revenue. Am I correct or wrong? This is not as per accounting standard number 9. That concept is as per IGAAPs. And last and final, membership fees or subscription. You need to check out why the membership fees or subscription is provided. Is it provided exclusively only for membership? Then you need to recognize revenue when the membership is provided. And if at all membership includes various other services, then you have to follow proportionate completion method. Respond, everybody, clear? Now, frankly speaking, from sale of goods, this kind of model is very, very important. He will be including multiple cases from sale of goods, and he will be asking how much revenue you have to recognize. That is easy, not at all difficult. And check out. This is a very different question from one of the RTP's questions. Likewise, there is an agreement to dispatch goods valuing 5,000 for the next 6 months. So 5 into 6 months, which is nothing but 30 lakhs. But he had made the entire payment of rupees 30 lakhs. In the 4th month, due to fire, Hina Limited requested not to dispatch the goods worth 15 lakhs, which are actually ready to dispatch. And Raj Limited accounted 15 lakhs as sale and transferred the balance to advance received against sales account. Is my point clear? By observing this question, manakela anpistundante total 5 lakhs for 6 months. Every month sale will be converted to the extent of 5 lakhs. Is it clear, everybody? But institute's contention is not that at all. Institute's contention is all about 30 lakhs sold first itself. This 30 lakhs is obviously your sale. And you are delivering 5 lakhs per month since the delivery is delayed at buyer's request. Is the point clear, everybody? Now, are the stock in hand or not? Identified or not? Ready or not? Ready for delivery or not? Packed or not? Everything done. So you need to recognize entire 30 lakhs as sale. That is how the intention of institute. So be careful in this context. Don't think that 5 lakhs is converted into sale every month. Entire amount is sale only, but it is simply like delivery delayed at buyer's request. Is my point clear, everybody? And one more important thing that I would like to tell. Listen very, very carefully, everybody. There is a company developing a software. There is a company developing a software for another company. Frankly speaking, since it is software development, by the moment when some portion is completed, another company can use that portion. Is it clear? అసలు అలా ఏం లేదు. క్వశ్చన్లో ఏముందో చెప్తా. వాట్ ఈస్ దేర్ ఇన్ ద క్వశ్చన్? There is a company which is developing a software and the total period of development will take 1 year. By the end of the year, you have actually completed 70% of the software development. And the total amount of software development is 1 lakh. By the end of the year, how much amount does a company can recognize it as revenue? Question clear? Huh? Sir, what is the agreement for? How much amount is the agreement for? 1 lakh. And what is the agreement for? Developing a software, which will take an overall period of 1 year. By the end of the year, how much % completed? So now how much revenue does the company can recognize at the end of the year? Is my question clear? Frankly speaking, you need to check out whether is it completed service contract method or proportionate completion method. If at all you are following completed service contract method, entire work will be completed only after rendering the service. At that time, you should not recognize any revenue. But if at all it is proportionate completion method, 1 lakh into 70%, 70,000 you need to recognize it as revenue. Is it clear, everybody? All the others, all the AIs, all your institute is considering it as proportionate completion method only. Because you are providing the service for a continuous period of 1 year. And hence by the end of the year, since 70% work is completed, you need to recognize 70% as revenue. Respond, everybody, clear? And let me tell you one more example. Did you remember FlixNet? One problem is there. Jagratta. Say for example, 1200 is the subscription amount. You have paid the 1200 on 31/3/2012. And this is valid for 1 year. That is up to 31/3/2013. How much revenue you need to recognize by the end of 31/3/2012? You have taken the subscription on this date, Amma. Service is valid for 1 year, Amma. That is up to 31/3/2013. Now my question, how much revenue you have to recognize as at 31/3/2012? 0. Because service is not yet completed, rendered. Whereas coming to 31/3/2013, how much? Entire 1200. Is it clear, everybody? So with this point, students are thinking something like this is a completed service contract method. Since the service is completed after 1 year, you are recognizing it as revenue. But it is not like that. It is a proportionate completion method. Because you have taken 1200 and you are providing the service continuously for 1 year. And frankly speaking, every month 100 will be converted into revenue. And by the end of the year, since all the 12 months is completed, 1200 will be converted into revenue. Respond, everybody, clear? And there are some set of students who are thinking that it is completed service contract method. No, it is not completed service contract method. It is proportionate completion method. Every month you need to recognize 100. Since after the completion of year, entire 12 months completed, entire 1200 will be recognized as revenue. Respond, everybody, clear? Last and final concept relating to AS9. Wait for 5 more minutes. And the concept here is all about other income, interest, dividend, royalty. Royalty has to be recognized as per the agreement. Dividend has to be recognized when right to receive is established. Right to receive is established only when the dividend is declared. Interest has to be recognized on proportionate basis. These are the 3 different conditions. And common conditions are there should be no uncertainty in collection and ultimate collection should be established. These are common conditions for everything. Shall I proceed further? Now, very, very important point, that is, sir, if at all it is sale of goods or rendering of service, if it is initial uncertainty, postpone the revenue recognition till the certainty is established. If it is subsequent uncertainty, you have to create a provision. You should not reverse. But if it is use of enterprise resources by others yielding interest, dividend and royalty, initial uncertainty, postpone the revenue recognition, but subsequent uncertainty, you need to reverse. Is it clear? You are having one question also, royalty receivable, Iraqi dinar. There is a company which has to receive the royalty from in Iraqi dinar to the extent of rupees 200 lakhs. But due to war, due to some restrictions, the amount cannot be exchanged in Iraqi dinar. Initially, you thought of like it is certain and recognized in P&L account. But then it had become uncertain. You have to take it off from P&L account. Is it clear? Sir, for sale of goods and rendering of service, you need to create a provision. But if it is interest and dividend and royalty, you have to reverse or create a provision. Reverse. Did you ever come across with provision for bad debts? Yes. So creating a provision is good. Did you ever come across with provision for interest? See. Provision for dividend? Chi. Provision for royalty? Chi. And hence you should not create provision. Hey, hence kaadu. Sorry. If you did not come across, you should not create provision and na intention kaadu. Common sense entante. Say for example, you thought of like you will get interest and you are writing an entry like in interest account debtor to outstanding interest account. You have written this journal entry. But in future, you have come to know that this is uncertain. So is this income needed or not needed? And hence cancel that income. Is this asset needed or not needed? Cancel that asset also. Is my point clear? Say for example, you have already written like interest account debtor to outstanding interest account. And interest is already closed and transferred to P&L account. Now, in the next year, it had become uncertain. Already interest is closed, kadamma. So now you need to cancel only outstanding interest. And the journal entry will become outstanding interest account debtor to P&L account. Respond everybody clear. Now, if you are doing credit sales, what is the entry? Debtor account debtor to sales account. Subsequent uncertainty ante, do you have doubt on debtor or doubt on sales? Doubt on debtor, and hence you should not reverse the journal entry. Here you need to create a provision. P&L account debtor to provision for bad debts. Is the concept clear? Here sale is not doubtful, debtor is doubt. Here not only outstanding interest is also doubt. And hence, for sale of goods and rendering of services, you need to create a provision. You should not reverse. But for interest, dividend and royalty, you have to reverse. You should not create a provision. Clear everybody? Those students who are watching on YouTube, if you do like our marathon, please subscribe to our channel and please do comment. Coming to branch, most of the concentration is given only to the dependent branch but not to the independent branch. But to some extent of independent branch also we will learn. And the next one, accounting standard number 18 and accounting standard number 19. These are the things we are going to discuss. And one more thing, coming to AS19, I am not going to discuss elaborately. Because if I have discussed AS19 elaborately, it itself will take 2 hours to tell. Yes, I will tell. Allah.